Hey everybody, thanks so much for tuning in tonight. This is Greg Lewis, Director of Marketing for Metastock, coming at you from my basement. Thank you so much. This presentation is going to be about 7 hours tonight, and it'll start in about 14 minutes. Tonight, how this is going to go is we're going to be broadcasting, I should say simulcasting from YouTube as well as GoToWebinar. If you prefer to watch this on GoToWebinar, you're certainly welcome to go to metastock.com/APAC-Summit and register there and watch it there, but you're certainly welcome to stay here on YouTube. It's all the same to us. The host, I should say, tonight will be Hunter Smith, and there will be 7 different speakers, one of whom will be Hunter Smith, and the first speaker will be Brad Gilbert. Anyway, I'm just going to go ahead and go off, and if you have any questions, go ahead and chat them through. I'll be monitoring the YouTube chat, and Hunter will be monitoring GoToWebinar and YouTube chat as well. So throughout the evening, if you have questions for the presenters and you're here on YouTube, go ahead and put it in the chat, and we'll pass those on to the presenters and ask them during the Q&A. So thank you, and you got about 13 minutes, so hang out. And when you sign on, go ahead and let us know where you're signing on from. Yeah, hello, Richard Stevens. Richard asks if this will be available in part or in its entirety afterwards, because he has to go feed the horses and stock now. Yeah, to be sure, Richard, you can watch this in its entirety later. The way this works is it's actually recording on YouTube now. So when you can go back, rewind right now and start watching this over again if you wanted to. This little countdown bit we usually cut off after we are finished, so you don't have to sit there and watch the countdown again, but you can always fast forward through that. So yeah, it's actually recording right now, and it will be available in its entirety right here where you're watching it. So good question. Thank you, Richard, and good luck with those horses in stock in Nevada. By the way, the reason we're doing this so late in the US is, of course, it's the APAC Summit. So anybody in Asia and Southeast Asia, this is a perfect time for them because it's Saturday morning. If you're in the North America, maybe not so great because we're starting at 6 o'clock in the evening, and this will go in until about 1 o'clock. And that's particularly difficult for excuse me, Ed Downs, who's going to be starting at about 1 o'clock in the morning, I think, his time. So when Ed comes on, give him a little break. He's going to be tired. Okay, so we do have a couple more people tripping in now. Make sure you go ahead and let us know where you're listening in from today. I'm curious to know, really, of our listeners, who's actually in Southeast Asia or Asia and in the APAC region, and who's here in North America or Europe. But I'd love to hear from you, so let us know as you're logging in. And if you have any questions, now is a great time to ask them, generally, of course, of the event, and I'll be able to answer them. Hey everybody, once again we'll be starting in about 2 minutes. Our first speaker will be Brad Gilbert. If you have any questions on YouTube, please go ahead and make sure to ask them in chat. I'll be monitoring chat where it says Metastock, that's me, Greg, and Hunter will be viewing that as well as passing them on to the presenters. So don't be, there they go. So don't be shy at all about asking questions this evening. Thank you so much, and we'll be starting in just another minute.
Thanks, bud. Hello, everyone. My name is Hunter Smith, coming to you live from my home in Salt Lake City, Utah. Thank you very much for attending. This is the Asia Pacific Online Traders Summit. We have a long list of wonderful speakers here that will be presenting to you this afternoon. We're excited to show a bunch of different methodologies to you. We're excited to show you a bunch of different ways to trade, and hopefully out of this next 7 hours you will get something very valuable that you can use in your trading. Now, I hope everybody can see my screen okay. Let me just double check that. Looks like you can. Before we get into our first presenter, I wanted to cover the legal part of it. This demonstration is designed to instruct you on using Metastock and accompanying software plugins. It's not a recommendation to buy or sell, but rather guidelines to interpreting and using the specific indicators and features within the software. The information, software, and techniques presented today should only be used by investors who are aware of the risk inherent in trading. Metastock shall have no liability for any investment decisions based on the use of our software, any trading strategies or information provided in connection with the company. So like I was saying, we have 7 wonderful, well, I'll give you 6.5 wonderful speakers today because I'm one of those speakers. But you have a professional trader starting you off, Mr. Brad Gilbert. I'm looking forward to introducing him. We're going to kick this right off and get straight into the education. We are live on YouTube, so feel free to check us out on youtube.com/Metastock. Type questions along the way, and we'll do our best to answer those between YouTube and GoToMeeting. Mr. Brad Gilbert, he founded Traders for Traders in 2009 after 18 years on the front line of some of the biggest Forex trading teams in the world. We've actually had the advantage of working with Traders for Traders for quite a few years now, and Brad's been at the forefront of really some wonderful Forex trading products and education. And today he's going to be presenting on trading the risk on, risk off scenario. So to get us started here, Brad, can you hear me okay?
Great, thank you, Hunter. Appreciate the very warm welcome. All right, yeah, now welcome everyone. And I'd like to, when Hunter asked me about presenting, I was thinking of the most relevant sort of thing I could actually tell people about, and it's actually this risk on, risk off scenario. So what I want to do is just to start with, there's some key components you need to understand about the market and where everything sort of comes from. So let me just grab this screen here and I'll show my screen. There we go. Where are we? Okay. Not the one. Okay. There we go. All right, everyone see the slides here okay?
Looks great.
Okay, cool. All right, everyone. So this is this may be a new aspect for a lot of traders who, for one reason or another, looking to, improve their lifestyle and the investment choices, just becoming a trader and taking ownership of your own sort of financials is a great thing. But one thing that many traders forget about is there's a certain process, like any sort of skill that you may acquire, whether it's any, any type of work that you do, you usually go through a learning process. And one of the first things that I just want to go through to make sure everyone understands the market and the market mechanics, because then once you understand this, I can actually go through and show you how the risk on, risk off scenario works, right? This is a lot different to using your charts and just general indicators. This is more about understanding that the market itself is the indicator, not the tools that you may use. I mean, I also agree that some of the indicators you can use out there can very much enhance your probability of success. But once you understand the core mechanics, then you can really sort of make some inroads into your overall consistency. Now, understanding the financial market mechanics, it's quite simple, right? There's the central bank or the central banks. You've got the fundamental data, the macroeconomic data that drives the market or the economies and tells you what's going on with the economies. And then you've got the financial markets themselves, really focusing on Forex, equity indices or equities, and also bonds. Okay, there's a whole structure here. Now, in normal trading conditions, the market mechanics are very clear, systematic, structured. There's consistent liquidity, and because of that consistency and liquidity, there's less volatility, right? You got normal market conditions. And what we've seen recently with the whole, coronavirus and the reactions that the market's had, it's been problematic because we have no or less liquidity, and that creates extra volatility and a whole range of issues. But just bringing you back to the core basics, right? I just want you to understand this first. The central banks, okay, they manage the economic cycles, manage the economies, very much like the board of a company manages the company, okay, their finances and plans and structure and all these sorts of things. It's exactly what the central banks do. Now, going back to, almost pre-07, 08, 09, around the global financial crisis, they had a basic inflation band, right? 2 to 3%. So what that means is you go back to sort of when Greenspan was around, it was very simple. If inflation dropped below 2%, they lowered interest rates, right? Trying to get people spending their money, less savings and all this sort of stuff. When the inflation rate went above 3%, right? All they did was raise interest rates. They wanted people to save money. So it was a very easy structure for the central banks to manage the economies. Now, with the sort of development of technology, global information now is readily available at the drop of a hat. And with that, the markets have become a lot more dynamic. Okay, so just understand what these central banks are doing. And I know this won't take very long, but I just want you to understand this because I know a lot of our clients, when they first join us, don't understand the structure of how this works. So every 4 to 6 weeks, right? Some central banks, it's every month. Some other central banks, now the ECB, the Fed, every sort of 6 weeks. Now, what they do is they basically meet, they discuss all the financial economic data. They make at the end of their meeting, they have an interest rate decision and a statement, which is released at the same time. Then they come down sort of 45 minutes for many of the central bankers. They have a press conference, explain what they've been doing. And then about a week or so later, you get the minutes of the meeting, which gives you a lot more details of what they were discussing. And in between the cycle of the meetings, Okay, they have the opportunity to come out and do speeches, whether it's the chairman, the president, or the deputies. They can come out and sort of alter the market's perception of what the central bank is doing. Right, these guys are extremely transparent. They want the market, they want traders, they want investors to understand what they're doing, and by doing so, they remove a lot of the knee-jerk volatility out there in the market. All right, so just having a look here, this is the core. So what are they looking and discussing when they get to those meetings? Well, they're discussing the core economic numbers that come out, okay? Primarily inflation and employment are the two core numbers that they refer to most, but all the other small numbers that you see on the economic calendars creates a picture of where that economic cycle is. Do they need to cut rates? Do they need to raise rates? Or is everything just running very consistently and smooth, right? So as this cycle, this is a never-ending cycle. The data is set a year in advance. So as it goes around, they come back to the meeting, they discuss what the data's been, and they make rational decisions on whether they need to give the economy a boost. By doing so, they would raise or cut rates. If they need to slow the economy down, stop inflation going through the roof, they raise rates, right? It's a very simple structure. So interest rates and currency value. This is very simple, okay? If they cut interest rates, the general currency will fall. It's the interest rate differential against the other currencies. If they raise interest rates, currencies rally, right? Now, sometimes a lot of traders ask me and say, well, they've just raised rates, but the currency's fallen. Now, the economic data that they see over the course of the month will predetermine what they're already going to do at the meeting. So by the time the meeting comes up, it's more often than not, it's 90 to 95% factored in whether they're going to cut rates or not. So a lot of the time, it's the statement that determines what happens next in the currency. And usually if they've raised rates, they will say, well, we've raised rates, that's solved the problem. We probably won't do it for a while. And what happens is the currency falls. So you got to understand how the market sort of factors in the economic numbers themselves. Right, the central banks plan to manage the economic cycles. So since the global financial crisis, right, the central banks had to dig into their coffers, get a whole heap of cash, spread the debt, or take a lot of debt burden on. So instead of having an inflation band of between 2 and 3%, most of them were just hoping to get above 2%. Now, the only central bank that actually managed to achieve this was the Fed, right? The Federal Reserve. US economy bounced much quicker than the other economies, especially with Brexit, a lot of other issues going on in the back end, a lot of residual debt that just hasn't been flushed out of the market. And that's what we're sort of dealing with now as well. And I'll come into that as we start to look across the Metastock templates to explain where all this is. But generally speaking, the idea was if inflation got to 2% or above 2%, they would raise rates. If it stayed below 2% and needed to kick along, they would cut interest rates. All right, so this is the whole cycle, and this is going to make a lot more sense why I'm going through this very shortly. Now, major geopolitical events. So I've just explained to you the market mechanics, okay, the central banks, the fundamentals, how that impacts the financial markets. When we have major geopolitical events, such as the coronavirus pandemic, well, it changes everything. Okay, the central banks are still there and the financial markets are reacting to this, but the fundamentals are replaced by, it's like the stimulus packages that the central banks can roll out and the governments versus the pandemic impact itself. So what they're trying to do is balance, like inject as much money as they can to offset the impact of the pandemic. So the first couple of weeks, as most of you, if you've been watching the markets over the course last month or two, would have noticed huge moves, massive moves in the equity markets. The equity markets dropped about 38% in 5 weeks. The currencies, you know what, the currencies were pretty stable throughout this, but we did see, you know, a good 10-cent move across the board in a lot of pairs. But markets become unclear. They're driven by panic, inconsistent liquidity, and that's where that extreme volatility comes in. And unlike the fundamentals, the market is reacting to the stimulus measures whilst at the same time, the fear that is being created by the pandemic itself, it just starts to run. Okay, we get a bit of a running cycle. And then when this happens, the overall mechanics change to be where the focus of the central banks changed. They have to start focusing on the stimulus package itself, and that really revolves around, there's two aspects to it. There's the bond market itself. Okay, so what they do is they cut rates and they buy bonds. Now, really, what they're trying to do is they're starting to work in conjunction with the governments, right? And the bond market is one way where they can get, they can impact indirectly the interest rate market, which is already at zero. Okay, and they're also providing cash for the governments to basically, roll out stimulus package, offset taxes, make sure all the people who are affected by, employment, make sure they've got benefits and all these sorts of things. I think, the biggest packages globally ever have been rolled out across the board in many countries. So how the stimulus package works, and this is quite important because this is the actual where we need to start focusing on different instruments, not just the currencies and not just the charts, for where the direction of the currencies is going to go, and also equity markets and bond markets. So the central bank, right? So historically, and they've been mentioning a few things which is changing on this front, but they generally can only buy financial assets, okay, the central bank itself. But what they can do is they can print cash, right? So they print cash, they buy government bonds. Now the government, they can't print the cash. So they sell government bonds to the central bank, but what they can do is they can go and buy the goods and services. So they sort of work in conjunction, and what that creates, it creates a bit of a raw nerve in the market, on the bond market itself, right? And that has a natural flow-in effect to the equity markets. Now, one thing that I know a lot of traders who haven't been trading for a long time don't understand is the natural correlation or the natural relationship between the bond market, the interest rate market, the equity markets, and the currency value. Right? This is where we're starting to get into the crux of the whole risk on, risk off profile. Now, so you need to understand, I won't go into spend much time on actually telling you how these things are actually correlated and how the bond prices move and interest rates and all these sorts of aspects. But understand, okay, if bond prices rally, that means interest rates move lower. Just on the face of it, the bond price is reflected as an interest rate, right? So if the bond price goes up, the issuer of the bond has to pay back less. That less amount is reflected as an interest rate, so it becomes smaller. So as bond prices go up, interest rates fall. If interest rates fall, it becomes cheaper to borrow money. And that generally means equity markets rally. People will borrow at a lower rate and invest their money in the equity markets, equities rally. But the lower interest rates, this is why I showed you that slide earlier, interest rates and the currency value have a direct relationship. And this is about sort of, global rates and interest rate differentials. If the currency or a country's interest rates fall, the currency falls, okay, in relation to the other currencies out there. What we see at the moment is when all the central banks go to zero, it's like, well, what do we do now? And so that's where it can become confusing if you don't know how the relationship here works and how the risk on, risk off profile or scenario fits in. You won't know which currency pair to buy or sell, okay? It really comes back to understanding the core dynamics of these instruments and how they work across the board. Now, as I was just sort of saying, the two core raw nerves, okay, when there's a massive geopolitical event like we're seeing at the moment, becomes the bond prices and the equity markets themselves. Okay, a lot of mums and dads, investors, fund managers have got a huge amount of money in the equity markets in particular. So if that falls over, that creates another financial problem for the central bank and the governments. At the same time, to calm the markets down, the bond market itself, okay, the government treasuries, this is the core market, historically the safest investment you can get. Now, we saw a lot of bond prices getting haircuts during the global financial crisis, but they, the confidence in that, they need that to stay up, stay afloat. Okay, this is part of the quantitative easing. Whereas normal easing, they would cut interest rates. During the quantitative easing process, they indirectly cut interest rates by buying bonds. Now, interest rates are at zero. Okay, so you can't really cut rates, or you could go to negative, but that's problematic in itself. The easiest step for them to do is to come out and buy bonds, push interest rates lower. It gives the equity markets a boost. and the currency falls. A lower currency makes you more competitive globally. But what happens is when they all do the same thing, the moves start to become random on the currency itself. Okay, usually we're looking at just the core numbers, and the central bank tells us whether they're going to raise interest rates or not. Now, during these events, on a risk-on, risk-off profile, we start to see a rush to safe havens. We start to focus on the equity markets and the bond prices, and these are the things that you need to be focusing on as we go forward through these events. Okay, so just a quick one on the risk-on, risk-off profile. Now, this terminology came around during sort of 07, 08, 09, during the global financial crisis. A lot of the media outlets, CNBC, or actually probably all of them, actually, all the TV networks, were looking for a way to actually describe what was happening in the markets, and equities were just collapsing, right? So what they came out with was the terminology, risk on. Okay, they're saying markets were risk on today, and they've been using it for the last 10 years. Okay, risk on means basically the equity markets are rallying. Okay, risk, people are happy to have risk, so they buy equities, and that's how you get it, right? Risk off, the exact same thing. Well, they're selling their equities, their risk in the market, and that's where that profile came out, specifically out of the US, right? But it's now, it's almost become generic terminology out there. But just understand, it's more about the equities than anything else. Okay, so on a risk-on profile, bonds rally, equity markets rally, interest rates fall, the US dollar falls, and the commodity currencies in particular rally, Aussie, Kiwi, and CAD, right? And the same, and vice versa, the risk-off profile, well, it's just the opposite to what we just had. You've got the bonds falling, equity markets fall, interest rates rally, which they don't want, or central banks during this time. The US dollar rallies and the commodity currencies fall. Okay, it's a pretty simple process. But this is where, if you don't have a tool such as Metastock, right, you can't look at the bond prices, you can't follow the equities, because the interest rate movements are behind the scenes. It's not like the central bank's doing this, you know, telling you interest rates are going up and down. It's the movement of the bonds and the equity markets that are determining what interest rates are doing on a daily sort of basis. So the US dollar will react to the way, in particular, the equity markets, which is, as I said, the major focus for traders. The bond markets, it's a bigger market for institutions, but very important. And then you've obviously got the commodity currencies there in the background. So just coming back now, what happens also at this time? The safe haven trade, right? This is one of those weird ones. It doesn't always make sense. And the safe haven play can change very quickly. Historically, you've got gold and Swiss, okay? Traditional safe havens have got a lot of structure, and they can come in and play in and out all the time. The yen, one of the most liquid currencies, and stable interest rates. So when things start to go a bit pear-shaped, the yen starts to appreciate, okay? Dollar yen comes off, or all the yen crosses, for that matter, go down. But the US dollar, when things get really extremely bad, okay, the US dollar is the default safe haven, okay? It's the reserve currency. And funnily enough, the US or the USA is the least dependent country in the world on exports, right? They can manage themselves without the export market. Of course, they can improve things with exporting, but all the other currencies globally generally rely on the export market to survive. The US doesn't do it, and that's why it becomes a safe haven throughout these events. Now, what we've seen is, and I'll run through this on your charts in a bit, you see dollar yen or the yen is the safe haven. Then all of a sudden, 2 days later, it's the dollar, and dollar yen is rallying. How can you predict that? Well, it's pretty hard, to be honest. And this is where you need to have some structure around what you're doing to work out where you should go with this. And it's like correlations between the currencies, right? Those correlations can break down every other day of the week. So you need to be focusing very specifically on a number of different aspects of the market, which are your indicators, not things you're sticking on your charts, to make sure you know exactly you're trading the right instruments and you're getting the right information from the right sources. So the risk on, risk off versus the safe haven relationship, or the safe haven, how these things intermix. Well, generally speaking, risk on, right? Equity markets rallying, the safe havens come off, okay? Whether that's the Swiss, you get gold, the dollar itself, or the yen. That it's a very, very simple relationship. And when you have a risk-off scenario, okay, the equities going down, the safe havens go up, and that's how it is. Now, I'm going to get into the charts now because I want to do most of my explaining actually using Metastock itself. You're going to stick to your daily trade routine throughout this, okay? Regardless of what you're doing, depending on where you're getting your your trade ideas from, you still got to have the same sort of trade routine that you need to follow. And I'll come back to this at the end, where you evaluate the opportunity, you plan the trade, you work out what strategy you're going to put in place, you cross-check, make sure everything's correct, and then you execute the trades, right? This is a lot different to a lot of traders out there who are sort of banging away on price action. There's a lot more structure to professional trading than probably what meets the eye. Okay, so here we go. Right. So what is your job, right? Your job as a trader, okay, is to find the market's raw nerve. Now, this page here, which I've developed, and a lot of our clients, or I'd say all of our clients use, it just gives you the answers as to exactly what's happening throughout the course of these massive geopolitical events, because this is the raw nerve. Now, it doesn't take away from the fact that we still analyze these instruments technically. The fundamentals, the economic data, it's out the window, right? So this page in particular tells me exactly what I need to know and where to look for specific things. All right, so let me just come into now to my screens here. Now, I'll just come into this page specifically to start with. So what we've got is we've got a number of different things to look at. Now, up the left here, let me just see if I can get my pen on. Where is that? There it is. Okay, so at the top here, I mean, this is the risk on, risk off profile. Let me just change the color. All right, so now what do I focus on? When you're focusing on the markets, think of the global markets. Like, I know we've got three major time zones. You've got the Asia Pacific time zone, you've got the European time zone, North American time zone, right? So to me, or traders in general, it's one big giant day, right? So we go through this. Now, when you think of the markets as a whole, the US, regardless of your opinion on the US, it is the epicenter of economies and the financial markets. So what you need to be doing is focusing on, and this is very much the same as the global financial crisis, right? It all stemmed from the US equity market and the US bond market, right? So you need to be following these things very closely. Now, I know for a lot of traders in the Asia Pacific region, it can be quite late for you to be sort of tuning in, but this is where the direction of the market is coming from. Okay. Now, what can happen as these events drag on, as in the pandemic? It's been going for a couple of months, or started late last year in China. February started to get some traction. By the start of March, where we're already sort of shutting everything down. This is where the US equity market really came into play and was the main source of information about what was going on. Now, when you focus on the core currencies themselves, as in you're following the equity markets, right? So these equity markets fall. The next step is what's going to be impacted next. Well, through the North American session, the yen and the yen crosses in particular is the first port of call for the safe haven trade. Okay, you've also got the Swiss, and then also you're looking at the metals, and in particular gold, right? So generally, when I look at the equity markets here, I generally know what's going to happen down here to the Asian equities. Okay, looking in particular at Japan and China, and you get the sort of flow-on effect. So the equity markets, to me, react as one. If the US equities are up, then the Asian equities are going to be up. That would mean the yen crosses are going to be up. Dollar yen will be higher, right? So you come back down here, you got the Australian, New Zealand equity markets. Well, invariably, they just follow the Dow as well, and the general impact of the Asian equities. And then the European equity markets, which flow on directly after the Asian session, generally repeat exactly what's happening on the North American equities, right? Now, what we're seeing is this pandemic is actually it's very hard to sort of track. Now, this is on a general scale. That's exactly what happens, especially when things blow up and there's a lot of different news around and all the instruments, the bonds are crashing and all these various aspects here. So what you've got to try and work out is, what have I got to look at? Now, generally speaking, let me just come back to change screens here. Okay, so coming back over, this is where, now I'm going to go through a range of pages here. What I want you to sort of just hang in there is actually understand, well, I've got the wrong thing on there. Is trying to work out, let's save that, got to get that screen off. Okay, so where you're going to follow the trail. Now, one of the first things you need to be doing is, I've got about, well, I've got a lot of different templates, but I've got 3 different screens I'm using here. That's why I'm sort of just taking a bit of time to move around the board here. But one thing that you need to do is be able to follow the news. So when it comes back to looking at the general news, you need a news source that actually is covering a lot of different aspects, okay? So what we end up with is a very clear and broad view of the markets, okay? I've got the markets here on foreign exchange, so I can see exactly what's happening here. I've got the main page, central banks and global economy here. Up the top here, I've just got the front page of Metastock, and down the bottom here, I've got world news. The idea is you're trying to keep up to speed with what's going on, because the information that comes out here, a lot of the information is just news, and they're reporting the data. A lot of it isn't opinion pieces, right? You don't want a journo's opinion a lot of the time on what's happening and what's not. All I want to know is the facts, and this is why you need a system like this, because it tells you exactly what's going on, very specific about anything to do with obviously Trump or the virus or the currencies. This is your news source. You cannot be awake for 24 hours a day. Okay, maybe you can do it once, but trying to stay awake throughout the week is problematic. You're going to get fatigued. You're going to make poor trading decisions, and it's going to be not a very happy trading situation for you. So what you need to do when you come back to the markets, you need to come back and check what's been happening in the market. And this is where you get the value of a resource like this. It's important you do this, okay? Find out what the raw nerve is. Now, when we come back and you look at the markets themselves, as in you're trying to work out what's happening, as I said, we get a number of different things here. Generally, on a normal sort of trading basis, we're looking at the core macroeconomic fundamentals, okay? This calendar, if you've been looking at the fundamentals across the board, there's the initial jobless claims each week from the US have been impacting the market. Outside of that, right, the fundamentals are out the window. The stimulus package and what the governments are doing and how they're reacting to the pandemic becomes the fundamental. It is random. The news alerts are sketchy. They're misinformative. It's very hard to sort of be trading what's going on. So looking at this data here is no good to you, right? There's no point looking at this. So what we need to do is look at where the market really is focusing. And this is where I know a lot of you may not understand a lot about what's going on with the bonds, but this is where you need to be following. Now, on a general scale, you want the yield curve to be going higher, right? And you may have seen sometime where, say, the 30-year over here is getting down here towards the 10, or the 10-year is below the 7 or 5. When this curve starts to invert, or those bond yields, basically that would mean, okay, so in 5 years, we're going to be cruising, but in 10 years, it's going to be terrible. So what it is, it's a precursor to a recession, right? And you'll see it mentioned a lot when the bond markets are under pressure. So what the central banks have done is they've come in and they've told you they're going to buy an absolute cartload of bonds, and they get these bonds, the 10, the 7, the 5, the 30 years, or make sure they're steady, stable, and they're above, or they don't sort of drop dramatically. So what do we know once again? With bond markets, okay, if the bond markets rally, equity markets rally. Okay, so this is like when you're looking at the treasuries, you can look at that as your general overall view of, okay, is everything okay? Yes, it is. So then you come back and then you start to look at the equity markets and go, if bonds are rallying, invariably these things are going to be rallying. If the equity markets are rallying, okay, the dollar yen and the yen crosses would be rallying. What else is going to happen? If the equity markets are rallying, gold's going to fall. Okay, you're going to start to see where the flow on effect is across the board using these various tools. Okay, and I don't expect everyone to sort of get this straight away. We do a workshop on this, and it takes time to sink in. For new traders, right, who have Metastock, right, it's a ginormous information hub, right? We used to use Metastock in the banks, right? So I'm very familiar with it. I've used it for about 20 years through Reuters. Then it became Metastock, Thomson Reuters, et cetera, et cetera. So one of the things, there's a lot of tools you can use. Now, one of the key ones that I want to highlight, this is, we are humans, right? We see things, our brain is tuned into fear. That's why the media, focuses on fear. So, they're trying to sell advertising, all the TV networks, and it's all about fear and how many people are dying and all those sorts of things. There's never much positive news. So it's very hard to see what's going on. When you look at your charts, and I'll come to those in a second, because there's a number of charts here that you can look at as well. It's very hard to sometimes see what's going on. The correlation matrix, this tool here will allow us to work out, we can set up an X and Y axis on various instruments. At the moment, I've got it set up on, say, US equities and some Asian equities there, as well as some treasuries. And then I can have all the major pairs plus the risk pairs that I think are, part of a safe haven. So I can work out which safe haven is in the game. You can process this and it will tell you exactly which pairs are reacting with which instrument, right? This is where you start to get a bit more functional. This is where it might actually start to make a bit more sense. So if you're looking at the equity markets, right, the US equities, and they're rallying, right? So you're looking at the Dow Jones, or the futures, the S&P minis, and you've got the NASDAQ, across the board, some treasuries. You can actually work out very quickly without sort of looking at 50 charts and going, well, what pair's moving with what? And with this, you can actually set up the parameters, okay, that will, if I just come into the formatting, you can come in and choose how extreme you want the parameters. Now, what I'm looking for is generally, I like correlations at 90% and above, right? That's where I'm looking for. So anything above 90, that gives you a very close relationship. And when you have that initial focus, you can actually really drill into that pair and actually start to dedicate some time on it. Like these Swiss here, for whatever reason, the Nikkei futures here, very close relationship, right? So if you're in the Asian session in particular, keep a very close eye on dollar Swiss, right? This is where you can use the tools. Now, you can set up the, let me just clear that screen. Now, what you can do is you can set up a whole range of instruments here. Now, if I go into the setup here, modify lists, I've got a whole range of different lists for different instruments that I can check the correlations between, whether it's the treasuries, okay, against the currencies, just the normal currencies, or the commodity currencies, risk appetite, etc. So when I come back to the main page here, if I'm looking for, okay, treasuries, I calculate, it'll go through the process. This does all the hard work for you, all the heavy lifting. So if there's a relationship, and this is what I was talking about before, you need to understand the relationship between the bond markets and the currencies. Usually it's the bond markets and the equity markets, and traders look at the equity markets to see what's happening intrinsically there. But if you go through this process, right, and you come in and you're looking for a high correlation, we can't really see it here at the moment. You're like, okay, so the treasuries, I can't see very clearly what's happening on the currencies, which one's impacting what. So then I can go back to another list and go through whether it's, say, US equities or just equities in general. Okay, recalculate, see if there's anything that really sticks out here. Actually, these are actually just random stocks as opposed to normal ones. So let's just come back to the US equities. Okay, once again, global equity markets. You've got to, I don't care where you're based, you need to be watching what's happening on the US equity market, right? And the US bond market. It will flow through all the other equity markets, and that's where you'll find the answers. And at the moment, this is a pretty big, this is probably the lightest correlations I've seen in the last month, right? Usually we had, if you go back through and look at our FX Market Insight videos on YouTube, there was like a dozen currencies here, which were all lighting up on the equity markets. It makes the trade selection much easier. Now, coming back to trade selection, right? This is the equity indices themselves, the currencies, okay, and even the commodities, even if it's the oil trade, right? The oil itself, crude, all of these instruments trade technically the same as the currencies. So what you can do is you don't just sort of sit here and go, well, okay, the Dow's going up. I'll buy some yen crosses, or I'll buy dollar yen. I might sell some gold. Hang on, let's get a bit fine-tune this process. Right? It's not just about just buying on price action. What you want to do is you want to come back and really fine-tune the opportunity around your technicals. And this is, once again, using the broad information that is on Metastock is very important, understanding how to use this. Okay, so what I've got over here is I've just got the actually, let me just come back to the risk on page. You get the wrong screen up. Okay, here we go. Sorry, back to the right screen. Okay, so what we've got is I've got the major currency pairs here, right? But what you can do is you need to get, if you're not doing it already, start analyzing all instruments. Okay, so generally part of my trade routine is trying to identify what's going on. Now, if you're just looking at the hourly charts, this is going to become a little bit problematic, because what you get in the hourly charts itself is, I would generally call the noise of the market. Okay, price action. Yeah, it's going up, it's going down, it's going up, but you don't really know what's going on overall. So what you need to be doing is looking at these major, say, currencies. And I've also got the Dow Jones, oil, gold, the major sort of instruments that have been dominating the market for some time up here as well. So if I'm looking at, say, the Aussie dollar here, right? Let me just come through a couple of these. You know, we had a bit of a move down. It started trading sideways. I haven't adjusted that trend line because it hasn't really moved beyond it yet. But that doesn't, it sort of says, okay, yeah, Aussie's drifting lower, now trading sideways. To get a better view of this, I would suggest, to get clarity in your analysis, right? You want to come back and say, look at the Aussie on multiple timeframes, right? You need to have, what you want to do is, if you can get clear direction on your hourly chart and your daily chart, well, then you're going to be pretty confident where the direction for that currency is. Now, normally that direction comes from the central banks, right? But the central banks have emptied their pockets. Their interest rates, they've got no tools to use now except quantitative easing and throwing and printing money, right? That's all they've got. So it's very hard to see where the movement's coming from. And that's why we're looking at the equity markets and the bond markets once again. But looking at this, you're looking for clear direction. Now, to me, Aussie is trading sideways here. It's still within the range. I'm still looking to get short Aussie, for that matter, on any sort of moves higher. But at the moment, it's not really going anywhere. So to me, it's going sideways. Now, if I see a currency pair going sideways, I don't put a line through it, but I will look at where the key levels are and look for opportunities. Okay, for instance, if the equity markets fall, okay, once again, if the equity markets like it we have seen, I'll have to come back to this page because it's such a good tool. If you see the equity markets, now let me just change screens once again. Okay, so just looking at the so the Dow here, right? So just using the full extent of Metastock. Okay, so I've got some Fibonacci retracements here, right? So once it broke down through, well, 27,750 around there, it started free falling, right? This is when the coronavirus started becoming national. Everything, governments were shutting down, shutting borders, all these sorts of things. The fundamentals go out the window. Price action becomes extremely volatile. You need to clarify what you're trading. That's why we're looking at the overall. If you don't understand that relationship, bonds up, equities up, interest rates down, currencies down. You need to know which one's which, and then the safe havens come into play. But the equity markets here, you can see how far it went. Now, once again, let me just come back to sort of seeing exactly how far it is. There's a lot of tools here to work out how far things are moving. One is this feature here, okay, the info line. Okay, so over that 6-week period, just clear the screen, we've got a situation where, the US equities over 6 weeks fell 38.4%, right? So then you can actually come back and sort of work out, well, yeah, that's great. I mean, you're using this whilst it's on the move, and it's bounced from that low 33% over the last 3 weeks. To me, it's not over yet. But what you want to do is when you're sort of seeing opportunities like this, you are coming back into the Dow. So I've got the Dow there. So if I just come back across to my main page, I want to know what's going on with the Dow. So if the Dow is falling, I can actually isolate the best entry level, right? So once again, if you come back to the Dow, what I'm doing is I'm looking at multiple time frames. Okay, so with the tools I've got, and I've really gone into short term here on the hourlies. You can see from the lows, we've got a bit of a support line here around 23,500. So you're looking at the full range of the opportunity itself. Now, if you've been through these events before, the equity markets are the raw nerve, right? So when these things break, you can actually plan your entry, not just on price action, but also on the actual technical level itself. Okay, if I just blow that up, you've got a very clear entry level here. And this is this signal once again down through 27,780. That's the start of the move. If you can isolate that. So not only looking at the price action. So what I'm trying to do is show you that the information is going to come from the risk on, risk off profile, and you can fine tune your entry and managing your risk. If you can manage your risk around the entry, you can put a bigger trade size on. You can have a more quantified stop loss, right? Instead of just having 100 or 200 point stop loss, that's problematic because if you have a big enough position, your account's wiped out. So you need to understand the connection between not only your technicals, the fundamentals, which are now sort of non-existent. The fundamentals, once again, is the news, the stimulus, but really the equity in the bond markets. You can sort of target where the price action is going to go. And once you get into this profile, you can start to fine tune the opportunity itself. So if you are looking at the majors, okay, and you're looking for, which pair, you're like, okay, I'm not sure on the Aussie, Kiwi, well, it's falling, maybe a sell on rallies, dollar yen, looks like it's trading sideways. Euro still wants to go down. There's just nothing to give it a push, right? This is all dollar related. And you've got sideways action here on sterling. And we've seen some massive moves here on dollar CAD, but now sort of back to sideways. Oil at $18. Man, as a trader, I'm like, what is going on? Man, this is pretty epic. That should signal dollar CAD to that way, just as a side thing. So you've got all these opportunities. So when I see an opportunity where there is a bit of imbalance in the correlations or the relationships with the different pairs, I go into those pairs. Now, dollar CAD, I haven't looked at this until right now, but this is like dollar CAD, oil at $18. The dollar should be going through the roof here, and dollar CAD should be weakening. So to me, 140, 157, this is a good opportunity to be getting long through this level. Now, you may think, well, that's 150 points away. The markets will deliver 300-point moves in these sort of conditions, right? So what we're trying to do is even quantify maybe a potential entry that is quicker than that. Now, the trend lines, I won't go into how trend lines are drawn and too much. I haven't got time for that. But generally speaking, you've got two highs here. It's the start of a new resistance trend line. The market will be focusing on this through 140.75. It's a really good level. One thing that I had yesterday, I actually wanted to show you this. I mean, this move on gold today, okay, the North American session was easy to pick. And actually, if you have a look at the FX Market Insight, I really highlighted this, and I'll show you that in a second. You've got a trend line here with 1, 2, 3, 4, say 5 touches. This is a very good trend line. But what you need to see is, and this is where I'm bringing some other aspects of understanding what you're doing in, is look up here. It's starting to stall. right? So yeah, the trend is up, it's stalling. To me, there's a no-brainer trade here. And that no-brainer trade is a simple break trade through the trend line. And you've got to have structure around your capital management, but this is pretty easy to do. It's down here at 1680. It's a simple trade to make some cash on. And if you don't look, and I know a lot of traders don't do this, they sort of have one or two pairs they focus on. You need to open your eyes up to the whole market, okay? Whether that's just oil itself, crude, okay? The equity markets, and I'm just focusing here on the US equities at this point, but you should have them all up, and all the other instruments. Now, let me just come back to my main page here. Now, let me just show you where I sort of combine a lot of the analysis into our daily trade routine. Okay, so let me just flick back over here. Okay, so just looking, we had this up for all of our members, the Online Traders Summit. So just having a look here, what you need to be able to do. Okay, so I've just described to you how to follow the risk on, risk off sort of scenario, and I'm going to come back and just recap that before I finish. But you need to be looking at the market conditions. Now, when you come to trade, I don't know if you think much about this, but what you need to be doing is looking very closely at the overall market conditions. Are they good trading conditions? Now, if the US dollar is behaving consistently across the board, then what you're going to find is you're going to find the major pairs, and this is a really, really gorgeous profile. I suggest you do this amongst anything else. We've got the dollar index here and the dollar pairs at the top, right? The US dollar is the base currency. The bottom pairs here, the US dollar is the terms, which is the second quote of the currency. When these pairs are all the same way, red means down, green means up, this is a sign that we have good trading conditions. When the US dollar has very clear direction, the markets are on, and you need to be focusing, okay? When the US dollar doesn't have any clear direction, all the major currency pairs discombobulate. And that's when the cross currencies come into play, and you can pick them off on basically, different economic conditions. Of course, once again, at the moment, all the central banks are cutting rates to zero. So the cross currency trade is a little bit looser, right? The major currency pairs is where the action is, or the major instruments. Okay, you got the commodities, you got the metals, you got the crude, you've got the equity markets. This is where the raw nerve is, and this is where you need to be focusing on your trading to really fine-tune your trade selection. Okay, this is very important. So when I look at that and I see that this structure, okay, where the major pairs are all doing exactly what they should with their correlations, to me, this is awesome. And this is where I come back and I will say that that was today. Yesterday, they were out of whack. So I had an average for yesterday's trading because the majors weren't in play. The market driver, your job is to find out what the market driver is. Now, of course, the overall market driver is the coronavirus, but that will be replaced by, if it's just the equity market or the bond market, it's going to be one of those two factors first. Once again, understand if equities go up, okay, generally means it's because the bonds are going up, interest rates are falling, so the currency should go down. Where that becomes problematic is if everything starts to lose traction and the market or traders lose confidence in the overall market, the dollar will rally as a safe haven when usually it falls, right? So once again, if you start to see the dollar doing something different on the equity markets than normal, well, you'll know to change your focus. So once again, where's my risk on page? Okay, so if these things are going up, right, generally speaking, dollar yen would be going up and the yen crosses, okay, the safe havens would be falling, right? So when the US dollar starts to move in the same direction as the equity markets, it could be a time to say, okay, look, this problem's getting big. You're probably looking at something more specific like gold or just Swiss, okay? So this is where you can sort of start to fine tune things. Now, I know this is a fair bit to sort of take in, but our aim is to try and help our clients work out what's going on. So when you go through your analysis and understanding the risk on, risk off profile, you want to start identifying where the opportunities are, right? So when you're looking at the active pairs, we're talking about pairs that have very clear direction. You've got to isolate those pairs And the pairs with clear direction, you are looking to trade those pairs. And the market will tell you which of those pairs to be trading. Right? It's very important. You let the market determine what to trade. You don't just sort of take the day off and go, you know what, dollar CAD's my favorite, so I'm just trading it. But what could be happening is it could be in a sideways trading motion and just chopping about. And it's going to be very tricky to trade that currency pair without clear direction. Right? So this is where we differentiate between trading sensibly and accurately around, other events. Now, just looking at these other pairs though, the watch list pairs. These pairs are the ones where the overall trend is a bit mixed. It doesn't mean that we don't have opportunities here to get into the trading opportunity. All we need is specific triggers, okay? And that's where you can start to look for opportunities. So these pairs down here, I've got a couple of different structures here, right? Euro, Aussie, and dollar Swiss. I'm looking to sell on a rally. Okay, this is about understanding the whole dynamics of the market as well as these instruments. The Dow, I'm just looking to sell a break, right? I know it's been going up, it's stalling. We've got a good level here of support. So the no-brainer trade there is a break trade, right? So once again, make it easy for yourself to work out what you should be trading. So that's, and this is, this is what I wanted to show you. Like gold, I mean, to me, it sort of stood out. Yeah, the trend is up, but it's been stalling. To me, it's set up for a trigger. If it breaks down through this level here, sell a break, okay, that's got to be some cash in that. And as we saw, there was, right? So that's one of the easier sort of aspects to follow. And beyond that, usually in these markets, the risk on, risk off profile, once again, down the bottom here, you're usually looking at the macroeconomic data. Now we've finished the data for this week, but this is where you usually go to, and this is where you find all your answers. In the risk on, risk off scenario, you don't find any answers here. So don't get too caught up on where the economic data is coming out. Funnily enough, economic data in this time zone or in this sort of market conditions, Trump speech. If we see the Donald, having a speech, it's very important you pay attention, right? The whole aspect of setting up different pages and different templates. If I just bring this across, what you're trying to do is you're trying to fine tune your whole selection. Now, as I mentioned, I've got three 27-inch screens here. I know a lot of traders have more, some have less. To me, I have 3 big screens because I need to see a range of data without taking my eyes off the market. Right, that's the whole aspect of this. So I set up some of the pages here. And if I just show you, I've got one here specifically on Trump. So I know exactly if he's saying anything, I can catch it. Up the top here, major news. And then you come across here to, I want to hear what's going around the market, especially, insightful, specific information about what the Fed's doing, any central banks, any currency pairs. And this is where, if you can get your head around this aspect of the market, the indicators that you put on your charts to try and work out what's going on, well, you probably won't need them as much, right? So just coming back to the news here, this is where the answers are. And when you come back, and I know a lot of people, as I said, I think a lot of the indicators that people use in their charts, yeah, they're good probability enhancers. But your indicators in this risk on, risk off scenario, it's a page like this, all right? So what you need to do is focus on the relationship between these instruments, focus on the currency pairs that are probably going to move, okay, and the commodities and metals that are going to move as well. And then you can keep a track of during the 3 sessions, right? You've got the North American session, then it comes down to the Asian session. Is this moving in the same direction? If it is, well, these currencies here will continue the same move. If the equity markets in the Asian session move the opposite way, you'll see the opposite move here in the currencies, right? The answers are in front of you. And the same way you come into the European session, you're looking for the same movement from the North American session into the European equities. Once again, if it's the same, you'll see the same movements in the currencies. If it reverses, you'll see the opposite move. All right, so that's where we are, guys. This is it may be a new concept for a lot of people, but what I want you to do is just understand that this is the dynamics of how it all works, right? And this is what guys at the banks and the fund managers are looking at to make their trading decisions, because it's different to normal market conditions. And once you get your head around this, I can tell you your trade selection will become so much better. You'll be able to really fine tune your capital management. That means having a bigger trade size with a more defined stop loss and bigger take profits, and give yourself a chance to really make some cash. All right. Now, just one thing I just wanted to share as part of this presentation, we get a chance to sort of give you guys a bit more in-depth opportunities to sort of check out what we're all doing. I think all the presenters will be having a bit of a look at this. So once again, as you signed up, you would have been able to choose some of the special bonus offers that Hunter and the guys have organised with us. You will get the 5-part webinar series on how the bankers trade Forex. The templates that you've seen here, I'm always fine-tuning things as to what's happening, but they'll be very close to what I've just shown you. You'll get, if you've got Metastock and you get a Metastock subscription, we'll provide the templates that I've shown you, and you can just upload those straight into your templates. It's going to make building these templates, you're just going to start seeing things straight away. Everything will light up as opposed to spending weeks and weeks trying to work out how to set this up. You'll also get free access to our daily market insight, where I'm actually using these tools, these templates, to show you what's going on, right? As I said, it's going to fine tune your whole process. And then there's an extra discount there on some of the program and all those sorts of things. Okay, so that's pretty much where we are, guys. I think I'm just about out of time. But I just wanted to make sure that that's exactly everything you need to know is in these templates, right? What I need to do is probably spend a bit more time. That's what we do through the structure of our course and everything else, is to make sure you understand this a lot better. Having a number of days to do this as opposed to an hour is a bit easier. I was going to say, Hunter, is there any questions I need to answer before we wrap up there?
No, we have a few questions, but because of the time constraint, what we'll do is we'll have people reach out to you directly for questions. Now, there's a couple of different ways that they can take advantage here. First off, on our end, if you're looking for the templates, go to metastock.com/T4T install, and you'll be able to get a trial of Zenith, as well as all of the templates that were shown here today. And Zenith is a product that Brad was primarily using throughout that. Now, Brad, is there another way that they can get a hold of you?
Yeah, if you guys send us an email, we'll get in touch with you guys directly, and we can set you up with the structure of what we've got. Just go to the Traders for Traders website. You'll click on the site there, or support at tradersfortraders.com. We'll pick you up straight away and get you set up.
Wonderful. Well, thank you so much, Brad. I appreciate you speaking this morning. Enjoy the rest of your day.
Thank you, Hunter. Good luck, everyone. Cheerio.
All right, guys. So moving on, wonderful presentation by Brad. Like I said, I actually put in the YouTube, and I'll make sure to put that into GoToWebinar as well. It's metastock.com/T4T install, and you'll be able to get Metastock Zenith, which is the tool that he was using, as well as all the templates that he was using as well. And there's a video on there showing you exactly how to install them. So moving on, we have a pretty special bonus offer today for all of those that are attending the summit. We have a couple of newer products, newer add-ons, some newer education available through Metastock, and we wanted to showcase those. We will be a little bit later on, but we're going to be offering these at a very, very special price. First, Ed Downs has a brand new product out called the Chart Pattern Engine. It comes with 13 explorations, an expert advisor. This is kind of based off, this system was kind of created by his AI system. Very, very popular system right now. Normally that is $14.95. Also, for the Summit Bundle, as we're calling it, we wanted to include our trade launch systems by Stuart McPhee. Now, Stuart's going to be speaking a little bit later on this evening, showing a little bit more about his add-on, etc. But right now you have the ability to order the trade launch systems add-on, as well as bundle it with a 5 course, basically a 5-module training that he just recently finished and we have recorded. Now, this training normally he sells for $7.99. The add-on normally sells for $4.99. But we want to include in this bundle Metastock DC. We want to include a month of data for free for you. We wanted to include the chart pattern engine by Ed Downs, Stuart McPhee's trade launch system, as well as his 5-module training, which ended up being around 6 hours or so long. We wanted to include Unleash the Power of Metastock, which is an amazing walkthrough of Metastock 17, as well as our white glove installation service. Now, normally all of this is, pardon me, going to retail for a little over $3,300. For attending the summit, we wanted to give you a special price of $19.97. So you're saving almost $1,500 by doing it through the summit versus splitting them up individually. Now, there's a couple of different ways that you can take advantage of this offer. What you can do is call right now, and it's in the YouTube link, but we'll make sure to put we'll put it in the go-to as well. It's 1-800-882-3040. As well as feel free to come into sales chat. So that's metastock.com/sales chat. Also, if you have any questions or anything like that, they'd be more than happy to help you. Now, moving on to our next speaker. We're very, very glad to have Mr. Gary Burton with us. He's actually done quite a few webinars for us. He's done a couple of our market recaps that we have every single Friday. Check those out on our YouTube as well. And he is going to be covering developing a simple and profitable trading plan with technical analysis. Now, we've had the opportunity of working with Gary for many years now. We've taken his system, which is basically an interpretation of the Huguro method. We've put that into Metastock. So that's actually available within Metastock 17. He's an amazing educator, has a knack for explaining things to individuals. So let's go ahead and bring on the director of the Australian School of Technical Analysis. Gary, can you hear me?
Hunter, yes, I'm here.
Wonderful. Well, I'm going to just turn the time straight over to you.
All right, let's see if we could make this work. All right, so we should be able to see my full screen now.
So I just turned it over to you. Should be popping up. Ah, I see it.
Okay.
Perfect.
Very good. Welcome, everyone. Thank you for coming along today. I think Brad's presentation really highlights what's in the back of Metastock. When you take on Metastock, you have the Zenith product in the background. I'll also be using Zenith charts today because it's part of my work, and I'm going to go through part of my work that I supply to Reuters and show the results of that. And I come at this from a trading perspective. I trade for a living. It pays for my groceries each week and various other things. So that's really, I sit at my desk each day and work out, well, how am I going to buy next week groceries, basically. Not really, but I do trade my own accounts, and I trade some small amount of managed money. So my background is I'm a member of the Professional Analysts Association. I write for Reuters. I also write for FP Markets and the Trading Edge magazine, and I trade my own account. What I wanted to talk about today was approaching this from a trader's point of view as we sit down and trade the markets and we look for, as Brad said, there's a lot of things going on at the market at the moment. So I'm going to bring in some fairly simple guidelines that you can build a very simple trading system that you don't need to code and you don't need to get exotic indicators for, but really let the market tell us where it's going. These books here really impacted my career, if you like, as a trader. The Japanese Chart of Charts, which contains the Huguro method, which we have now programmed inside Metastock. It's a free download or free add-on in there, and listen to the market, which is sadly out of print now, but extremely good. I'm going to go through some of the concepts in there later in this presentation today. And of course, the Navy SEALs book, I'm not a Navy SEAL by any stretch, but the presentation of ownership, particularly they talked about it from a Navy SEAL point of view, but ownership of what's going on around you is an extremely important concept as a trader. And the second one there, make your bed, very famous speech on YouTube around that. But it basically says that you make your bed in the morning, you get one task completed, and it will then lead to the second and third task for the day. So we need a structured approach to our trading day. So this, I always state to my students and to anyone that would listen, this is about as untidy as your desk should be. You don't need state-of-the-art hardware to run any sort of trading lifestyle, but you do need reliable hardware and software, and you need a backup plan. And the backup plan is a second internet connection of some sort, whether it's a phone hotspot outside of your wireless router, but some form of secondary contact to the outside world. And you keep your desk tidy. The most important thing, if you've got stuff piled up all over your desk, just get it off there. This is a business that we need to, this is a business desk. And this is a business, and we need to approach our trading, even if you're sitting at home in this lockdown, looking at the markets, treat it as a business, and it'll give you a little bit more clarity. So I'll point out that this presentation is not to be implied as financial advice in any form whatsoever, but I am going to go through my work with Thomson Reuters. Now, there's a lot of slides in this, and it's quite repetitive, but I do want to point out that this is how you build a trading plan by this repetitive approach. So if you see anything wise in this presentation, we should credit the many experts that have preceded me. If you see anything foolish, then you can assume that it is my error. This is my trading thought for the day. I have this actually up on the wall. I'm calm, stable, I slept well, I'm ready to go, ready to do my job as well as I can. I focus on doing the important thing. I will only make the right decision, not allowing myself to be distracted. I will not let my mind think of insignificant things, and I don't rely on anyone or anything. I will not be incited to make a mistake. This was actually the opening line in Ad Astra, and it really grabbed my attention because that's what we're attempting to do as we focus on the markets, is to keep our focus on the information that's provided to us and not be incited by other people's opinions, news, as Brad said, opinion pieces in news, that type of thing really doesn't help us at all. The information actually is in the market. So I often ask this question in my presentations, that we have two pieces of price action here. And one of them is the Russian primary index, and one is the Chicago Board of Trade wheat market. And I would challenge quickly anyone to sort of say, well, which one is which? Because quite frankly, I've forgotten by now which one is which. But the point I make with this is that they show the same characteristics. As the price goes up, price goes down. And if we look closer inside them, we'll see that new highs are made and new lows are made along the way. And we see down days and up days next to each other, that type of thing. So there is the underlying driver of all of this, of course, is the fundamentals in the background, but it's also the human trader emotion that's attached to these markets and the fear and greed that works around them. One of these is Bitcoin, and one is the S&P 500. Again, unless the sidebar was on, we really wouldn't know which one was which. So again, they both go down, they both go up, they both contain large ranges, they both contain small ranges on a day-to-day and even intraday basis, and at times they look very, very similar, but we tend to bring our own way of being to them. If we understand this Bitcoin, oh, well, Bitcoin means this, or the S&P 500 means that, and so on. A lot of people say that the markets are different today than they were 50 years ago, 60 years ago. The top line here is the S&P in 1948, and the bottom line is the S&P just recently. I think the current S&P looks easier to trade in the gappy 1948 markets. People say these markets are hard. No, they're not. They are far more liquid, and we can see that in the way that the chart flows as compared to 1948. That's a little snippet I've got from 1948, but essentially markets are the same. They go up and they go down, and it's our business as traders is to put some form of application to that to work out, well, where do we fit in with this? Where does my trading plan fit in with this? Rather than saying, well, I feel it's going up or I feel it's going down, I can tell you is not a trading plan. So I will get, as we go, I will come to the some short-term price analysis when we get to the end of the presentation. First of all, I want to look at the relative strength indicator. Simple detail around that. It's an awesome indicator for giving you a picture of the market in itself and some simple applications of relative strength. Now, relative strength, as everyone knows, operates between a low level and a high level, and mostly in between. It's not that helpful to us, but there are some nice examples that occur on a repetitive basis that you can build an expectancy out of with the relative strength. So we're going to look at simple market structure. I'm going to spend quite a bit of time on this and some entry methods and some risk around that. Then we're going to look at the results of that and the outcome of that inside a trading plan using some risk management and the equity curve that was created out of that. And then, as I say, we'll look at some short-term patterns. So the relative strength in itself is simply an average of the upward price change against the average of the downward price change of over a set period of time. Now, this example here shows this is the S&P 500, and the first piece of information here, I'll get my pointer out now. This first piece of information down here shows that most RSIs are set at 14 periods, so I would recommend you don't change that. But it shows in this grouping here, as the market moved from the left here up to the center line there, there's 14 periods in there. It made a gain of 98 points during that time. From the open there to the close there was a 98-point gain. And it took 1, 2, 3, 4, 5, 6, 7, 8 days to do that. So an average of 12.3 points per day gain. And during that time, the down days or the down periods were 1, 2, 3, 4, 5, 6, and a total of 16 points. So an average push down of about 2.6 points. So we had an average gain of 12.3 points and an average drawdown of 2.6 points in that period through there. So we saw the relative strength at that time continue to rise as it works through the maths. The second period here over here shows that the market is in a higher place up here at 33.29. However, in its journey from this point here up to the high here, we had a total gain of 154 points, which was greater than the previous period. That's how we got up here. And an average daily gain of around 17.1 points. During that time, the average loss started to increase. So we took out 65 points in drawdown and an average of 13 points per drawdown period, per day in this case. So the 13 is certainly much larger than the 2.6 in the lead up to this. And so we saw the relative strength start to come off, as they say. It hasn't made new highs in line with the market itself. It's the most important that the relative strength, which is essentially a momentum indicator, move with the market. So if the market makes a new high, the relative strength should make a new high. And when it doesn't, this is what really should alert us as traders, and we can factor this simple observation into our thinking. All right, now, so the sums are that when we add them, work them through in the maths, there they are there, the 12.3 and the 2.6, 17.1 and the 13. and we end up with this lower value down here of the RSI. So I would encourage you to always use the 14 periods. The developers of these indicators went to a lot of trouble, did a lot of back testing on it, and so using their settings I've found is always the best outcome. When we look at RSI compared to price, if we have the price making a low in this area here, and the price makes a small rally, and then the price itself makes a lower low, lower than the previous low, and starts to rally again, we get this opportunity where there's often divergence, where the relative strength moves down in line with the market through here, makes the low, the relative strength rises with the market here, and then the relative strength falls but makes a higher low than the previous low. So the relative strength has made a higher low than the previous low, and the market has made a lower low. So market's fallen further than and should have taken the relative strength with it, but there's been a change in this momentum in the way that this has fallen through here into the low. There's been a change in this momentum, which is mathematically calculated out to give the relative strength the higher low look here. The most important aspect of this type observation of this type of divergence is that the indicator itself, the relative strength, must fall below 30 into the low. It then must rise above 30, but not rise above 50. It then must fall again below 30, and then it's on its way. So this is basic bullish divergence. And once it swings over the internal high point here, as the market's forming this low, as it swings over this, right there, we describe this as a swing buy signal. Now, this can be back tested in all time frames. I tend to do these things by hand. I go through my charts essentially bar by bar on most days. Plenty of time now in lockdown, but this observation here is described as a swing buy signal. Then we have this bearish divergence as the market makes a new high. Relative strength makes a high, and it must be over 70. So relative strength moves over 70. A lot of people say that relative strength over 70 is an overbought signal. That's actually not true. If you go look and look through your charts constructively and look at your relative strength, it's often the precedes a significant rally in price, because it means the momentum is very, very strong. So in this case, relative strength value moves over 70. Market makes a high, market has a pullback. Market goes on to make a newer high up here, and the relative strength makes a lower high. So it means that the momentum in getting up to this new high is lower than the momentum coming into this high here. So again, it must be over 70, it must swing below 70, but not below 50. Swings over 70 to make a lower high, and then swings down at that point. And here we describe this point here as a swing sell signal. On a chart, one of the things that I would encourage you to do is, when you look at this type of divergence, relative strength is calculated on the closing price. It's not calculated on the range of a bar or the shadow of a candle. It's simply calculated on the closing price. So you must look at the closing prices to decide if we have a divergent signal. So here we can see the market made the low here, the relative strength made the low, market danced around a little and then formed into a higher low, a lower low here, but the relative strength formed into a higher low just here below the 30 level, and here became the swing buy signal as this market came and broke out of this downward range here. It gave a swing buy signal. Now, the most challenging part of this is saying, well, I have no further information in front of me, but I have a buy signal. To give you confidence in this, this really needs to be back tested by you by simply working through your charts and seeing if this application is true. And so in this case, we saw the stock come out of there and start to rally out of there. Now, one confirming part of this is the relative strength then moved over 50. And I would argue that this is the point where we should get excited when relative strength starts to work itself over 50. So the market made a higher low, and then went on to make higher highs in there. Now I'm going to come and have a look back at this in a moment or two around Dow Theory and why this is so in our analysis. So when we see divergence from closing prices in here to closing prices up here, we saw the relative strength make a high here. It was over the 70 level. It came in, made a low above the 50 level as the market pulled into here. And then the market went on to make new highs, but the relative strength failed to make a new high. And we're coming in here to a sell signal right here. And I just highlight to you, this is February 2020, and the Nasdaq was putting in a divergent sell signal, giving you plenty of warning that this was on. Now, Dow Theory around this, I've been trading for over 20 years. I've been teaching analysis for a good part of that 15 years, 16 years now. This concept of Dow Theory was really my turning point in my application to the markets. Dow Theory came out of Charles Dow's observation of the averages, the industrials average and the transports average back at the turn of the century. Now, there's not a chance that Dow invented technical analysis. That wasn't his thing. He simply just observed that when the averages changed, he could see a change in the market, and that was really what he centered his statements around. His afternoon newsletter comments were around that. What we do in the market's a great tool for anticipating potential outcomes. The market's always on the lookout for a change in the underlying economic activity of the industrials and the transports. And this is this will give us our bull market and our bear market outcome. So the market is very forward looking. We saw the market sell off dramatically at the end of February. The market is often one of those instruments that will sell first and ask questions later. The market's got it right at the first sell-off that there was something bad happening here. It's not our business to argue with the market, but really react with it. So the primary bull market is a broad upward movement interpreted by secondary reactions, averaging longer than 2 years. So it says at least a bull market should average at least 2 years. During this time, stock prices advance because of demand by investors and speculators. The market is looking at the industrials, the underlying manufacturing of a country, the underlying money flowing around, transports are active, people are buying goods, goods are being delivered into the industry, that type of thing. So the transports will be quite active as well. And then the market makes a decision about that collectively, and we see investors and speculators. Inside a primary bear market, it's often the broad downward movement interrupted by secondary reactions. It's caused by economic ills, does not terminate until stock prices have thoroughly discounted the worst that is apt to occur. I can't underestimate this. I can't underline this enough to you, that this market is trying to work out, as Brad pointed out, the market's being driven by the Fed at the moment. There is a risk that there will be a reckoning point again as the market actually sees that we're not going to get past, or potentially sees we're not going to get past any sort of startup soon, and industrials really will suffer into the end of this year and potentially into next year. And that's what we're on the lookout for at the moment. So a primary bear market is a broad downward trend interrupted by secondary reactions. Now, a lot of conversation at the moment around this secondary reaction. Let's take a look at this in a moment. So a secondary reaction is considered to be an important decline in a bull market or an advance in a bear market, usually lasting 3 weeks to many months, during which the price movement generally retraces 33 to 66% of the primary price change since the termination of last preceding secondary action. When we determine trend in the market, underlying trend, the first thing we do is we use a weekly chart. This gives us our broad direction. So during the primary phase of a rising market, new highs are made and higher lows are made. So once we see the low in the market makes a high, and we're looking for this higher low in here, and then a break of the high just here. This is the exact point that we see a change in trend, and it's really observed on weekly, monthly, longer time frame charts. It is not observed in daily charts and less than daily charts. That's simply noise in the market. So when we identify underlying what we call a primary trend, we're looking for it outside in the weekly charts. Then in the bearish phase of the market, we see the market make a high, makes a low. In this case, it's a higher low than previous, but then makes a higher low. And as we break the previous low there, we see a change in what we call primary trend. And we can see along the way that we have these reactions along the way. Now, we break this down a little bit further, and what that statement is saying that from the last low to this low high up here, we could have a retracement down here of 33 to 66% of that value, that range in there. And along the way, we'll get these smaller ups and downs, which can be observed in the daily chart, until we find the low and the market moves on again. So these ranges here can be 5% up and down ranges on a daily basis or day-to-day basis over a few days. And then as the market gets underway, these retracements here of less than 10% or less are really just also noise in what we call the primary movement. The thing that brings this undone these days is the fact that the margin trading magnifies these your profit and loss. And so I'm going to come a little bit later and talk about some position sizing around that. We'll take a look at that. So when we apply this to the Dow, this is the daily chart of the Dow up until last night. I haven't got last night's price action up in here, but I believe it had a pretty good night, making new highs. But when we look at the original high up here at 29,568 into the closing low here, and this short rally here was at 6.6% of value, and then the market went on to fall a total of 10,977 points. This current rally here, this current movement up here, currently is a 48% movement of this downward leg here. So this movement from here to here, that's 10,000 points. We currently have about a 48%, probably about a 50% after last night, but 50% range up through here. Now, in the daily chart here, we can see the low, the high, and the low. So on a daily basis, we've actually broken this low and we're in a daily downtrend at this point, and then the high up here, and here is the low, and we've sort of moved into it as we break across this high, we're into a daily uptrend. But that's not where the real action is. The real action is here in the weekly chart. If we look at that same piece of price action in the weekly chart of the Dow, we can see that the high here, this is the daily movement, but the weekly movement has simply made one straight move down through here. So we have a corrective move in the market. And if we look back to our left on this chart, we'll see that it's taken out a number of previous lows in one fell swoop. So it's called a corrective move. We have a very large range here, an inside range here, and a very large range here, and a further one here. Following on from that, we have this outside range, an inside bar, and a shorter range here, and a shorter range here. So we have this is now described as a secondary reaction. These very strong moves become your primary moves, and these overlapping moves become your secondary reaction. So we are certainly, from a technical analysis point of view, from a Dow Theory point of view, we are within the secondary reaction following a correction. This is not a new bull market unfolding. To get a bull market to unfold, this needs to retrace here and then needs to rally again to break this high. And then we'll come back and say, yep, we now have a primary bull market underway, or primary bullish phase underway. Probability is now stacked on our side to be long the market. But when we look at line charts, we can see that we just go through and observe these highs and lows throughout the market. So higher highs and higher lows and higher highs and higher lows. We can see this large range here is a corrective up move. It's simply taken out the previous high in one straight fell move. And again, we had a corrective move here where we saw it take out the high and then start to trend again. So when we apply this to price action, this weekly uptrend in here, we can see that these large ranges here become the primary move. These overlapping ranges here become the secondary move. And when we look inside these closer, these secondary moves, we can see that if we unfold them into a daily chart, they look like a daily downtrend, often look like a daily downtrend. And this, a lot of traders mistakenly spend their time inside daily charts. They go, okay, well, this is trending down. I should be short or I should be selling, rather than looking for an opportunity to buy inside an established uptrend that's in place already. So it's something to be aware of. This 2 time frame application to your thinking is looking at these retracements and say, are they a primary retracement or are they a secondary retracement? So secondary retracements overlap each other, the price bars overlap. Primary retracements are the very strong bars that give you this directional movement in the market. So my work with Thomson Reuters centers around this, and we're going to look at a lot of line charts at the moment. I'm going to get through them as quickly as I can so I can get into the short-term price action. And also point out that one of the more interesting books around is Bulkowski's chart patterns, and he basically explains how often times things fail. We'll take a look at that. Inside his book, he describes things called 3 falling peaks. So there's a high here and a high here and a high here, and easy to see that there's 3 highs, so he calls them 3 falling peaks. An ascending pattern, there's generally at least 3 data points in an ascending pattern, 1, 2, and 3, 1, 2, and 3. If you see these 3 observable points inside a pattern, that pattern is generally considered complete. And then he goes on to describe these rectangle bottoms here, 1, 2, 3 lows, in this case 4 lows, or rectangle top where we have this range up through here. And then talks about broadening patterns with the low, the high, the lower low, the high up here, and 1, 2, 3 patterns, and we have 1, 2, 3 significant lows along the way. And the book goes on. So rectangular bottoms and patterns always contain 3 to 5 data points. So something must contain, on the broader sense, must contain 3 to 5 data points for that pattern to be complete. So in the real world, it doesn't look anything like this textbook examples. So in the real world, we'll take a look at this using a line chart just to highlight some closing price movements. So in the real world, it looks like this, where we get this jagged price movements as markets fluctuate around. But at the end of the day, we can still see 3 peaks, 1, 2, and 3. And here, I've picked this one out just to point out there's 3. This one could be the 3rd one here, but certainly this one is higher, so I've named that as 3. Now this is after the fact. Now below here we have 1, 2, 3. So we would say that this pattern here is now complete, and we'd be looking for movement outside of this area. Again, 1, 2, and 3 in this pattern. And this one here, ABB, there's 3 highs in here before it failed. And then along here we have 1, 2, and 3, and then it went on to form another 1, 2, 3 here. But this then broke out of that consolidation and started to move. And we can see that the relative strength has now started to rise as the market is making new lows, but the relative strength here over 50, which is encouraging. So again, 3 pushes high before the corrective move here, and then rallied again into this pattern. So 1, 2, 3 lows in there. We could say there's 1, 2, 3 highs, 4 highs in here, but then it broke out of there and got on its way. This is the part that interests me as a trader. This breakout or this consolidation fail, if there's a price movement to the bottom side, but this breakout is the part that interests me. So I'll go through these. I'll get through these a little bit quicker now because I've got a lot of charts here, but we can see it's done with a line chart and just looking for these 3 significant lows. So these 3 lows here turned up, and we turned up here with price divergence as well, RSI divergence. And our swing buy signal here, as it crossed 50, started to break out, RSI across 50, and we have a new momentum trend. One of my favorites, of course, is Batman. When Batman shows up, you always sell. And Batman turned up again, we always sell. These are off charts that I've sort of collected over time. This is WHA on there. Now, if we develop a simple approach to this using a weekly line chart and the relative strength and a little bit of volume, and we'll bring in the MACD just to have a bit of a look at that. We can, my work with Reuters is I submit some analysis to them each week, and it's based around this setup, if you like, and it's simply a red line chart, which is your closing price line chart on a weekly basis. Bit of a volume indicator here, relative strength, and occasionally I'll bring in the MACD. So these elements are on every chart. So this one here, we're going back a little bit now, but this was BHP. And so when we set up our, and when we teach ourselves analysis, if you like, or when we make observations of our charts, the pieces that I write are simply conversational pieces. So it simply describes what is happening. The weekly chart of BHP shows a downtrend during 2015. Well, that's this area down here. Into a closing price low of $15. The pennant pattern in early 2016 shows a breakout during April. Okay, well, it's kind of broken out just here. And so on. So it sets up a buy signal, basically a buy zone. From this pattern, a technical price target is established up here, and I've just picked out some relevant past support point. A stop loss is required at $16.10, and if this goes to the stop, it means it indicates a break of the established trend, because we're starting to trend here. More importantly, there's 1, 2, 3 lows in here. It went on and met its price target and went further on, and then retraced and formed 3 lows again, and then broke out. So we had to put in a buy zone again, relative strength over 50. So 2 elements: breakout of a pattern, relative strength over 50. And it went on again to meet the price target and set itself up again up through here. So as it broke out, relative strength stayed over 50, but then it started to diverge, or not a great example, but it started to diverge, and we saw BHP simply retrace back. Now it's starting to form a trend line, 1, 2, and 3, and we can see there's 1, 2, 3 lows in here, and the market moved higher out of that pattern. So a very simple observation of just price action and just drawing the simplest lines around there, but looking for 3 of something, 3 significant price points. This one of Santos, 1, 2, 3 lows in here, became a buy signal, set up a price target of around 750, and I think it exceeded that eventually. And more importantly is that everyone has nominated with a stop loss. Now I'm going to come back to this in a little bit of detail in a moment about why the stop loss is nominated as a stop loss. But Santos here had a divergence, bullish divergence here on the RSI, set up the pattern, and then went to the breakout. And Santos rallied out through there and eventually gave another buy signal, MACD buy signal, as well as the slower, faster average crosses are slower, and quite a good look in all of that. So again, this one, CDA, we can see that the relative strength has moved below 50 here, back over 50. There's a pattern in here, 1, 2, and 3, and a breakout, a retest, and simply a buy zone and a stop loss here, price target there. And it went on to far exceed the price target, which is problematic in itself, and then gave a divergent signal as the RSI started to diverge away. As the price got higher and higher, the relative strength diverged away, and we saw it correct back down earlier this year. So there was lots of warnings in the equities market that momentum was weakening off. This one again, CGC, gave a number of buy signals along the way, and a breakout through here again, and a price target up through there, and simply failed. It's put in a lower high, lower low, lower high, lower low, went through the stop loss and simply failed down here to $3.50. We saw the relative strength move below 50 and the relative strength just dwindle away. There is nothing to see in here as far as an opportunity when the relative strength is below 50. However, it came up again down here. We had 3 lows in here with 3 significant lows on the way down, 1, 2, and 3, but also 3 lows in here. And we have this divergence on the relative strength. And so far, it's basically done nothing. This is current chart, and it's basically done nothing. But it's interesting that the volumes are quite high here. So there's a lot of accumulation that would seem at this level. So this hasn't met the stop losses yet, but it's sitting there with a price target of 570 just being this last resistance level on there. AX1 also significant trend line underneath, breakout at the top, 1, 2, 3 highs in there, broke out through there, put in a higher low, relative strength over 50, MACD gave a buy signal and a bit of a volume increase. Trend is underway behind you. This is a weekly chart, price target here, stop loss there, and it's became on its way as well currently in this time period. So this is now starting to show a repetitive outcome of this, looking at these significant trend line supports and pattern breakouts. And then eventually AX1 put in a divergence and simply failed out of there. And relative strength diverged away. MACD gave a sell signal, and on this corrective outcome we've had. Now this happens as a trader, of course. It's not a thing to get bent out of shape over. But if we manage our position sizing, we can work our way through that. And I'll show you the results of that in a moment. LCX, NASDAQ listed stock, gave a buy zone, 1, 2, 3 lows, had divergence way in the background, had relative strength divergence. So there's certainly a new primary trend underway, breaking the high here, as this was a significant high. There's the pullback and the new high. So we have a primary trend underway. Relative strength over 50, MACD gave a swing buy signal, 1, 2, 3. It can't be anything else but a buy, and put a stop loss in and a price target. And it recently met its price target earlier this year, and then simply failed. And on the way, it produced a relative strength divergence signal, and relative strength made a lower high here and broke the previous low, giving the sell signal, and eventually it went through the stop loss anyway. MACD rolled over, but this divergence on relative strength, I can't impress upon you enough its importance in, particularly if you're momentum trading in a longish term portfolio of with a view of sort of weeks to a couple of months. And then often we can have everything right for us, 1, 2, 3 lows, resistance level here, buy zone set up here, relative strength over 50, and it just simply goes straight to the stop loss in there. So clearly market has the capacity to do that, and a little bit of back testing will prove that to you. James Hardy came in with a buy zone, 1, 2, 3 lows in the pattern, over RSI over 50 through there, price target of 24.80. I said at the time, I wrote another note, said take profit, and it eventually went on to put in a high of $32. So what would I know about that? But on the way to $32, it diverged, made a new high here, and relative strength started putting in lower highs, break below the 70 level here, and then went to a swing sell signal just here on its way down. I'll just go back one here. This really should have you on the edge of your seat when we see relative strength starting to fall away and markets starting to push higher. That in itself is not the sell signal. This is a sell signal down here, but this really should alert you in your daily notes to say that this needs to be monitored. CCP also take profit here out of this buy zone. 1, 2, 3 resistance level, broke out, buy zone there and price target, but eventually went on to $37 and simply failed. No indication, no divergence in here. Relative strength made a new high in line with the stock, but simply failed out of that. So it's this happens in trading. No indication of any price weakness other than some health epidemic. Here, BAP, this divergence here, or this rising, sorry, not divergence, this rising RSI over 50 at this point. The breakout here, 1, 2, 3 highs in here. We could argue that there's a bit of a pattern in the background, but these breakout over these 3 highs into the buy zone with a target of $8.50 simply failed again. Divergence high here, lower high on the divergence, and gave the swing sell signal just in here, and the stock failed out of that. And again, A2 milk, this is still current. A2 milk gave the buy zone here, 1, 2, 3 lower highs. In fact, you could pick out 3 lows, 1, 2, 3 lows in here. But it was also a retest to the long-term trend line, and nothing other than the RSI here over 50 or right on 50, and a price target into there and a stop loss sitting here. It went on and it went on, and it's through the price target now. We have a problem, Houston, is that we have the A2 milk making new highs out through here, but we have the relative strength not making new highs compared to recent past. So this is a little bit of concern. Where it's not a concern is the relative strength has come through the 50 level here. So kind of our divergence observation is not to take place once it moves through 50. Price action rules up here. But if it swings over 70 here, swings below and then back above 70 and makes a lower high and swings lower, then we'll be looking for our divergence here. This is your job as a trader, as a portfolio, your own portfolio manager. AMD, Nasdaq stock. Again in here, 1, 2, 3 highs, broke through this little resistance area, relative strength over 50, bit of volume, and off it goes to the price target up through there. We can see that the stock has made a new high up in here just earlier this year. Relative strength hasn't made a new high. This should alert you that something is wrong. And Cochlear, 1, 2, 3 highs on the way down. 3 significant highs on the way down. There's 3 lows. There's a low here, and a low here, 3 lows, and a breakout of this short trend line, relative strength over 50, and a bit of volume on there. And Cochlear almost hit the stop loss, but Cochlear went on to meet the price target of $220. So then recently gave another buy signal up here with a price target of 282 and simply failed out of that. Turned out that the whole pattern was divergent as this unfolded with lower highs through here. So this relative strength, there's something in this. So in the CNU, 1, 2, 3 lows, buy zone. In here we have the rising relative strength over 50, bit of volume, and a buy zone price target stop loss. And here we have the meeting the price target. Relative strength is not doing anything other than what the stock is doing or the underlying price is doing, so not a lot to see there just at the moment. CTXS, US stock, gave the buy zone price target through here, 1, 2, 3, 4 highs in here, 1, 2, 3 lows in here. Relative strength moves over 50 and breaks out of this small pattern here. It can't be anything else except a buy zone. That's the best we can do. And it actually went on to meet the stop loss before it met the price target. That's what happens from time to time, just to rub a bit of salt in. ASML, again, V-shaped recovery down here. We saw the relative strength move over 50 and it's starting to trend, the high, the low, the new high, and buy zone $270 went on to meet that buy zone. Now this is coming into last year, most of these. ATVI gave a divergent top back in 2018, went in to make new lows in here, 1, 2, 3 lows, broke out above this 48.50 resistance. This last part of the low here was your bullish divergence where the stock makes a new low, relative strength makes a higher low. There it is, just over the 30 level there. relative strength makes a higher low and breaks out as a buy signal in here. The next piece is that we'd be nice if it was over 50, and really we want it to break out of this pattern. So we've got the early part of our setup here, and then the breakout in there, and we saw it rally. This is current price up here and hasn't met our stop loss at this point. I'm getting to, hopefully, I've been very repetitive about this, pointing out over and over again the same setup gives you or the same observation will give you a simple trading plan. So what we're looking for is a 3-pattern plan: 1, 2, 3, 3 lows, 3 highs, 3 something, a resistance area if possible, a change of trend, the low, the high, the higher low, the higher high, change of trend, divergence in the background, relative strength over 50. So we want support levels, we want the relative strength over 50, and a higher low, and any sort of divergence would be helpful, just to give us a few guidelines. Now this requires, for me, I go through my ASX 200 watch list on a weekly basis, one by one, looking at these line charts, and the Nasdaq and the S&P 500. I can tell you it's far better fun than TV. Yes, it is. Far better fun than TV, just searching for these observable patterns. One of the ones I copped a bit of flack over was actually Domino's Pizza. It gave all of the right signals: 1, 2, 3 highs in here, 2, 3 lows, 1 here, 1 here, 1 here. Gave a divergence signal right at the bottom, over 50, and the buy zone. All the analysts said that Domino's was really bound to suffer through issues in Europe and whatever, but the market is the market, and it set up a buy zone, so it could only be one thing. Where this rubber hits the road around this is once you get a trading plan together, once you get a repeatable observation of the market together, if we apply some risk to this, we can use this very simple observation of risking a percentage of your account. So if we establish where the entry price is, and we establish where our stop loss is, whether our stop loss is at this level or at this level, it matters not. It should also just represent 1% of our account. And so in all of the observations that I've shown here, there's only 2 things that can happen. It can either hit the price target or it hits a stop loss. They're the only 2 things that can really happen along the way. So if it hits the stop loss, we can make it represent 1% of our underlying account value. So our total account value, if your account value is $100,000, then we're going to risk $1,000 from there to there. And whatever we get on the upside, we'll consider that to be our bonus. The way this works out is if our entry level is at $25 and our stop level is at $24, we're going to risk $1 in this particular example. So $100,000, 1%, we're going to risk $1,000 between here and here. We simply divide our risk is then divided by, our account risk is then divided by our equity risk or our FX risk or our futures points risk, and to give us a position size. So that if we go from here to our stop loss, we can simply only lose 1% of our account along the way. This is the bit that separates out those that just want to have a go at the markets and those that create a business out of this. This simple observation will save you from large losses in your account and turn this into a basic game of business example game. What I did was I took all of my recommendations that I made to Reuters over a year, and I put them into a spreadsheet and said, well, if this is our code here, this is the exchange. This was the entry price on the day I made the recommendation. This was the stop loss on my chart that I sent them. This was the risk between the entry point of that day and the stop loss. It created a position size. Our price target through here, And so two things can happen. It either hit the price target or it hit the stop loss. So in this example here, the first trade was a loser. The next one 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 came home and so on. And we build up this spreadsheet of outcome. And what happened was, because I was always interested to know if you make these recommendations, you really should take responsibility and follow them up. It's the same with anybody sending you a newsletter or any sort of trade recommendation. Well, you really should be asking them how this pans out with some results in the background. So what we found out was that along the way, over a period of a year, there were 81 losses and 123 wins, which was nice. The average trading time was 54 days, and the average P&L was about 6,140. So we ended up with an equity curve like this, and along the way, this is sort of point out that sometimes the markets are just the market. So we have a mixture of Australian stocks and US stocks in that report, and no matter whether it's the Australian market or the US market, it just seems to be the market sometimes. Along the way, we just went into an equity drawdown where the losses for a period of time exceeded the winners. And it happened here again, 8% drawdown was our maximum right there. So it's often, it's not you, it often is sometimes just the market's not giving you what we expect. I did it again in 2019, went through my recommendations using a 1% risk stop loss method, went through them all of my recommendations every week and in a line, and we ended up with this equity curve. So this has some merit now. So we've seen a positive equity curve over two data sets a couple of years apart. One thing I've got this one in here. I made a recommendation on Boeing back in 2016 for a price target of $157. And of course, Boeing goes on to make over $400 price range. And interestingly enough, it's back down here at $100 at the moment with the world as it is. I put this to work in my trading account with my money. This is how I make my living. And the equity curve, this is the equity curve after 55 trades in here. This is the current equity curve after 83 positions taken, and this is up to date as of yesterday. This was the drawdown we had. A number of stops were taken late February. In the last couple of weeks, I've managed to work that back up through here. So this was an extraordinary win. They come along every now and again. And I'll point out that if you run a 1% stop loss, you can't have this go this way. It can only give you a 1% drawdown of your account. So when I make a recommendation or when I put my own trade on, I know for a fact now that I have a 35% chance of failure. I know that I have an average hold day of 54 days before being stopped out one way or the other, either at the price target or at the stop loss. And I also know that I can have up to 4 losses in a row because my backtest results have already proven that. So taking 4 losses in a row is not the headache that some people play it out to be. It's just already established inside the trading plan and becomes part of my daily routine. So very quickly, I've only got a few minutes left, Hunter, I think.
Yeah, just
I just want to go through
1 or 2 minutes.
Okay, so I'll just go through a couple of ideas that I'm working on at the moment. One of the things that bothers me, I'll say this first, that things you hear traders say that I believe in the technology, but it has to go back up. This guy's chart looks good, that guy's chart is wrong. So people have all these opinions rather than looking at what they're supposed to be doing. And the indicator I use never tells me it'll soon go back up and so on. It's not a loss until you sell, and they start screaming manipulation. The problem with this type of talk, if you're an active trader or want to be an active trader, the problem with this, if you're developing up this mindset, the issue with that is that you will start to believe this on a subconscious level. So my view of this is that they not only say, but on a subconscious level believe until they understand the maths of taking a loss. Only when they truly internalize the simple maths of risk, will a stronger belief come into play. So right there is a tipping point between success and failure. So if you understand that by accepting a 1% stop on and using some form of position sizing will give you an advantage or an edge in the market, that is your tipping point to become a successful trader. I'll just go through this very quickly. So any person can create an entry method, but most trading ideas are very good at developing the entry with very little attention paid to a consistent exit. One of the things, and it's actually the exit that makes the money, just taking it off the table. One of the things that interests me on my day-to-day business at the moment is this concept of spike high, and I credit a chap I've done a lot of work with, Ivan Kraston's around this. He really drilled this into me. This concept of where the market, where a bar, I should say, and it can be anything up to a weekly or monthly or daily or intraday bar, makes a high, and the previous bar has a lower high, and the following bar has a lower high, irregardless of the color of the candles. But so we call this area here the spike high. This is the intimate level of resistance in the market. And then the spike low, where we have a higher low either side. So this becomes a spike low. So we don't know it is one until this bar is completed. But they become, this area here becomes your intimate level of support. And here we have a spike high, has a lower high either side. And I say the color of the candle or the bar is irrelevant. It's whether the market was actually able to push higher than the previous bar or not is what I'm interested in. So when you string them together, we have a spike high here, a spike low here, it has a higher low either side, and then a spike high here and a spike low there, and so on. And you start to open out your charts, and they're everywhere. There's a lot of them in your chart. And people look at themselves just noise of the market, but these are your areas of resistance here in that particular time period. So area of resistance here and an area of support here. So it becomes more than interesting when those intimate areas are broken in follow-on price action. So we sort them into two groups and looking at the relationship of the near past prices. So we want to observe, does the following price trade and close over this spike high here, as this one has? So this one has closed here over this spike high. Gives us a different observation of the market. Then we have the spike high up here. We have, because it has a lower high either side. And we notice that there's a lower spike high here. So the market has been unable to take out this previous one in there. So in a lot of Davis box methods and turtle trading methods, they're saying, well, you know, buy the breakout in there and it's 20 period consolidation breakout. The issue with that is that the average failure rate is, the break-even rate's 11%, and the average rise is potentially 24%, but it can pull back to that level or a little lower 60% of the time. So a premature breakout is when prices close outside of a formation, trend line or boundary, but quickly return. And a premature breakout cannot be distinguished from a valid breakout when it occurs. So we're looking at these breakouts here, and the very real application is that these can simply retest or simply fail. And there's been some spectacular failures in Australian dollar, did that recently as it broke out and then simply returned lower out of that. So Bukowski went on to document all of these potential failures in the market, and this is really what I spend a lot of my day thinking about is how can this actually be wrong? How can this fail on me? So he went on to say that flag breakouts have a failure rate of 4%, but it can, if it fails, the market can move 22% lower. It throws back 43% of the time and has a percentage of meeting the target 64% of the time. I'm just going to go forward a few slides here. I want to get to something that you can take away with you. Maybe Hunter can give you this presentation at a later time. Let me go through here. This is the one I want. If you're in a position, whether it's in a daily, weekly, we can start to do what's called a bar count. And we need to first of all identify where the spike high is and where the spike low is. And then we start to count the bars after that, including the follow-on bars. So we have 1 bar, 2 bars, 3 bars, 4 bars, 5 bars, 6 bars later, and it broke that high. This is proven to be a relevant statistic, as often if we get a breakout of a previous spike high, and in fact there's one here, a previous spike high, if we get a breakout through there, this tends to be a stronger indicator that price may continue. And here 1, 2, 3, 4 bars, and we had a breakout through there. And then we have the 1, 2, 3, 4, 5, 6 bars, but it closed inside that spike high. So it didn't close outside there, but simply closed inside. And we find that as we get these bars that close inside, if we don't have a breakout within the next 6 bars, 1, 2, 3, 4, 5, 6, it's generally over, and we find a high probability top in place through there. So I'll leave that there, Hunter. I want to get to one more slide. This one here. And I'm starting to work on some ideas around this, where we're seeing these spike highs in the market and we see the breakout, and I'm saying to myself, well, if this fails, which has a high percentage of failure, if this fails, if we sold the market here, does it actually pay off? So there's my work going forward, and we can see here the failure here. This one, we didn't see any failure, it simply continued on, but there was the high there, and we had a close outside there, and then it simply rolled over and failed in there. And again, here another example, and I'll leave it there. I've got lots of examples here, but I'll leave it there because I'll take up someone else's time. And we should have our charts marked up this way so we can keep a record of what we're doing. And that's me.
Wonderful. Thank you so much, Gary. It's always a pleasure, to have you present. You make candle analysis very, very easy, and you interpret it very well. So it's nice to have that. So if you need to get a hold of Gary, feel free to contact us. We can give you his contact information if you have other questions. Metastock 17 does have his Haguro method programmed within it, and it is, it's very, very powerful, and it gives you a wonderful outline of kind of the week ahead, essentially. So Gary, thanks again so much for your time, and I hope you have a wonderful rest of your day.
Thank you, Hunter. Thank you, everyone.
Now, moving on, hope you guys can all see my screen. We have a couple of add-ons that we are putting together in our Online Traders Summit bundle, and we're very, very excited about them. The first one of which is by Ed Downs, and it is the chart pattern engine. It has 13 explorations, 1 expert advisor. It's actually was created kind of off of his AI method, which is another add-on that we have here at Metastock that goes through and identifies, the best systems to use, etc. This is actually built off of that, and it's been a very, very popular add-on so far. Normally, that's a one-time cost of $14.95. Of course, we're going to discount that for you actually attending the summit today or this evening, wherever you're at. The next part of the bundle is Stuart McPhee's add-on, and both Ed and Stuart are going to be speaking here in just a little while. First off, it's his trade launch systems. It comes with 4 different systems: expert advisors, explorations, indicators. You can actually customize one of his expert advisors with how much risk you want, how much is in your account, etc. And the expert advisor will walk you through how you should place your trades, essentially. Now, that system has been very, very popular, but a lot of times we feel with certain add-ons, it's good to have education with it and have the person that created that add-on to actually walk you through step by step on how to use it in your trading. Stuart has just recently finished a course. It's 5 modules long. Comes out to be probably right around 6 hours long, and it's intensive training with him where he goes over things like how to create a trading plan, understanding the 7-step trading system, the 8-to-2 rule, how to improve your trading discipline. I was actually there for all 5 classes. It's an amazing course. Normally he sells it for $7.99, and his add-on is $4.99. So normally for these things, you're looking at about $3,300. We wanted to give you access to Metastock DC as well. Metastock DC retails at about $499. We have put all of this together in the bundle. So Metastock DC, you get 1 month of end of day data. You get the chart pattern engine add-on. You get the trade launch systems by Stuart McPhee, as well as his 6-hour training course. Unleash the power of Metastock, as well as the white glove installation service for $19.97. So you end up saving a little under $1,500 by going through and by just being here, essentially. So a couple of ways you can take advantage of that. You can call in to 800-882-3040 if you're in the U.S. The number, if you're not in the U.S., let me just pull that up real quick. Also, a really, really good way to get a hold of us is sales chat. We have reps in the sales chat right now. Metastock.com/sales chat. Also, if you're outside of the country, country code +1 801-506-1003. So right along to the next speaker, Mr. Robin Ho, who we've actually had the pleasure of working with for quite some time now. He does extensive training utilizing our Zenith platform, which you saw a little bit earlier. He is a top tier trader and remiser at Phillip Capital. He actually became a very sought after speaker after he turned $100,000 into $2 million within 15 months during the 2008 financial crisis. Robin, can you hear me okay? Hey, Robin, can you hear me okay? Hi, Robin. Can you hear me? You're actually, it looks like you're muted. Oh, can you hear me?
Are we good?
Yeah, I can hear you now. Perfect.
Great.
Let me turn the presenter over to you. You should see a pop-up on your screen. Okay, perfect. I see your desktop. Okay, do you have are you showing the right screen? I see a bunch of different PowerPoints or a bunch of different slides right now. Perfect, we can see it just fine. Go ahead, my friend.
All right. Hi, everyone. Very good morning to you. I'm really glad to be here this morning. I remember the last time I was here was on this same seminar was on 20th February. And I remember back then, somebody asked me a question at the end of the seminar, and he asked, Robin, can you recommend a couple of stocks for us to buy. And I remember my answer was, I'm so bearish on the market. I said, no buy recommendation. And if you need to buy anything, it would be gold. All right, so I remember that's what I said the last time. And I'm not sure how many of you listened to my talk the last time, but if you're new, welcome. My name is Robin, and today I'm going to spend the next 1 hour telling you how I approach the markets, the strategy I use to approach the market to stay alive and to be profitable. So a lot of these slides that I prepare, it's really not only for you, but for me. A lot of these trade plans, I use them personally to trade the markets. So today I would like to share with you some of these trade plans and how I develop them and how I use them to trade the markets. All right. All right. So the usual disclaimer: no inducement to trade today. Whatever I present today really is my own opinion. There's no inducement to trade, and only for education purpose only. All right. Let me just share with you as a start one of the world's greatest trader, and his name is Jesse Livermore. And Jesse Livermore said this, right? He said that I know from experience that nobody can give me a tip or, all right, so let me repeat that. So Jesse Livermore said, I know from experience that nobody can give me a tip or series of tips that will make me more money than my own judgment. So what Jesse Livermore is saying is that if you want to be a trader or investor that you hope to manage and make your own money, you really need to learn a life skill. All right, you really need to make your own judgment. All right, so this guy is no stranger to you, Michael Jordan, and Michael Jordan is a legendary basketball player. And I quote him, he said, I've never lost a game, I just ran out of time. So what Michael is really saying is that, he believes in himself, he believes in his superior skill, and there's sometimes that he would lose in a game, and the reason why he lost in the game is because the referee probably blew the whistle on him. But if he had been allowed to carry on and given more time in the game, he's sure that he would never lost the game. All right, so I lost many games in trading the stock market, nearly went bust many times in my trading career. And I remember in 2008, there was an article written on our national Chinese newspaper, and he said that article tells a story of how I've lost everything, went into a couple of hundreds of thousands of debts, and then came back to be one of the top trader in Singapore. All right, so let me just share with you a couple of recent predictions. I'm sure a lot of you out there would understand that, or who have, who are in the market, knows that we live in very interesting times. We live in very unprecedented times. The way we see the market volatility, unprecedented, market swinging between 5 to 10% a day, and a lot of traders really do not know how to handle a situation like this. So, all right, so let me, well, as Hunter have shared on my profile, on my history, I made headlines in 2008 during the global financial crisis when a lot of people are losing money and I was making a lot of money. All right, so this time around, there was an article written about me by Dr. Welf on 18th of March. And what Dr. Welf did was that, he tracked my portfolio. He wanted to know how I did in the month of March when the market was coming down. So what I did really was, I just gave him all, in one of my CFDs account, I gave him all my trades. And he tabulated the trades. It came to $175,000 profit in just 1 month. And, so the volatility, so I managed to exploit the volatility in this market to make money. But if you look at this chart, all right, so this is Dow Jones, okay? And this is the price action of Dow Jones in the last 2 months. So I've been on the trading floor, and I have spoken to many traders and investors, and a lot of you will be thinking that in this volatility, a lot of traders, or investors could be making money. And if you think that a lot of people out there are making money, you're wrong, right? So in this volatility, actually, a lot of people lose money because they don't know how to handle a situation like this. So just take a look at Dow Jones, all right? I mean, Dow Jones fell in 27 days close to 40%. All right, so this is the fastest fall in terms of speed and magnitude in the history of Dow Jones. So in 27 days, it fell close to 38%, and it has since rebounded from the bottom 33% in 18 days. And today, in the face of all the grim news, sorry. All right, just bear with me for a moment. All right, sorry about that. So today we see the market rebounding, and it has since rebounded like 33% in 18 days. And really what you could see is that, if I haven't started shorting early in the game, all right, so I started shorting the market quite early in the game. Somewhere in February, I was starting to short the markets, and by the end, before the market turned, just before the market turned, I was just looking at my P&L, and I was making close to $1 million. But this rebound, all right, I have given away almost 40% of my profits, and I mean, as a professional trader like me, it's tough to be keeping profits, all right, that you make, and I could imagine a lot of traders and investors out there. So just look at the price action of Dow Jones, all right, and if I hadn't, like I said, if I hadn't shorted early, right, and because the market fell fast and furious. And if the market has fallen already 20-30%, I wouldn't have put a big short position into the market, right? Because that would be like too much of a risk. If you look at the price movement of Dow Jones, all right. So as the market comes down, look at the volume, right, that picks up right just before the market bottom, all right. You saw the volume here, all right. So here was where the market started falling, all right? But then there were still a lot of unbelievers. People still do not believe that this downturn is going to be severe. A lot of people even think that this correction could be a buying opportunity. And that is why when the market came off, you see the volume was thin until right around the bottom, just before it rebounded, you could see the volume picking up, and that's where the fear of the market came in. And so what happened, after the fear, the market started rebounding. And as the market rebounds, see the volumes are not there. In fact, it is rebounding on very thin volume. So what does it tell us? It tells us that a lot of traders, right, although the market is going up, they're still not convinced that this run is real. So by the time they are convinced that the time is real, perhaps the market is already right on the top. All right. So this what this seminar is all about. This is where I want to share how you should position yourself in the market, all right, with the help of price action, just looking at the price, looking at the volume, and having a trade plan. All right, so I started getting bearish, all right, in February 4th this year. And, when I started getting bearish and when I had a hunch that the market could be topping out, I sent this, I posted this chart on my blog, and also sent this notice to all my students, my clients, my followers. And I said, that from these trade plans, I believe that Dow Jones could be topping out here. So I sent two warnings, all right, one in December and another one here in February, that the market could be topping out. And that was where I started building a portfolio of short position. All right, so if you want to know where that was, so this is where the top was, all right, and this was the trade plan, all right, that helped me pinpoint where the market was going to top out. So this is my long-term trade plan. This is like a trade plan that stretches almost 25 years. All right, this is where the global financial crisis happened. That's where I made the my $2 million from $100,000 with this trade plan. I knew that was going to top, and with this trade plan, I knew this is where the market is going to top. And with that, well, that prediction here, the market is going to top. And then the question is, if you know the market is going to top, I know the market is going to top, where is the market heading? So that was my trade plan for the market, all right? And that was where I said the market was heading. So if it pops on top, all right, these are the support levels, all right, that I talk about. And did that happen? All right, so that was the support that I was talking about at 17474. So the market, as it bottomed, it came very closely to 17477, and it has since rebounded today to 24,000. All right, so with a trade plan, I figure that was where I shorted the market. That was where I figured the top will be. That was I figured the market will top out, and then that was the target. All right, that the market, that was my target for the market as it falls. All right, so here is also a plan of S&P, and this is where, as the Dow Jones pops, S&P pops too. But here I updated the trade plan of S&P on 16th of March, and I say, watch here, if S&P pops, all right, this will be the target at 2330. All right, did that happen? That happens almost spot on. All right, here's 2330 and rebounded to 2640 as of 16th of March. All right, so I hope I have already given you a little idea on how I trade with trade plans, and as we go further, all right, you will get a better glimpse of what I'm talking about. All right, so this is a lot of people today are really not sure and they're very confused on where the market is heading. I'm getting so many questions about market directions from now, especially after a very, very huge fall, all right, of 38%, and now the market is climbing, rebounding 33% from the bottom. And a lot of people are asking, is this the start of a bull run? It has the market bottom. All right. So this is where I want to use this seminar not only to educate you, but also I hope that some of the analysis that I do in this seminar will help you in your trading. All right. So this seminar is not only about education; it's a little bit about the my market outlook. In the next couple of months. All right. So I believe that the market has taken a big fall, and it is climbing, and at some point of time, this rebound will sort of taper out, and the downtrend could resume. So I want to I want to just play back global financial crisis 2008. And I remember I was at the thick of the action. All right, so that was where I call a short or a peak of the market in 2007, somewhere off in November 2007. I remember, that was where I put $100,000 and it turned to $2 million. But then I just want you to be watching the Dow Jones chart, all right? So nothing goes down in a straight line. So back then, all right, Dow Jones also fell fast and furious. It went down 22% and it rebounded 12%, all right? So it did like almost 50% rebound, and it stayed there for 4 months, okay? So I remember a lot of people like now, all right, was getting bullish on the market. As the market rebound, they are saying, hey, the market must have bottomed, and they were getting in to buy, and lo and behold, after the rebound, the real crash came, and that is where a lot more investors got hurt. All right, so I hope I have given you like a big picture of what is happening and how I approach the markets. But so now I just want to give a little bit more details. All right. So a lot of you know that for me, I don't trade with indicators. I trade with a trade plan, and I trade with price action. So really, I watch the price. I watch the volume. And with the price and the volume, I create a trade plan. So just for education reasons, I just want to go through with you my prediction of gold, how I have, predicted a bull run in gold way back in December last year, and how this prediction has unfolded. All right. So on 14 June 2019, I showed this trade plan of gold, and I said that gold has been like just hitting this trend line. You see this red trend line here 8 times in the last 6 years, right? It hits this trend line 8 times, and every time it hits that, it pulls back. All right. So but here on the 14th June, I said, well, this time around it's not going to pull back, right? This time around it's going to break above this trend line, and that, all right, will be that will signal a multi-year bull run for gold. All right, did that happen? All right, so that was what happened when it finally broke on 20th June. All right, I said, right, on my trade plan, the next target will be 1520, and did it hit 1520? It hit 1520 exactly, and then it corrected. So this is my long-term trade plan of gold. All right, and if you see my long-term trade plan of gold, I have a couple of targets. All right, so this was where I caught the breakout of gold, and I said that if it breaks out here, all right, if gold breaks out here, all right, we could see a multi-year bull run, and that is the trade plan. All right, so this is the target, all right, that I've set in 20th February, and let's see how it went. So so fast forward now on 26th March, all right, so the trade plan still went very well. Everything went on clockwork, and I predicted the market will hit 1745, all right, on 30th of March. And guess what? Just 2 days ago, it hits that level exactly there. It hits there, and after it hits 1745, now it pulls back. Just yesterday, it pulls back to 1680. All right. This was what I posted on Facebook, all right, as when gold retraced, okay, here to 1515, and I said, all right, watch out, you know, gold is going to take a run up, and you know, we have two targets here, all right, 1702 and 1717. So a short term run coming up, and it's going to hit this targets here. And what did happen exactly? It hits there. All right. So this was a trade plan. All right, hitting 1717. And guess what? All right. Yesterday, all the targets were hit, and after it was hit, all right, it corrected. All right. So you see, so I want you to be seeing how these trade plans has been helping me. All right, the long term and the shorter term trade plan. So the longer term trade plans helped me to have a macro picture, and that macro picture was a target of 1745. All right, and this secondary trade plan, I will call the micro trade plan, tells me that in the short term, when gold breaks above the 1650 level, it is coming to 1717. And so this is where I took my profits, and then we could see now gold, you know, doing a little correction, but this correction is, all right, an opportunity to get in back to gold, because, like I said, the multi-year bull run of gold has started way back, all right, in December 2019. All right, so here I want to share with you how I have also traded the STI index with a trade plan. I want to show you how, you know, progressively through different trade plans, I spotted the high of STI, and how I've used this trade plan, all right, even to spot the bottoms and a couple of very, very significant rebound. So on January 15th, I posted, you know, a chart, all right, on my Facebook, and I said, hey, watch out. I mean, this is STI index, and when it hits 3256, all right, it's probably, you know, it is a major resistance, and we will expect a major correction coming. All right, so this is my first trade plan on STI index, and let's see what happens after that. All right, so this was where it hits the high. All right, and STI was coming down, and as it comes down, I updated my trade plan again, and I said that STI now, all right, is supported along this very nice uptrend line, and if it breaks, right, if it breaks, we could see a very big fall, all right, or very steep fall coming for STI. All right, so this was again on 26th February, I updated my trade plan again, giving the targets for for STI index, All right, and so that was my targets. And I remember Dr. Welf interviewing me, all right, somewhere in the middle of March. And as the market was falling and everybody was asking where the market was headed for STI, I said this, right? I said that STI, unless you see STI hit 2230, all right, it would not rebound. So it has to hit 2230 before we could see STI rebounding. Okay, so at that point of time, I remember there were a lot of skeptics that said, you know, that couldn't happen. You know, 2230 is just too far away. It's just a couple of 100 points away from where we predicted, and you know, and let's see what happens. All right, so what I want to do right now is I want to be showing you a trade plan that I did here. So this was a trade plan that you saw earlier, right here. All right, but this now here, just here, is my macro trade plan. All right, so this macro trade plans, all right, gives me a conviction of where major market tops is. All right, and where the major market tops is through the macro trade plan, and this secondary trade plan tells me where the market will go in the short term. All right, so this is where I predicted 2230. Saw that on the trade plan. All right, a beautiful trade plan that says 2230 STI could, all right, rebound. All right, 2230. All right, and let's see what happens after that. And this was exactly there, spot on. All right, STI hit 2230, and today it has rebounded like 200 points from the top. All right, so what I want to show you here really is how this trade plan synergizes. All right, so this is the first trade plan I had, and that's where I spotted the top. All right. And this macro trade plan, all right, sort of spotted, all right, the recent bottom. So the question is now for those Singaporeans investors, you know, who are watching this program, you could be interested in where STI is headed next. All right. So from this chart, right, I mean, just this secondary trends, you could see the STI is hitting into the resistance. All right, so we could be on the short term. All right, STI could be resisted along at this level, and that is on the Friday's close, and only if it breaks, all right, this level, you want to be turning bullish, but otherwise expect a short-term correction coming from STI. All right, so my strategy, having been in the market and trading for the last 30 years, you know, when I first started trading, you know, I used many strategies. Particularly, you know, I'll be using like candlesticks, I'll be using indicators like moving averages, stochastic, Fibonacci, Bollinger Bands, things like that. And I'm sure a lot of you are familiar with that. You know, but I have since, you know, realized that through price action, all right, you know, I could profit from the market consistently, all right? So when I was using those other indicators, you know, I was not, you know, really profiting or making money consistently. It was lots of roller coaster that I have to go through. But with price volume action and with a trade plan, all right, and I was doing a lot better. All right, so a lot of you out there and a lot of traders today only watch the price, right? And particularly if you have been trading in Forex, right? Particularly Forex traders only watch price, right? They don't even watch volume. So they only watch the price action to trade. But let me just tell you this, right? That you know, volume is a very important indicator, if not a more important indicator than price. And then a lot of you will ask, then how does trade plan comes to play? So even right, you know, when I first, when I started with price and I combined it with volume, you know, while it was, giving me great results, my trading improved a lot. But when so this is a secret, right? So when I was able to combine, all right, price and volume, and then using these two indicators, all right, creating a trade plan by using these two indicators, you know, that was the secret, right, to my successful trading. So let me just give you an example, all right? So what determines price? Price, all right, is really a function of demand and supply. And when the demand is equal to supply, the price will stay flat. When the demand exceeds supply, the price will go up. And vice versa, when the supply exceeds demand, price will go down. All right, so what about volume? All right. So volume to me is the energy in the market. It gives you conviction. It gives you a conviction, all right, to take a trade. All right, whether it be long or short, it gives you a conviction to take a trade. So if volume goes up and price goes up, it gives you a strong buy conviction. But if volume goes down and, all right, so if volume goes up and price goes down, then it will be a strong sell conviction. All right, so let me just give an example, all right, on Tesla. Okay, so Tesla back way back in 2019, all right, is one of the most shorted stock in the US. A lot of people, a lot of analysts downgraded Tesla because, all right, they were not only producing not enough electric vehicles expected. They were burning a lot of cash, and you know, a lot of analysts actually downgraded Tesla, and that's why you see parallel to 2019 December, Tesla was not doing very well. So Tesla was going down and muddling along, and so you saw in October 2019, all right, all of a sudden you see a spike in volume of Tesla, right? A spike in volume in Tesla, and then you had a very, you know, not only a spike, but you have in volume, but also a price gap. So to a lot of people, this doesn't mean a lot, right? But to me, as a professional trader, that's very important, because something, all right, something very, you know, something very important has changed, all right, in Tesla price action, and this price movement could, to me, here could usher in a very bullish run. And what you could see here, all right, is, all right, after this exceptional and significant volume, and after that, the prices sort of went flat for a while, and then it took off. And you see how Tesla price took off, all right? It went from 300 plus all the way to 900 over dollars. And this is where I sounded a warning to the trading community who are still bullish on Tesla. And I say, watch here, you know. So we had a very good, all right, price and volume movement here that sparked off a big run. And here, all right, we have another, all right, huge volumes, and a lot of people were just starting to get bullish here. And that's where I said that the greed, all right, has started coming in. And so when the greed started coming in, all right, it's not a time to buy anymore. It's a time to be selling. And that's where, I said that, Tesla could have topped. All right. And, the rest is history. If you have seen Tesla after it topped up here, all right, when the market started falling in February, it went back to as low as where it came from, and that is the $300 region. So yesterday, all right, the market had a big rebound, and the market rebounded because of this news here that Gillette, all right, has got a drug that has been proven effective in corona virus patients. All right, it not only brought the fever down, all right, it also helped a lot of them in their respiratory, taking them off from the ventilators. So that really was a new input into the market. So the market now had hope, right, that a vaccine to the virus will soon be found. And that's where, yesterday you saw on that hope, the market on Wall Street went up almost 3%. So look here, all right. So, so Tesla yesterday, Gillette yesterday was an obvious choice for traders, all right? So I just want you to be taking a look at how the Gillette price movement went last night as of 2 a.m., all right? So that was where the Gillette price was at like 1 a.m., all right? So obviously I'm interested in getting into Gillette. I just, want to be sure that my timing was correct and I get it at a good price. So I know a lot of people, when the market started, all right, they went in here, all right, they got into Gillette at 86 bucks, all right. So a lot of my friends are calling me and asking, should we be getting in here? And I said, all right, wait, all right, according to my trade plan, all right, 86 is a huge resistance. All right. Why is it a huge resistance? Because this is a bar, right, that just in the middle of March, right, was what I called, a bar of greed, right? A lot of investors actually went in here to buy Gillette, but all right, it failed, and it formed the top of 86 bucks, retraced back all the way to about 65, all right, and then it rebounded. So last night, I was tempted to buy Gillette, but just looking at this price action, I did not enter Gillette at the high, and I was just waiting for Gillette, if I could, all right, to be buying right here at $79. All right, so what this trade plan really tells us is, do not get in to areas where there are huge resistance and areas where you could see greed coming in. All right, so this was where greed came in. And for me, there's two places to buy Tesla, to buy Gillette, and one is at $79, and the other is when it breaks above 79. So I'm looking at this stock here, Gillette, and looking at the price action. This is where Gillette should be heading in the longer term at $98, and that is my trade plan. How do I get to $98? If you look back into history, you will see another greed bar, right, somewhere off here, all right, and that shows 98. And so I'm just watching the price action of Gillette and just trying to find a good time to get in there. All right, so let me just skip this and. All right, so what did I do yesterday? All right, so this is my trade calls yesterday. I just wanted to be showing you a very simple method of trading just watching price and the volume, and just watching where, all right, greed comes into the market and where fears comes into the market. And obviously, when greed comes into the market, we should be a seller and not a buyer. And when fear comes into the market, we should be exploiting the fear and getting, all right, to buy the market, all right, at a good time. All right, so this is where I am yesterday, and yesterday I took a short position of Yang Chiang. So if you look back in the history of Yang Chiang, all right, so every time when you see fear, all right, all right, so that's a good time to get in. So this is where, how do I know there's a lot of fear? Look at the volume and look at how many people are selling Yang Chiang when it fell from $2 all the way back to 75 cents. So that forms a good opportunity to buy Yang Chiang. All right. So that was where Yang Chiang formed a bottom and a short-term top. But what I want to be telling you is that, all right, this bar here, right, which was the maximum fear recorded back in August 2019. This is something that we still can be using, all right, to trade the market. So you saw that every time when the market bounced, all right, and hits the top here, all right, of this line, all right, that this was where the rebound failed, and similarly that was where the rebound failed. So Yang Chiang hit a bottom, you know, and rebounded, and you could see where this is where the greed came in. When the greed came in, the market fell back. When everybody got excited on the market and getting in, the market fell back down, and this is where you saw the fear came in, all right, to the market. And look here, I mean, this is where the fear came in, and as a trader, right, if you can remember where this price action is, see what happens when the market finally fell, all right, from the top. This was where, all right, you should be getting into market again, because that was where the fear price action was in history. And then, so every time you see that there is a greed that comes in, the market tends to correct. When a greed comes in, the market tends to correct, and if you can spot this greed and fear, and if you can know where to get into a good position, all right, whether to buy or to sell, you can profit a lot from the markets. All right. So this was where the last fear bar came in. Saw that? All right. So when the market fell, see the volume increased. All right. And yesterday, right, when Yang Chiang hits this level here again, all right, this was a level that was hit many times, and for many times it has proven to be a significant resistance because of so many greed bars that were here. And so yesterday we had another high volume bar here, all right, and it failed. Right, so it closed low, and that was where I took a long position. Sorry, I took a short position with sorry. All right, so so that's where I took a short position. All right, and with a target to buy back at 91 cents. So I'm not saying that Yang Chiang is going into a bear market, but this is just a tactical trade, all right? A tactical trade, shorting Yang Chiang at 101 with a target of 91 cents and 86 cents, all right? So I hope that just this very simple way of trading that I have been using, all right, in my last 20 years of professional trading, you know, just watching prices, just watching how to exploit greed and fear. All right, so so this is another stocks that I shorted yesterday, and it's DBS. Okay, so this is where we could see a greed bar coming in. All right, DBS fell quite a lot here, and that's where it had a big rebound. A lot of people were coming in to buy, thinking the market has bottomed. It failed, and with that, you know, this forms now a very good support and resistance. And every time it comes here, All right, every time it hits this line where the grid failed previously, it would correct. So it hits here, you know, so here just on the 16th of April, 3 days back, you know, it hits right there at a $20 mark, it pulls back, and yesterday it pulls back again. That's why I took a short here yesterday with a tactic, and so that's, you know, I'm not expecting GBS to go into, all right, a bear market yet, but so this is a tactical trade, all right, shorting it close to 1940 and with a target of 1886 and 1844. So this is my two targets that I'm looking to buy back, a very tactical short-term trade. All right, so this is where I posted on my chat group. All right, so every time I do a trade, you know, I'll be telling them that I shorted the market and which stock I've shorted. So here so yesterday I shorted the market at 441. I shorted DBS, and I said to my trade on the chat group that I will be holding this position overnight. All right. So let me see. I have not much time left. Let me just skip this. All right. So this is how I made $2 million from $100,000, and this is a very, very simple trade plan. All right, of the Dow, and this was where I spotted. All right, and call a short of the Dow right here. And that was the bottom, and that was where I covered my shorts and make the $2 million. All right, and back then in 2008, 2007, 2008, you know, I was a very active trader, and you could see that even my commission, my personal trading commission comes to over $1,000 per month, and this is a record of how I turned $100,000 into $2 million in 15 months. All right, and if you are a trader out there watching this program today, all right, it's important for you to be keeping a trading journal of your P&L, like what I do. All right, so if you see, right, the profile of this P&L, all right, and how from $100,000 it turns into $2 million, right? So the one in blacks are profits, and the one in the reds are losses. And you could see that every time when I take a gain, it's always huge. When I take a loss, it's always very small. And this same whole P&L pattern stretches for 15 months. And that's how I made so much money. So a lot of you will be asking, how do you do it? And the only way possible to do this is to trade with a trade plan. And be cutting your losses very early and be riding your gains. All right, so it is only through trading like this that you can keep your profits big. All right, you can ride on your profit and take big profits and take very, very small losses. All right, so this is a profile of how I traded intraday on the channel A50, and just making 100 over 1,000 US. All right, just through intraday trading. So I want to be just spending a couple of minutes showing you, how a trade plan is done. All right, let me just give you an illustration of Dow Jones. All right, I remember on 2nd of February, I was doing a market outlook, watched by about 400 over participants, and there, I showed my Dow Jones trade plan. Okay, and here, I was telling the crowd that, Dow Jones is on a bull run, but, I don't know where it's really headed, whether it's, this bull run will continue or not. But what I do have is a trade plan. So in this trade plan, I showed, all right, that if Dow Jones were to continue on this trend, the bull run will continue. But if Dow Jones breaks this trend, okay, this is my plan. So if Dow Jones breaks 225,800, it will go to 24300, and if it breaks 24300, it will go into this channel zone. All right, you will trade with this channel trends. So did that happen? Lo and behold, the Saturday after the talk, and that was, I remember, Monday, Dow Jones broke the trend, and this is where a short signal was triggered, and Dow Jones hit 24300. After hitting 24300, it bounces off, and after bouncing off, all right, and when it broke into this channel trend, all right, it just followed this channel, all right, and resumed the uptrend again. So let me just give you an animation of how this whole thing is done. So this is how the trade plan was drawn, all right, and so this is the first sell signal on Dow Jones, and so this was where it broke 25800, and when it broke 25800, it went to 24300, and it rebounded from there. And you could see that it rebounded along this trend line, and when it broke into the trend line, all right, the prices just traded within the trend line. All right. So the lesson learned here really is you really need to have a trade plan. And if you are a trader trying to follow the market directions or to following the momentums of the market, most times you will be whipped by the market, and most times you suffer heavy losses getting into the market at the wrong time. For example, see the market now when it falls, right? Just like what happens in last month when the market fell, it fell fast and furious. Right, the last time, right? The market always fell fast and furious, not giving you a chance to sell. And by the time you're convinced that we should be selling, the market will rebound. All right, and by the time the market, when you're convinced about selling, when the market falls here, like here, by the time you're convinced that you should be selling, the market would rebound again. All right. So with a trade plan, you know exactly when to get into the markets, all right, and when to be selling. All right. So you could be selling at the top and buying right at the bottom. All right. So this is the current macro trade plan. All right, and it has hit the top like I've shown you just earlier on. Okay. So the lesson learned here is, you have to plan. All right? You have to plan your trade. If you fail to plan, you plan to fail. All right. So I want to talk about the advantage of trading with price action versus indicators. So this is the chart of STI. All right. And moving average crossover has been one of my favorite strategy. All right. Before I was using price, volumes, and trade plans as my strategy. All right. Moving average crossover is one of my favorite trading strategy. All right. And well, I just want to be quickly explaining how it works. So here we have on STI index a 10 and 40 moving average. All right. So when the short term crosses the long-term moving average from the bottom is a buy signal. When it cuts, all right, the short-term cuts the long-term from the top, it would be a sell signal. So what you really saw was that if you have bought here and sold here, all right, you would have lost 23 points. And with this, if you have bought here, okay, on this crossover at 2329, and if you have sold here at 3373, you would have made 85 points on this crossover. Okay, and you will look back and you say, boy, I've lost 23 points and I've gained 85 points, and that you would have thought must be a great strategy. But then going forward, by using the same signal, all right, you will have lost 23 points, 122 points, 180 points. So what's the moral of the story? The moral story really is, right, if you out there, right, a lot of you traders and investors out there who are trading, and if you are using indicators works only when the market is trading. So here, when the market is trading, it works really, really well. All right. So if you have applied this on a very trendy market like the Nasdaq, right, in the last 20 years, okay. All right, look at Nasdaq, and if you have used this, you need not be cutting losses, all right, until now, all right, even today, 17 April, yesterday, there was still no crossover, there was still no signal to sell the Nasdaq, all right. So, but then I want you to be watching this, all right. All right, Nasdaq, all right. So if you have been like using moving averages, all right, it is a very lagging signals. But if you, as opposed to using a trade plan, so this is my Nasdaq trade plan, my macro trade plan. It works really, really well. All right, and I want to be sharing with you this trade plan today. And yesterday, that trade, according to this trade plan, Nasdaq could have hit a resistance. Look here, all right. According to this my trade plan, this macro trade plan, all right. So this trade plan spotted the top, and here, all right, it hits a very important resistance. I know a lot of you are very bullish on the market right now, all right. You know, and almost every day the Nasdaq is going up, but you know, according to my trade plan, it has hit a resistance, and that is where I stop buying. And that is where, you know, I start taking profits on Nasdaq. So this is my Nasdaq post, all right. Calling a short on Nasdaq at 8:45. All right, that could be a short-term top, and so that was where I posted on my chat group last night, calling a conviction sell at 8:50, and last night it hit 8:50. All right, corrected back to 700. And you know, that was great. So I don't have a lot of time, all right. So I just skip some slides. So I do some courses, all right. And so if you like to be finding out more about price action, volume trading, all right, you could contact me, all right. I'll show you my contact number, but before that, right, let me just show you my Facebook, RHO Trading Signals. So if you want to be getting in touch with me, and if you want to know what, you know, I have been doing, my market calls, my market updates, you know, I post a lot of this on RHO Trading Facebook. Please feel free to join RHO Trading Facebook, and I have been running some real-time, providing a real-time intraday trading signal alerts. So, so every day, right? Every day I provide signal alerts on major indices around the world, particularly the Hang Seng, the China A50, the Simsky, and in the night time it will be the Dow Jones, Nasdaq, and S&P. So I just want to show you how it works. So before the market opens, you know, I would be doing predictions, all right, on how the market moves, and when it hits. So before the market opens, I'll be calling the high or the low, predicting the high and low. And for example, on 17 April, that was on Friday, all right, I caught a high of China A50 around about this region. All right, the market opened here, I opened low, all right, climb up there, all right, and when it came down, this is where I call, our system called a short on the market. And this is where our system called a buy, and buy, and that was all intraday trades, all right? So here, just with these trades, right, for the subscribers that followed this trade could have made a couple, about 100 points off channel A50 index, all right? So this will show you, we have been running this service for the last 1 year, and the performance has been amazing. We have not lost, all right, a trade for the last 1 year. All the indices that we did, all right, all our calls, all the indices were positive. None of them were negative. And if you want to subscribe this for this intraday trading signals, all right, and to get a 1 month free trial, you could go to tradingkungfu.com key levels and subscribe, all right? So look out for RHO trading signals for stocks coming up soon. We hope to be, depending on how the COVID-19 situation pans out, we hope to be rolling it out somewhere next month. All right, so if you are interested in finding out more about my cost, this is where you could find more details. All right, you could email to me or my partner. All right, we plan to run one in May if the COVID-19 situation allows. All right, if you want to be joining my trading community, you want to be part of my chat group, all right, you could go to my blog, robinhosmarttrade.com, and just click join my trading community. Okay, and every Monday I do a market chat. All right, every Monday I do a market chat to give you my analysis of the week ahead. All right, and if you are interested, please go to Robinhood Smart Trade and find out how to get into the market chat, how to join the market chat. All right, and before I go, this is my contact. If you want to ask me more questions, please email me, all right, or my partner. Okay, so that's all I have for you, and my time has reached. Thank you for being with me for the last 1 hour. I hope to see you again. Stay safe and stay profitable. Bye.
Wonderful. Thank you so much, Robin. That's a very, very good presentation. Obviously Robin's been doing classes for quite some time now, and they've gone over, very, very well, especially from the, the feedback that we've gotten. So Robin, thanks again so much.
Thanks, Hunter. Thanks for having me. Yeah.
You have a good evening.
Yeah. Thank you.
All right. Let's. I'm going to quickly show you guys. Let me make sure my screen is being shown. Okay. All right. Like I said before, we have several more guests to go. Right before I introduce our next guest, keep in mind Metastock 17 is out. We have a couple of new add-ons out and a little bit more education. And just kind of speed through this offer real quick. Our new chart pattern engine add-on for Metastock has been receiving very, very good reviews. It comes with 13 explorations, an expert advisor. It's built off of an AI trading engine. Also with this pack, we're going to be throwing in Stuart McPhee, who will be speaking here in just about 2 hours. His add-on, the Trade Launch Systems, as well as his 5-module course that lasts about 6 hours of very intense training. We also wanted to include in this pack Metastock 17 end of day, so Metastock DC. So all of this normally retails at about $3,300. For attending the summit, we will be offering both add-ons as well as that 6-hour education for $19.97. It saves you a little under $1,500 if you were to buy these individually. So we'll include Metastock DC, a month of data, the chart pattern engine add-on, Stuart McPhee's add-on, as well as his 6 hours worth of training, unleash the power of Metastock, and the white glove installation service that our support has become so famous on. And now our next guest, Mr. Daryl Guppy. I see you right there and all primed and ready. Good to have you here. Daryl's going to be presenting on the COVID strategy. I'm very, very curious as to what you have to say. Obviously, Daryl's a well-renowned market expert. I mean, he's been educating individuals for a very, very long time. I've seen him speak live a couple of times, and it's always a pleasure. Daryl, how are you today?
Not too bad, thanks, Hunter.
Oh, wonderful. Well, I'll turn the time over to you. I'll go ahead and make you the presenter here and let you take it away.
Okay, thank you very much. Let me see what I can see there. Show my screen. Yes, I've just got to click that. That makes life a little bit easier. Okay, thank you very much, everyone, for coming. It's most important. I've got 60 minutes allocated, and I will use 60 minutes to complete this presentation. So obviously, what we're looking at today is a COVID trading strategy, because the idea that things are not any different is probably wrong. I'm going to try to cover 7 things in this 60 minutes. So that's a bit less than 10 minutes for each of it. I'm going to look at some background around this. I'm going to look at what recovery might look like going forward. Then I want to look at the chart analysis techniques that we use in the current environment, whether they need to change, how they can be modified, what's most appropriate. More importantly, we're going to look at rally and trend identification, because the difference between these two is particularly significant. If we are trading a rally, expecting it to be a trend, then we're going to end up in trouble. I'll look at some search parameters very briefly, because we think there's only a few search parameters that are appropriate in this environment. We'll look quickly at analysis filters, and then have a brief look at some recovery strategies that work. Recovery, not revenge. But of course, one of the things that you might possibly like to know is what's our performance background. So here's some details. We've produced a newsletter for the last 27 years. 70% of the case studies that we include in the newsletter have reached their targets. In CNBC, over 15 years, just for our CNBC blog, 73% of the indexes and stocks and commodities that we looked at went ahead to reach the targets that we specified. Of course, many of you will be familiar with my live CNBC work. We don't keep a record of the correct calls there, but the fact that I keep on coming back for the past 20 years suggests that they're pretty accurate. And in terms of FX notes, we've been doing those for 5 years, and I'll do a little bit of brief discussion about that, but our return rates for entered trades is an 87% success rate. So the techniques and methods that I'm talking about today are based on nearly 30 years of trading performance in the public arena. So all of those, particularly CNBC, are assessed on a global basis. Our big concern going forward is potential for a bear trap. We might call this the mother of all bear traps, the way things are developing. On the left-hand side on the chart, you can see that we had this dead cat bounce in the Australian index, the XJO. So after the tremendous fall that began in 2008, there was an 18% recovery that was then followed by a retracement and a continuation of the downtrend. That's potentially the danger that we're looking for in this current environment. China has been through this process earlier than Western markets. And we saw the same behavior with the China market. Shanghai index, we saw this tremendous fall that took place. It was interrupted by Chinese New Year, Wuhan lockdowns, etc. But the result was that we had this tremendous retracement followed by a 15% rally that took place over nearly a month. That rally petered out with a second fall at the beginning of March, and we're now looking at a rebound trend developing from there. So we have a feeling that there's the potential for a bear trap environment developing, even though the Dows continued to put on last night and for the last couple of days. Now, we may be wrong. this rebound development may develop into a strong trend. But at this point in time, we're into defensive trading rather than long-term trend-based trading. I really want to believe, watching the X-Files, they want to believe, we really want to believe that things are going to continue up. President Trump is telling us that this market is going to recover and things will be back to normal. The orange dot shows the forecast unemployment rate in the US. And though those are still a couple of days old, the initial job claims are still in excess of the forecast level. When we have this level of unemployment in the United States, then it makes this sort of Dow recovery unsustainable in the longer term. We want to believe that this is the beginning of a recovery, but at the same time, we suspect that there's a probability that reality is going to come crashing down. Now, whether that reality will be a rapid recovery, as President Trump suggests, and a continuation of this rally as a new uptrend, or whether that reality will be this is a significantly serious long-term economic impact and things are not going to be the same on the other side as they were before we went into it. In that case, we'd be looking at the chart on the left-hand side, initial jobless and unemployment claims, and saying this is more likely to be a continuation of the downtrend. We need this sort of background to help us to decide how we position ourselves within the market in the current environment. Do we take long-term trades and hold on to them in the belief that they're going to continue on a rising trend, or do we treat it as a rally situation until proven otherwise? Part of the way we can make that decision is to understand what recovery might look like. Now, there is a story that runs in the market at the moment that says that recovery, things were pretty much the same post-COVID as they were pre-COVID. I'm not too sure that narrative is correct. We think that there are at least 5 different elements in the recovery process, and each of those will have different impacts on different companies. So it becomes important to be able to identify which of those companies fall into which category, because how we trade them or how we invest in them will rest on that particular analysis. So let's quickly go through the 5 potential developments for recovery. The first is to remodel. Now, I'm not going to insult your intelligence by reading all the information that is printed at the bottom of the screen. I will give you time to read it by yourself. The important thing is that we have seen some remodeling, some rapid remodeling in industry to embrace e-commerce and social media in a way that now becomes integral to business rather than sitting on one side of business. That's one important aspect. So companies that have been able to do that successfully and able to maintain that going into the future provide investment opportunities. Companies that have not really been able to do that, maybe we need to stand clear, potentially look at a short side. But it's the second part of remodeling that becomes more important, because there's an increasing narrative taking place, particularly in the United States, but also in a number of Western countries, that we need to reduce our reliance on overseas suppliers. Now, this is sometimes conflated with an anti-China narrative, saying that China's responsible for this particular viral outbreak and it should pay some sort of compensation or whatever. But the important point is this concept of what is being called sovereign independence. So it's suggesting that we're likely to see a bit of a breakup of the relationship in supply lines between the Chinese supply lines and alternative supply lines, for want of a better word, drawing back from China. Now, that will have impacts on China. It will have impacts on other countries as well. We're not too sure how that will develop yet, but we need to be aware that this is an emerging and stronger narrative that's coming out of the current environment. That makes some companies that have relied heavily on Chinese supply lines vulnerable, and that includes the likes of Apple. Most of their supplies, most of their components are coming out or being assembled in China for the American market. If Apple, for instance, is forced to relocate all of its production processes, then that has a serious impact on its viability as a business and, of course, on its share price. So remodeling is the first part. Let's identify those companies that are either successfully remodeling their business practices or will be forced post-COVID to remodel. 2 other options are to restore or to repair. For many, restoring is going to be difficult because restoring business connections will take time and effort to rebuild the levels of trust that prevailed prior to the COVID crisis. Now, universities are a good example on that. If you take a country like Australia, the foreign student component of export earnings is either second or third largest, depending on which particular set of statistics you want. That means that universities who have treated their overseas students poorly in this current environment, and not just those students from China, are going to have quite a difficult time rebuilding the trust to rebuild that business model back up to its previous levels. How long that restoration is going to take has a significant impact on the way that those companies are going to perform. The third option is to repair. Now, these are just business activities that have slowed down. We can easily think of, in Singapore, KTV lounges, cafes, restaurants, demand for household goods, all those sorts of things that are just the normal part of life pre-COVID. They'll restore fairly easily. They'll be repaired fairly easily. Some will go under, of course, but companies like Starbucks, for instance, will come back and repair their business models fairly quickly and get back into operation fairly quickly. Cycle and Carriage in Singapore, for instance, will get back to selling cars much, much more rapidly. They don't need to restore their business or remodel it. Their old models are going to work pretty successfully. So these are the companies that we can look at and say, the price is being seriously oversold. We can buy these in at a cheaper level and use those as a cheap entry into a long-term investment environment. So understanding how companies may recover after COVID is particularly important in our investment and our trading choices because they tell us how we're going to react to it. The last two choices in the 5 R's are to revive or to resuscitate. If we're talking about reviving companies, tourism industry is probably the best example, whether it be the hotel chains like the Marriott or whether it be destinations such as, in my case, the Northern Territory or Australia or Europe, whatever the case may be. What we're looking at are these are companies that almost went to the wall. All their cash flow dried up. No tourists, no money, nothing. Some of them are marginal, they won't survive. But those that were able to hibernate because of fiscal support measures that came in, introduced by a variety of governments, they will be able to revive and revive relatively quickly. It won't be very fast. Again, these companies, hotel chains for instance, become investment targets because they're being oversold. They will recover, they will revive, the industry will grow, but it will grow over a much slower rate. It's going to take people a lot of time to get back onto aeroplanes and to go to tourist destinations because they want to be assured that those tourist destinations are safe. And that will become the major selling point, the safety of the destination, not the uniqueness of it. Those companies are longer term investments. If we identify them early, we can buy into them at favourable prices. Then, of course, there are those companies that need resuscitation, and they fall into two categories. Airline industry is a good example. Singapore Airlines, it's going to need resuscitation. It's on life support at the moment, as are most airlines. But Singapore Airlines, SQ, will be supported by Singaporean government. Qantas in Australia, even though they deny it, will be supported by the Australian government. So the national carriers will resuscitate more rapidly. However, they will require large cash injections, and whether they come from bond raisings, from government support, that's going to be significant as to how rapidly they're going to recover and where the competition is going to be. I suspect that the days of cheap flights have pretty much disappeared, at least for the next 5 or 6 years. The other companies that are going to need resuscitation are those high-tech startups that were in the cash burn phase of development. They will either collapse or they will need additional capital going into them. Now, there's an opportunity there to be able to buy options across those companies, again, at cheaper rates than currently are prevailing. So when we look at how business as a whole is likely to recover post-COVID, if we can put them into this category of revival or resuscitation or remodeling, then that allows us to focus more carefully on the trading or investment opportunities that may develop from those environments. Having that framework gives us a way that we can understand. So here are the consequences. Now, this is set up for the Australian market. We're using the underlying basis of the rest of the world, business, government, financial sectors, etc. But we are looking, for instance, at international demand shocks, direct wait and see behaviour, Woodside Petroleum, FMG, A2 milk, metal supplies, resources fall into this sort of categories. If you're looking at store closures, delivery restrictions, travel bans, you're looking at General Property Trust, which owns shopping malls, Capital Land in Singapore, Qantas Airlines, SIA, etc. Once we finish this presentation, come back to this slide. Forget the codes that I've put into here, WOW, VAH, VAH, for bankruptcy is Virgin Airlines in Australia. Disruption of domestic supply chains affects people like Woolworths. Get rid of my tags here in terms of stocks and put in your own. Use this as a framework to identify those who are most at risk and failing to recover, those that are likely to recover quickly, those that are exposed to global supply chains as distinct from domestic supply chains, because remember, international travel may become much more difficult. International logistics may become much more difficult and much more challenging as we go forward. So we need to set this background. We believe that the idea that post-COVID is going to be pretty much the same as pre-COVID is wrong. We believe that there will be some fundamental restructurings of economic activity that will take place. Using this type of analysis framework, we hope to identify those companies that will survive, that will get a boost in business quickly. They're the ones that we want to be involved in short-term investment and trading opportunities. Some for longer term, for instance, Sydney Airport are longer term buys for longer term recovery. Others, we're looking at short-term trades because they're not likely to survive for very long, but there's some good rebounds that take place. Life is very difficult, very different to what it was 3 or 4 weeks ago. How do we understand what's going on? We believe that the foundation is chart analysis. I just need to write down when we started here so I can make sure that I'm finished on the 60-minute time slot. Chart analysis is fundamental to understanding the market. It has been a concern that over the last 4 or 5 or 6 weeks, that there has been a whole lot of chart analysis that has developed on social media and various other places that is a pretty poor quality. Now, if we're going to survive in this environment, if we're going to be able to identify and trade effectively, then our chart analysis skills have to be top-notch. One of the ways in which we can identify whether we're doing the right thing is to understand where the errors are taking place. Where we can identify poor chart analysis, we can learn from that to improve our own chart analysis. And if our own chart analysis improves, then the quality of our trading also improves. Better definitions make for better results. So here's a riddle for you. I want to know what animal this is. It has a tail, it barks, it has sharp teeth, and it likes to jump up. And normally, in a live audience, I'd ask for various people to feed back. We can't do that in this environment. But I would suggest that 90% of you, if not more, will say this is a dog. Well, not necessarily, because this definition isn't tight enough. A tail, it barks, has sharp teeth, likes to jump up, pretty much describes a saltwater crocodile. It's a bit of a danger for fishing in the Northern Territory that we're very familiar with. And if we hear barking while we're on the water, we know that there are crocodiles sitting around. The important point is that loose definitions increase risk. That wasn't a dog, it was a crocodile. That wasn't a triangle, it was something else. That wasn't a head and shoulders pattern, it was something else. If we don't have our definitions as tight as possible, then we will make mistakes. And those mistakes in this market can be very quickly fatal. So let's have a look at a couple of examples of chart analysis which isn't quite right or sometimes quite wrong. This is like the curate's egg. Now the curates, of course, were ministers of the Church of England. They were often very young men, not particularly skilled in domestic skills or anything else, but they were good for preaching. And they would go to remote parishes in England. And there is the story of the bishop visiting his curate, and his curate cooks a meal for him and serves eggs. And the eggs aren't quite properly cooked. So the saying, the curate's egg, means that it's right or cooked in some places, but uncooked in other places. This charting example is an example of that type of curate's egg. It's right in some ways, but not right in some other ways. And yet, this is what we will commonly see in terms of analysis. First of all, it has a bearish triangle, and that's pretty well defined. We might argue about the exact placement of the support level or the sloping trend line, but by and large, it's pretty good. The same with the upward sloping triangle. Again, we might argue about the placement of the lower trend line. The placement of the resistance level is, yeah, it's pretty good. We might move it a bit higher, perhaps some people would do that, but by and large, it's pretty good. So what's the problem with it? Again, normally in a face-to-face audience, I'd ask for some feedback. So what's the problem? Let's do some deeper analysis in what's going on. First of all, here's a bearish triangle. We'll accept the lines as they've put them on as being accurate. What is the purpose of a bearish triangle? Why is it important in charting and chart analysis? The first part of the answer is a bearish triangle is bearish and generally tends to suggest that price will move down. Okay, that's fair enough. But more importantly, it gives us a method of establishing a price target, a measured move. And that is created by taking the base of the triangle, measuring that, taking that value and projecting it downwards from the lower level of the triangle. That gives us a downside target. And as we can see, that target was has been reached and also exceeded. So the bearish triangle by itself, that's important. But using the bearish triangle is even more important. So let's look at the bullish triangle. The bullish triangle, we apply the same methods. We measure the base, take that value, project it upwards, and it gives us an upside target. Now, the original illustration had this little bit here. And yes, it sort of moved towards the target level, but it placed the target level at this resistance point. So let's make the analysis a little bit more sophisticated. First thing, taking this base of the triangle, projecting upwards, gives us a price target here. But we know the price could continue slightly higher, but it would run into resistance at around this level here. That gives us the first part of a trading plan. It tells us that if we take a position in this stock, our first sell target is at this level. If price is still showing good momentum as it approaches that level, then we'll take our sell order out of the market and place it just below that resistance level, hoping to capture the breakthrough from the target as it moves towards resistance and then pulls back. That gives us a more effective trading plan. But as they say in all the best advertising, wait, there's more. If we look at this pattern here and we accept that it's correct, then the suggested buy zone on the original chart is here. That's a very conservative buy. And in fact, if we're buying on that first part of the breakout, the danger is that our stop loss level is still down at the lower level set by the trend line. We're actually entering a long way above the trend line, which is where our natural stop loss level is, through here. So what that means in the current environment is the risk in the trade grows substantially. The most effective way to enter in these types of trades is to enter as close to that trend line support level as possible. That means that it's only a small fall to go below the trend line that triggers our exit, because a fall below that trend line is what gets us out of the trade. So the aggressive buy zone is closer to the trend line value. It does two things. First, it reduces our risk, because when our stop is hit, the amount of capital we have at risk is much lower. Secondly, it increases the reward in the trade, because now we're trading from the value of close to the trend line to the initial target set by the measured move. So the initial analysis through here, it's pretty good. You won't go too much wrong by following that, but you can make it much, much better by understanding that the importance with triangles is the ability to measure the base and to project a measured move. Once you've got that in place, you can decide if you want to be an aggressive buyer or a conservative buyer. So this is what a perfect template looks like for a triangle pattern. And sometimes you'll find them in the market, as in this example. Sometimes they're pretty close to it, but not quite. So what are the characteristics? There are 4 important characteristics. The first is the resistance level, the flat edge, the horizontal edge of any triangle pattern. It must be tested on several occasions. Here you can see it's tested 1, 2, 3, 4, 5 times. So this is a pretty well-placed resistance level. We're not going to argue too much about that. The second is the ability to set an uptrend line in this upward sloping triangle. Again, it uses basic trend line analysis. It has an anchor point as a starting point, followed by several retests that confirm that the placement of the line is correct. The third part of this absolute template is the base, side 3. And this is often missing from many triangle analysis that I see. A triangle has 3 sides, not 2. It has a base, and the base is created by between 2 to 5 days of price activity that's continuous in the same direction. In other words, all the candles are black, or most of the candles are black, or white, as the case may be. It's not a mixture. The important thing is that the base allows us to then project the target. So the base is measured, and that value is projected above the horizontal resistance line. It sets a target that has a high reliability. Most of the time, it's achieved when the breakout takes place. It may be achieved very rapidly. It may be achieved quite slowly as price moves up bit by bit. But generally, these targets, particularly in a bull market, are accurate about 80% of the time. In a developing bear market, they're less reliable. They're still there, but they're less reliable. But the fourth part, which we often miss, is that price activity in the belly, in the stomach of the pattern, as it were, on the inside of the pattern, must be fairly consistent. This would not be a triangle if all this price activity was down here and didn't actually retest this resistance level. We must see consistent activity within the belly of the pattern before we can accept the pattern as being 100% perfect template. Now, we'll come across patterns that don't quite make it. Okay, that's fair enough. But what it means is that patterns become slightly less reliable. If this pattern, for instance, here on this chart, had most of our price activity down here and only one touch at this, then I would say there's probably only a 70% chance of reaching its projected target, and we would structure the trade accordingly. But in this perfect pattern, this is where I want to be entering, as close to this trend line as possible, because it maximizes the return to the target and it reduces the amount of risk because my stop signal is generated very quickly. So the key point, loose definitions increase our risk. The tighter the definition for the chart pattern, the more useful it is. Remember that the important part of a chart pattern is it allows us to project a price target through a measured move. Therefore, that helps us to establish better entry points, high reliability targets, which reduces the risk in the trade and increases the reward. Make a point of recognizing these pattern templates. So here's another example, and you can hang your cup in shame on this. This is terrible. But again, it comes from a professional website. First of all, this is not a cup. It's a V-shaped recovery, and I'll show you in a minute. This is claimed to be a handle. It takes 7 months to form. It is not a handle. This is what it should look like. Oops, let's go back here. First of all, a cup has a rounded bottom. It is not a V-shaped situation as shown here. A cup does not develop over 17 months or 7 months on a rectangle basis. A handle is a short-term breakout that takes place at the end of a cup pattern. However, this still does give us some accurate results. So we've got it right, but for all of the wrong reasons. This is a log scale chart, by the way. It should be arithmetic, but nevertheless, we can look at it. First of all, what's important here? Here is a breakout level. This is actually a double top or a triple top. I class this a double top breakout pattern. That's very different from a cup and handle. And what happens in this pattern is we measure the distance from the bottom of this reversal to the top of that resistance level. And we take that value and we project it upwards to give us an upside target around $2.72. Now remember, this is a log chart. So this distance here is logarithmically scaled moving up. The projection line is meaningless as a cup pattern, but it is meaningful as a double top breakout pattern. This target's not a cup and handle pattern. It's a double top breakout target. And if it's a double top breakout target, then the consequences for future trend development are quite different than if it was a breakout from a cup and handle pattern. So what's a cup and handle pattern look like? This is what a cup and handle pattern looks like in a perfect template. First, the lip of the cup or the saucer is defined by resistance level. Often, this resistance level will also be confirmed historically, off to the left-hand side of the chart. Then we can define this subsequent price action here with a curved line. And the curved line captures the support as each of these price pullbacks develops. Again, it's important that we have substantial price activity in the belly of the pattern. It shows that it's an active pattern. A simple fall down here and not much of a rebound doesn't really help us. It's this activity within the pattern that gives us confidence that we can measure the depth of the pattern, base to the top, and project this upwards to get a target. This is a highly reliable target. There is a high probability that when this breakout takes place, it will achieve this target level. The danger is that it will reach this target level and then collapse quite rapidly and only trade a handful of shares or a handful of lots at that level. So when we're using a trading plan for this, we set our sell target just one tick below that target level. That will ensure that that order is filled completely before the price goes all the way through its target. Now, there are two additions to this pattern, which I haven't shown on this chart. First of all, if it is a cup pattern generally takes place, develops over anywhere between 2 to 3 weeks, sometimes a little longer. It's a short, sharp pattern. But a saucer pattern may develop over 2 to 3 months. It's a longer pattern. It has the same sorts of behaviors, but it develops over a longer period. So in our previous chart, the saucer pattern is supposed to have developed in this very sharp V-shaped recovery. And we can easily define that best with a downtrend line rather than with the cup. You can see that this semicircle does not in any way define this part of price activity here. The second factor is that sometimes you will get, particularly in a cup pattern, the development of a handle. Now, a handle is created not by moving sideways. A handle is a pullback. So it's defined by a downward sloping trend line and a parallel downward sloping trend line. And price activity takes place in that. Then the breakout above the handle moves towards the target level. In a handle pattern, what happens is we take this price projection calculation and we start from the point where price breaks above the upper edge of the handle. So that means that the upside target is a little bit lower. These are pretty reliable patterns. We use the saucer pattern, the extended pattern, for long-term strategic analysis. We use the cup pattern for short-term rebound trading. Well-defined targets, high reliability. When that happens, we're into the trade, and our preference, as this pattern develops through here, is to get in at around this stage, 3/4 of the way through the development of the pattern. The pattern's been confirmed by the time we reach this point here, so we can enter here. If you're more conservative, you'll wait for this point, and if you're very conservative, you'll wait for this point. The advantage of entering here, of course, is that you are capturing the full move from here up to the target level, and your risk is defined by a stop that is just below the level of the curve support line. It's always important to remember, particularly in these environments, the closer you can enter to your defined stop loss line, the lower the risk in the trade. That's because it doesn't have to fall very far before it violates your stop loss line and you get out of the trade. So the amount that you're putting at risk is much, much lower. Here's another example of poor chart analysis that doesn't give us the right sort of result. And it has two parts to it. First, here's the original incorrectly placed trend line. It has a single anchor point here and a second anchor point here. That's it, 2. This point here may or may not become an anchor point. At this stage, we don't know because we can't see whether it's moved above or reacted away. There is only one valid trend line on this chart, and that is the red line. Starting at the top, anchor point A, B, and C. What we've got is a breakout, then a retreat, and a retest of the lows. This creates a double bottom pattern. Double bottom pattern, we measure the depth of the pattern here, and we can project that above to set an upside target. But the initial breakout pattern is a retest of this double bottom pattern highs that were made at this level. So if we're going to enter this trade, what we're looking for is not a breakout above this level. We've already missed most of the opportunity. We're looking for the rebound that takes place from this double bottom with an entry around 125 with an upside target around 143. Not an entry point at 133 or 134. Proper, correct chart analysis provides us with high reliability targets, a better and more effective way to manage risk, and high reliability trade opportunities. It's worth taking the time. And the number of times that we see trend lines that are incorrectly placed is terrifying, because these are people who are risking money on incorrect analysis. So just a very brief revision before we move on. When you're looking at placing a trend line, you're starting with the peak. You're looking for at least 2 or 3 anchor points for the trend line. These anchor points are created by a rally and a retreat, a rally and a retreat. They are not created by a series of lines through here. You need a change in the price activity and then another change. That becomes your anchor point. When a breakout takes place, your anchor point is here. Your second anchor point is as price retreats and then rebounds, retreats and rebounds again. That gives you your third anchor point. You then use this line projected into the future in a rising trend. This becomes a support line. You are looking for price action to continue to move up and then to come back and bounce off that trend line to prove that it's a valid support level. or in a downtrend line for a price to rally to the trend line and then retreat away from it. Again, that proves that the resistance is validly placed. Trendline reversals tend to be a V-shaped reversal, but that reversal is not always a trend reversal. That's a key definition that's important in the current trading environment. We need to be able to distinguish if we are trading a rally or if we are trading a trend. We're trading a rally, we're using tight stops, we're taking a short-term trade, we're collecting profits, we're using a tight profit stop. In a trend, generally lasts for a lot longer, weeks or months. Once we're in the money, in other words, once our trade is making a profit, we can be a bit more relaxed about how we are going to get into or out of that particular trend. So the difference is important. This schematic is the best way. This is what we call the week rally. Here, we've got all of the touch points that allow us to plot an accurate trend line. But notice first, most of these touch points are created, the bulk of the candles in this move are red. They're down candles. So the low of the day, we opened about the same, rose a bit, but then pulled back. Another low of the day. Here we rose, that's no problems. Here we pulled back again, hitting this new low. So the bulk of this activity here is actually created by red candles, by falling candles rather than rising candles. That's a weak rally. I'm not even going to be interested in trading this type of environment where, although we're still going up, we're not going up particularly strongly. The predominance of down candles in that rally environment tells us that it's weak. And it doesn't matter for me how strong the volume behavior is. It's the behavior during the days that becomes important. It's showing us the weaknesses there. On a strong rally, in contrast, most of the days are up days. We still have the same number of touch points. We're still able to validly place a trend line, but most of the days are showing up day behavior. So there is more buying pressure that's driving this rise in price. Here in the weak rally, we still have buying pressure, but people are taking short-term profits as quickly as they can. That's what gives us the down days, the predominance of down days in the weaker rally. This is the type of environment that we're looking for in the current trading environment, where we have a stronger rally taking place, where it's mainly dominated by up days rather than down days. Trend is slightly different, and I have compressed this considerably. So what we're looking for with a trend, interesting from a rally, is a greater variety of days within that period. So some are up days that create the anchor points, some are down days, some are up days. There's a greater mixture that takes place throughout this behavior. It usually extends over a longer period. This may extend over 4 or 5, 6, 10 days, whereas this may be extended over 14, 15, 20, 30 days. Key difference, a rally is continuous behavior in one direction, whereas a trend change is a rally followed by a retreat, followed by a rally, followed by a retreat, rally, retreat, rally, retreat. Not just single candles. It's a bunch of candles that create the environment. Those differences are important because they will determine what we trade and how we trade. So what are the search parameters we're using in the current market? The ones that we are avoiding are any indicators that rely on a combination of moving averages in their calculation. We have to wait, like the snake that swallowed an animal, we have to wait for it to be fully digested. If you're using an environment that, an indicator that includes, for instance, a 60-day moving average, then the large fall that took place in March will take 60 days to work out of the system. Until then, it will continue to distort the calculation. And this can be changed a little bit or offset by using an exponential calculation or a weighted moving average, some other variations on a moving average calculation. But in the current environment, we are reluctant to place too much emphasis on any indicator that rests essentially on moving averages. That might be an RSI, might be a stochastic, Williams percentage R. All of those moving average based indicators are used with more caution in terms of their signals. In a falling market, for instance, then these will give consistently oversold signals even when the market begins to recover. Usually, we use a lot of RSI divergence signals, but not in the current environment. But just as a quick reminder, because these will become important as this develops. So we can, for these purposes, say, here's our initial fall, here's the dead cat bounce, here's the following fall, and here's the rise. Now, if we see this situation developing in the underlying index market, the Dow, for instance, fall, dead cat bounce, new low, and then recovery. Those lows are connected with the downtrend line, and the RSI shows a divergence pattern. In other words, higher lows. This is the strongest reversal signal, and we are buyers here, and we would be buyers as strongest and fast as we can possibly go. On the other hand, if the Dow did a dead cat bounce, came back and created a double bottom situation and then rebounded, and we had this divergence pattern in the RSI, it's a pretty strong signal. We'd be buying back into this area here on confirmation that the trend can continue. But if the Dow did this, dead cat bounce, lower high, and moves higher, but we had a double bottom in the RSI, we would be treating this with a great deal of caution. So as this market begins to develop in the longer term, and we apply this to a weekly chart, then these are the divergence patterns that we're looking for to determine where we go. Currently, these are our technical searches. We're waiting for the averages to wash out. So we're not doing searches based on averages. We're particularly looking for 5-day new highs, and we're looking for price and volume behavior. But the key is no volume means no trade. If there is no volume, you will be left stranded on the beach. You can get into the trade opportunity, but you can't get out because there's no volume there. So although this is where we are starting our work, we're particularly looking for 5-day new highs, volume becomes a key decider. In the past, this is not quite so important, but in this environment, this is absolutely critical. If there is no volume, then there is no trade. If you want to buy 10 lots and the average trading size is 2 lots, walk away. If your average trading size is $10,000, but that would take 2 days to be able to expend that amount because the trade volume is so small, walk away. Because on the other side of the trade, when it comes time for you to get out, it's going to take you 2 days or 3 days or 4 days to get out. You won't be able to get out at your preferred price. So technical searches are important, but volume becomes the primary screening activity. The other thing that we're looking for is chart patterns. In this environment, chart patterns and strong, clear, well-defined trend breakouts are the key to trading opportunities. The opportunity must be clear. It must be obvious. It must be so obvious that it's unavoidable. In a good, strong bull market, you can trade and say, hey, it looks pretty close. It's almost there. The pattern's about 50% and get away with it. In this market, you can't. The danger is that instead of going up 300 points tomorrow, the market will fall 300 points tomorrow. And at this stage, we can't tell exactly what's going to happen. We go back to my earlier comments. We want to believe, but there's a whole lot of fundamental information that suggests that bullish sentiment may be misplaced. We also trade looking for specific relationships, and we apply this particularly in foreign currency and commodity markets. What we're looking for here, and I've explained this in more detail in some other locations, so we'll move over this fairly quickly. We're looking for the 5-day average range of price. That's a simple arithmetical calculation. So for instance, if the range of price between the high and the low is as set with these figures here, then the 5-day range is simply divided, those figures divided by 5, it gives us 100 points or 100 pips. So what that means, and we use the ANTS light trading method here, what that means is that there is an 85% probability that on the next trading day, that currency pair will reach 75% of its 5-day average range. In other words, if GBP NZD was showing a 5-day average range of 100 pips, then tomorrow there's an 85% probability it will move by 75 pips. That's a pretty high reliability. And we've used this method for 5 or 6 years and found it to be consistently reliable. Now, of course, how you decide whether GBP NZD is going to go up or down is another set of questions, and we apply a technical analysis to that. But we will look for the specific relationships in this environment and go for those opportunities to have the highest 5-day average range, and then analyze them at the next level to be able to determine whether they are moving up or down. So just to revise, strategically, we're looking for this dead cat bounce to develop, for multiple bottoms to develop in the indexes. Then we're looking for RSI divergence patterns for confirmation of those changes. We're not using indicators that rest heavily on averages at this stage. Oops, I'm going back the wrong way, my apologies. Our technical searches are based on looking for new 5-day highs and price and volume moves. If there's no volume, then there's no trade. We're also looking particularly for chart patterns properly defined, because those chart patterns give us highly reliable upside targets and allow us to manage risk and risk exposure in an exact and precise way. And then in some commodities, in foreign currency trading, commodity trading, and index trading, we're looking for specific relationships, the 5-day average range approach that will give us high probability targets on a 1 to 2 day basis. In other words, in this environment, we've reduced the amount of time in the market, and that in turn reduces the risk. So, analysis filters. Just looking at my time again. 1:44. Analysis filters. The important thing to remember is that the intensity of selection narrows down. What we're looking for, we start off looking at a whole lot of stocks and we narrow that list down. But the intensity of our analysis increases in inverse proportion. So I want to spend a lot of time looking at just 1 or 2 stocks. I don't want to spend a lot of time analyzing a whole lot of stocks. So the intensity of selection, we start with a whole lot and move it down to a small number of potential trading opportunities. The intensity of our analysis expands across those smaller number of opportunities. It's an inverse relationship. And once we've decided the 1 or 2 stocks we're interested in trading, then we can either execute directly or we can execute via a derivative, which will maximize the returns. And we use people like Go Markets to be able to do that because they give us that execution strategy, speed of execution, reliability of execution within that derivative market. So in summary, there are 3 essential tools that we use in the current market environment. The first is a straight horizontal line. That will allow us to identify support levels and resistance levels. Do that correctly, and you've got the beginning of what you can do with pattern analysis. The same, of course, applies to a downward sloping trend line or an upward sloping trend line. Accurate placement of trend lines is absolutely essential for all of your charting activity. If the trend line is inaccurately placed, then you're wasting your time and you're wasting your money. The third essential tool is the ability to set price projection targets. Define your chart patterns accurately and correctly. Once you've established your base pattern in a triangle, the depth of pattern in a cup and handle pattern, then you can take that value, project it upwards. It becomes a defined market move. High reliability. That's the type of pattern environment that we're looking for. Now, just excuse for a minute because I've lost track of time. I just need to type something in. Otherwise, oh, that's a very bad timing. If Hunter can just give me a heads up, then that'd be handy.
I have translated that first message you sent. And you may finish, Daryl, when you finish. You probably have about 5 to 10 minutes left.
That's right, though. I thought I had 10. I just thought I would reconfirm on that. Okay,
No worries.
so moving forward, and we need to go back to here, through to there. So what I'm looking for particularly is volatility on the entry and the stop. That's the key measure. Once I've identified the trading opportunity and I've come down to the entry point, I want a volatility measure to be able to confirm that my entry point is correct. And for that, I use the countback line. Now, we have covered the countback line a number of times in previous presentations, but I know we have new people in place. So we'll go through it very quickly. What we're doing with the countback line is we take the current lowest low in a downtrend. We move to the top of the current candle, move across to the left to the next highest candle, and move across to the left to the next highest candle. Now we ignore any candles that are lower or any candles that are of an equal high. This gives us a countback line. It tells us that price needs to move above this line, to close above this line, before an entry signal is generated. As the trend continues to fall, for instance, if we ignore all of this previous point, this point here is the lowest part of that trend. We would move to the top of that line, cross to the left to the next lowest, to the next highest, to the next highest, and there would be our countback line. So the countback line continues to fall as the market declines. What we're looking for on a rebound is for price to close above that countback line level. That gives us our entry signal for the next day. It also gives us the way to calculate our stop loss. So what we do is we take the highest high in that newly emerging uptrend, come to the bottom of that candle, cross to the left, to the bottom of that candle, cross to the left, to the bottom of the candle again, and this becomes our stop loss line. So price, we hope to enter here. It can in fact fall back as low as this level and then rebound before we need to close the trade. It is a self-adjusting volatility stop. So the higher, the broader the range or the lower the range will have a direct and immediate impact on the placement of this trailing stop. It's unlike other systems that rely on a moving average calculation. And remember, we said a little bit earlier that moving averages need to be absorbed by the system. These large price gaps and price moves that have taken place in the last couple of weeks need to be fully absorbed in any moving average calculation before we can reliably trust them. This stop loss calculation relies purely on the most recent price activity of the significant days. In a rising trend, it's those days that have continued to move higher. That's what becomes significant. In a falling trend, those trades that make new lows are the significant days. Shortest time period for the calculation is 3. Sometimes the calculation may last for 4 or 5 days before you get a new moving upwards. These are fully explained in my books, Guppy Trading, Share Trading, Better Trading, etc. In a rising trend, on the long side, we reverse the procedure. So for instance here, if this was the highest high to that date in the trend, we'd take that, move to the bottom of the candle, across to the left to the next lowest candle, the bottom of that, across to the left to the third lowest candle. This would be our trailing stop. In this example, this is the highest day in the current trend. To the bottom of the candle, cross to the left to the next candle, cross to the left to the next candle. We are ignoring a candle of an equal low. This is the next lowest candle. Here's our stop loss. So if there is a close below this level tomorrow, then we are out of the trade on the following day. This is an end of day exit signal. It's not an intraday signal. You can use it on an intraday basis, but we find it more reliable on an end of day basis. So what we're doing, just a very quick recap, we are looking at price and volume. We're looking for chart patterns. We're looking for specific relationships. We are doing most of our analysis on just a few stocks. We start our selection with a broad exploration, and Metastock is really, really good for doing that, to narrow down a small number of stocks. And on the small number of stocks, that's where we focus the intensity of our analysis. We either directly execute, which means buying the underlying share, or we execute using a derivative to be able to take advantage of the leverage. The only tools that we are essentially using are a trend line, support resistance levels, and target projections based on accurate identification of chart patterns. When we actually make the entry situation, what we're looking for is a volatility-based stop loss that is self-adjusting. That tells us when it's best to enter. Now, we always have to decide whether we are going to accept weight of evidence or confirmation. Those of you who accept weight of evidence will look at this display of clocks here and say the weight of evidence is that the correct time is 10:12. And that's the correct time because most of the clocks show 10:12. If you're looking for confirmation of evidence, then we would say the correct time is 10:08. And that's because 10:08 is seen by this digital clock here, and this old-fashioned mechanical clock is also showing 10:08. So the same thing, time, is being measured by two very different methods and reaching the same conclusion. Weight of evidence says it must be 10:12 because all of these clocks are showing that value. The problem is that all of those clocks are measuring time in the same way. They're measuring it digitally rather than digital and mechanical. Choice is up to you. Most people use weight of evidence. Our preference is to use confirmation of evidence. And when we're using confirmation of evidence, we will use a Guppy multiple moving average solution. Two groups of moving averages here. Short term, 3, 5, 8, 10, 12, and 15 exponential moving averages. Long term, 30, 35, 40, 45, 50, and 60 exponential moving averages. This creates a window of opportunity where these two groups of moving averages compress and cross over. Very aggressive traders will enter in this area here in anticipation of the breakout rally and trend continuation. Conservative traders will enter here. They tend to be investors and they are anticipating a continuation of the long-term uptrend. We're not applying GMMA analysis particularly at this point in time because we're not relying on any indicator that uses moving averages. We are really focused in the current environment on this volatility analysis, price moves, short-term rallies rather than long-term trends. And finally, like it or not, a lot of us are going to be involved in recovery trading. And the important thing is to make sure that the recovery trade is not a revenge trade. You can recover. You may be holding a stock that you bought at 56 cents, for instance. A revenge trade is where you take an entry back here at 25 cents. In other words, this downtrend has been broken. You're taking it at 25 cents. The revenge trade says I've got to get back to here or break even. So my revenge break even is at 35 cents. But it'd be nice to make just a little bit of money. So therefore, my sell target is going to be at 38 cents. That'll give me a 10% return. So I spent $10,000 at 56. I'll spend another $10,000 at 25. So I've spent 20,000 altogether. So if I get to break even to 35, yep, I can get out of the trade and have some face left. Or I can just aim for 10%. It's not very much, 10% in the current environment. Yeah, we can do that. So I'll get out of 38. That's the plan. That's revenge trading. Because the revenge trading is based on where you need to get back to break even plus a small profit. That, and this is a real example, by the way, is a fast track to disaster. Here, we entered at this level. It didn't reach our break-even target, but the trader will typically hold on, and he will hold on because he has no stop-loss discipline. If he had stop-loss discipline, he would have got out up here somewhere. He didn't. The fact that he held on means that he hasn't got stop-loss discipline, and he's unlikely to develop it quickly. So when price begins to fall back from here, he will hold on, and he'll forget about it, and he won't talk about it, and he'll ignore it. And he'll hope and hope that it goes away, and he very rarely looks at it, and eventually it's trading at 6 cents. Takes a couple of years to get there. So he spent $20,000, and as you can see, he's lost about $16,000 overall. Revenge trading takes this breakout and trades it to break even or higher. Recovery trading takes this breakout and exits here. Recovery trading doesn't attempt to put this new trade in the context of the first trade. Recovery trading uses the same stock, but treats this entirely as a new trade on its merits, trades to here, gets out at this level, because that's the technical signal that we're telling to get out. It may be a moving average crossover. It may be a countback line exit. It may be a trend line exit. Doesn't matter what methods used. The difference between revenge and recovery. Revenge takes these two trades together and says, this is the break even and that's my target. A recovery trade says, this is an entry situation from a downtrend, and I will trade this until I get an exit signal, and that trade will stand by itself. It makes no difference whether I reach break even or not. My objective is to treat this as a new trade to make a new amount of profit. And if that gives me a break even result, that's good. If it gives me extra money, that's also good. But that's not the purpose of the second trade. That's the important point. The revenge trade is based on getting back to break even by averaging down. The recovery trade says this is a trade that stands by itself and I'll get out irrespective of whether it reaches break even targets. And later on, I might take this recovery trade here or another one down here. This one moving from 5 cents to 10 cents. There's 100% return. You can build your recovery very quickly. So that's where I'll finish. Bonus offer sitting there. I think you've got that details in your trading notes. We'll give you 1 month free access to our weekly newsletter, which is usually around 16 to 22 pages. We look at trading techniques and methodologies that work in the current environment, and we use real-time case study trades. We'll give you free access to our FX market notes. They are the notes that allow us to achieve an 85% success rate, and an ETF trading guide with some tested methods for increasing returns in that environment. We often choose to execute our trades via derivatives, and we use Go Markets for that because they give us highly reliable, effective trading results. And that's been proved by a number of surveys taking place within the investment literature as well. Thank you for your time and attention. I'm sorry for going 1 minute over time there, but hopefully you're back on schedule.
Thank you so much, Daryl. Again, it's always a pleasure. I remember the first time I saw you speak live. It was in Sydney, Australia, for I think it was an IFTA conference or something of that nature. And I said, I want that man to narrate my life. I want him to say, well, it was late and Hunter was thirsty and he went to the refrigerator to get orange juice, except the way you say it. It would be great. Thank you so much, though.
No problem. Thank you.
What wonderful, wonderful offer. I will be putting that in the handouts for this presentation. Daryl, thanks again so much. You have a wonderful afternoon, I believe it is there. That
is correct.
Wonderful. All right, thank you.
I think it's good night for you as it is from your end.
It is. It is. It's going to be a wonderful one as well. All right, thanks, mate. So let's see here. Let me share back to my screen. Give me just a moment. I want to throw this PDF in the file share for you guys. That should be available in your handouts as we speak. Now, to kind of get us back on course, I have a little bit of time to cover some of the new features that are in Metastock. Let's see here. Now, I've covered the bonus offer a couple of times. I'll cover that once again after I'm done presenting. So here's me. I'm wearing the same shirt and everything. A little bit of a different hairdo because, you know, quarantine, we can't really get haircuts right now. I've been with Metastock for about 6 years now, and one of the things that I love the most about Metastock primarily is just due to the fact that it's a tool that allows people to get into workflows really, really easily. A workflow is especially important in this industry. I can't overstate that enough. A workflow is always going to be the most important because we're in an industry right now that, well, you know, has always been an industry that has a ton of variables, 1,000 variables. A stock can go up to $1,000, it can go down to $0. So the idea behind a workflow is being able to get up and do the exact same thing every single morning to limit the amount of variables that are in your life. And that's what Metastock really allows you to do. Now, Metastock 17, I know there are a lot of you out there in the audience right now that have been with Metastock for a very, very long time. Metastock 17 is incredibly unique. And the reason I say that is 17 it's something where we've thrown in so many new tools that completely change your workflow for the better. It's probably our best release since I've worked with the company. We've added a few new things. I'll show you a couple of things here within the time that we have. We've added in Quote Center. We've added in, which is a new power tool. Another new power tool is Option Scope for those of you that are options traders out there. We've added things in like the legacy file format in our new downloader. We automatically update our symbol database now for you. We have the ability to turn on pre and post market data. There are a bunch of usability features, just kind of general quality of life features that we've added in. We've added in some new systems as we always do. I'm not a huge PowerPoint guy, to be honest with you, so I really just want to jump into Metastock here, and I'm going to show you kind of what my workflow is like in the time that I have here. So first and foremost, when you open up Metastock, as you all can see there, just want to make sure you can see that. This is our Power Console. Now the Power Console is where you're going to start your day, essentially. Okay. Now, Daryl hit on something that was really, really important for me, and it was a perfect segue into kind of the topic of my talk. He put the two triangles up there, and basically, pardon me, was saying I want to spend a lot of time doing analysis on very, very few stocks. So I don't want to spend a ton of time doing analysis on a bunch of stocks. What I want to do is I want to do a bunch of analysis on a small number of stocks. And inherently, that's what we all want to do. And for example, if I want to trade the S&P 500, I am not going to open up 505 charts. It's ridiculous. You know, it takes far too much time. So the first step when the market opens, the first thing that I am going to do is I'm going to run a scan. That's how I start my morning. Now, our exploration tool is incredibly intuitive. It works very, very well. And the simplest way to explain it is if I want to look at the S&P 500, I have certain criteria, certain things that I look for with my trading opportunities. I want to be able to essentially input those or select those, and I want to scan across entire markets, the S&P 500 or all optionable stocks or SGX or ASX, wherever you are. Metastock covers all markets. I want to be able to scan across those markets and only find the stocks that return with the same value, or the value I'm looking for. So let's say, for example, I have a scan where I call it a pre-filter scan. If you're using Metastock, in my personal belief, I think you should always have a pre-filter scan. It can be volume-based, it can be price-based. For example, in this example, I'm looking for stocks that are under $100. If you ever have questions on how to write these pre-filter scans, they're super, super easy. You can come into Metastock support chat and they can assist you, or our formula team is very good as well. But I want to weed out, number one, all the stocks that are over $100. Okay, so I've selected my under $100 search. I've also selected the MACD expert system. Now the MACD is, I'm just using a very, very basic example. As you can see, there are quite a few systems that come with Metastock. There are a ton of different signals that you can actually search for. I'm scrolling through a few of them right now. I have about 220. I believe Metastock comes with about 200 right off the bat. Different things that you can search for. I'm using the MACD expert system because it's something that most of you in the audience are going to be familiar with. It's a very basic system, and if I hover over it, it's going to give me the explanation of what it is. It's going to show me MACD buy and sell signals and overbought and oversold conditions based off of the classic MACD definition. Now I have two explorations that are selected. The next thing I'm going to do is come down to this window and I am going to select the market. Now in this specific example, I'm going to be using local data, basically our data that I have downloaded for the S&P 500. A little bit of a tip for you. If you're using Metastock and you want to run really large explorations, or if you want to run large system tests, feel free to just download the data, because it runs a little bit faster, just kind of depending on your internet connection and where you're at, etc. So right now, I have the S&P 500 selected. Over to my right, this is essentially showing me I'm outlining how I'm exploring. So right now, I have used the results from the preceding exploration selected. So currently I'm running this as what I call kind of a drip system. I'm going to take the stocks that are under $100 and I'm going to run that scan across the S&P 500 first. I'm going to take the results from that exploration and I'm going to run it through the MACD expert system to identify stocks that have a buy or sell signal or overbought or oversold condition. Okay, what I'm doing is I'm creating that funnel of possible trade opportunities. Okay. So I can change the order of this. If I want to run the MACD first, I just select either one of them and use the arrows on the right side, but I actually want to run that first. If you select this second bubble here, the use the selected instruments for all explorations, it will run that exploration twice against the same, so it'll run the S&P against the under $100 filter, and as well as the same 500 instruments on the MACD expert system. But since I'm creating a funnel here, I want to take 505 stocks and I want to whittle it down to maybe 20 trading opportunities. So I'm going to go ahead and run this exploration. Moving pretty fast here, as you can see. We have a little bit of a status bar basically, so it's running through this first exploration. It's rejected 41%, so it's going to take that 59% and run it through, and we're actually done. So if I come down here and click on the MACD expert system, it's going to give me a couple of different categories here. Now, what I've done is I've taken the 294 results, that 294 stocks that are under $100. And it took those 294 and it ran it through the MACD expert system, and we came out with 80 results. Now those 80 results are going to range from MACD buy signals when the moving average crosses above its signal line, MACD sell signals, which in all honesty right now is going to be the majority, if not all, of these, just due to the fact that the current market climate, you know, we've been struggling a bit, as I'm sure you know out there. Most of them are going to be sell signals. We have overbought and oversold conditions as well. But if I want to isolate one or the other, all I have to do is double click on the column that I want. So if I want overbought stocks, I just double click and it brings all the overbought stocks to the top. The way that you can tell that is a 1 means it met that condition or it's true. A 0 means it didn't meet that condition or it's false. See how many buy signals we had. No buy signals. No buy signals. So it's been a rough market. We have all sell signals here. But I tell you what the next step in my workflow is, and this is actually using a brand new tool, a brand new power tool that's in Metastock called Quote Center. So what I'm going to do is I'm actually just going to click this button that says Open All Instruments in Quote Center. Okay. Now, just to take you through this, what this does is it opens up a completely different window that you can use as essentially a quote screen. Okay. Now, this is also a very good tool to manage your custom lists, and I'll get into that here in just a second. Because I'm using local data, you'll see that this part is filled out. It's going to say local path or source, and that's where you stored your local data. But the important columns here are going to be our last, are going to be our high, our low, open, volume, open interest, which is available as well, net change, and percentage change. So you have kind of the nitty gritty on these stocks. And essentially what I'm going to do is I can actually sort this by volume and put the largest volume stocks at the top. I believe I actually double click that. There we go. So AT&T, for example, had the highest volume. So I'm actually going to take a few of these and I can go ahead, I can do a couple of things. Number one, I can just double click on it and it's going to open up the chart behind me right there. Now, you're going to notice actually all of these stocks, pretty much all of them had a pretty good day. The market, I believe the Dow closed maybe 700 points up. So that's probably the reason that we're seeing all these stocks recover a little bit, is because the market had a really nice jump today. But what I'm going to do is I can actually select the ones that I want to have in a custom list, and I can save that custom list. Okay, so let's say that I'm going to go ahead and select, let's see, all of these. And I am going to, actually I can do a couple of things. So first off, I can open all of these at once if I want, or I can go ahead and delete the ones I don't want. So I'm going to come down here and let's say that I only wanted the top 5 that had you know, high volume. Okay, So I'm going to come down to the bottom after I've selected those. I'm going to notice that nothing else is selected. Actually, I have to do it this way. So I'm going to select the 6th stock, and then I scroll down to the bottom, and I'm going to select the last stock. Just by shift clicking, I'm going to delete the selected instruments, and now I have a list of 5 of the top volume stocks. Now I can come in here and I can name this something. This is based off of a, let's see, this is based off of an exploration. So automatically it's going to say that it's the MACD expert system because it's the exploration that we ran. But now this allows us to build these custom lists or watch list, if you will. Now, once I have these watch lists, go ahead and hit yes. Now, once I have these watch lists, here is a good example. In my chart tab, I'm going to have all of my watch lists. I can actually select one of my watch lists, and if I'm in the quote center tab, rather, I can select my watch lists, and to the right here, you're going to see everything that is in that watch list. From here, I can come in and actually add instruments if I want. I can take them away, but all I have to do is hit Open Quote Center. So in the morning, if I have this watch list of an exploration that I did the day before, I just open it in Quote Center, and it's going to pop over there for me. Okay. Now, just looking at the time here, there is something I did want to show you guys, because the first step for me is always going to be to run an exploration in the morning or in the afternoon, sometimes both. And I'm going to create lists off of that, and I'm going to create those watch lists. But I'm a type of trader that really believes that to be successful, that I have to be malleable with the market. I think that every market's a little bit different. Every sector is a little different. Every stock has its own kind of attitude. It has its own kind of behavioral pattern. And as technical analysts, it's our job to figure out what that pattern means. So what I want to do is I want to find the system, find out, number one, if my system works very, very well with the stocks I'm trying to trade. Number two, if there are other systems that work very, very well with the stocks I'm looking to trade. Okay, so let's run a system test. Okay, now a system test is, in my opinion, probably the second most important tool within Metastock, first being the exploration. You know, again, you're going to see the disclaimers at the beginning of most webinars. That's going to say something to the effect of past performance is no indication of future profits. Okay. We said it at the start of this one, but that's really our job as technical analysts. We're looking at signs of the past to see if that type of behavior will repeat, so that we can make a judgment call on what's going to happen in the future. The best way to do that is to run this analysis historically and see how the stocks have behaved. So if I want to come in here and I want to run a system test, so I want to find out, let's say, the MACD. I trade the MACD consistently, let's say. Personally, I don't that much because it's definitely a lagging indicator. However, let's say that you're a trader that believes the MACD is the best trading system in the world, and that's what you want to use. What I want to do is I want to test the MACD over the S&P 500 and find out which stocks historically have performed the best if I were to be trading the MACD on them. Now, I've selected the MACD expert system. I have selected, again, local data. I've selected the S&P 500. Now, on the right side of the screen, this is where you're going to start identifying what type of trader you are. Okay, do you take only long trades? Do you take just short trades? Or do you take both? So I can select that at the very top. I'm going to leave it at both. Records. There are a couple of different ways you can identify how long you're running this test over. 250 daily records is going to be about 1 trading year. So typically I test over the past year. You can test as far back as the stock goes if you wish. But for this presentation, I'm only testing over the course of the last year. You can also choose from an exchange date and time as well. The next thing I'm going to do is I'm going to come in here and I'm going to select trade options. This is going to identify what my trading account is like, what my risk is like. This is kind of profiling me as a trader. So I'm going to come over to account. I'm going to be honest, okay? I'm going to be honest when I put in my account numbers here, because if I put in here that I'm trading with $1 million and I'm not actually trading with $1 million, the test is going to be skewed and it's going to be off. If I'm running a system test, I want it to be as real life as humanly possible. So let's say I'm trading with $10,000 in an account. My right here, the default size is going to mean what my risk is every single time I trade. Now I have a couple of different options here. I can trade a number of units, so I trade 1,000 lots every time I trade, or I base it off a transaction cost. I trade $1,000 every single time. The most commonly used, I think, and the one that I definitely use the most, is percentage of available equity. And the reason for that is because if it's a 12-month simulation and 2 months into that, simulation, my trading account has grown by $2,000. That means that now I'm trading with $12,000 instead of just $10,000, and it will trade a percentage. In this case, it's 20% of that $12,000 instead of 10. So it adapts throughout the entire simulation. The next tab over is brokerage fees. I want to account for my overhead, because if I'm trading a system a whole lot, and let's say it's $6 to place a trade, $6 in and out of a trade, okay? That's overhead for my business. And if I'm trading a system a lot, that means I'm going to have a lot of an overhead. So this is where I'm going to account for my brokerage fees, unless you have a free brokerage, which there are a few of them out there right now. Robinhood is one. Don't get me started on them. When the market crashed, so did their website, and it cost a few of us a few dollars. So we set up the parameters, kind of the trading profile of how we trade. Now I'm just going to start this system test. So again, we're looking at the MACD. We're looking at the MACD over the course of the last year and how it's performed across the S&P 500. Now we have this little box right here at the bottom. This is going to give us kind of an update. It's going to give us the best performing stock so far has been $1,400 the last, and it's going to give us, more importantly, how far we are into this simulation. Now I'm going to run 2 simulations. I'm going to run this one to start with, and I'm going to run a second one that's going to be very important. And I encourage all of you that have Metastock or will get Metastock this evening or afternoon your time, I want all of you to do this. So we're just wrapping up here. Typically this takes about a minute to run a 1-year simulation with local data. Now I can go off and I can do other things while the simulation is running. And now I'll run these system tests across all optionable stocks, and it takes significantly longer because it's so much more data. So you can actually go in there and you can do other explorations and things of that nature. So let's take a look here. We finalized. Here is the exploration report. You can kind of guesstimate by looking at this. Green means it profited. Red means it did not profit. I look at a couple of things on this report. The first column that I look at is net profit, and I want to sort my stocks by net profit. Profit's why we're in this, so that's what I want to look at first. So I double click on net profit, and that's going to bring out my most profitable stocks using the MACD. And the second thing that I look at here is number of trades. This is how many times I had to trade to make the profit that is shown in the percent gain or the net profit. So Perigo, I traded 25 times over the course of the last year, and I made $1,700. Okay, now I can drill down into this a little bit more, just by double clicking on it. Now there's a bunch of stuff on this screen that you can use. I use a few data points here. I look at the trade summary. I look at how many long trades versus short trades. I'm going to look at buy and hold profit versus actual trading profit. So for example, my buy and hold profit means if I were to buy this stock a year ago and just held it over the course of the last year, I would have made $128. Versus actively trading this stock using the MACD system, I would have made $1,700. So this is obviously a little bit more of a volatile stock. Sometimes these numbers are inverse. Sometimes I would have made a whole heck of a lot of money, more money, actually just buying and holding. That I can do with that information. What I can put that in my long-term portfolio. Just kind of depends. The main thing, and I know I'm cruising through this pretty fast, but I only have a few minutes left. The main thing I want to look at is my equity curve. So I look at my summary, and then I come over here and I look at my equity curve. And the reason I do this is because it is the most visual representation of what my account did trading that stock with the MACD system over the course of the last year. To point out a couple of things here, the main reason I look at it is I profited very well for about 100 days, and then I've pretty much flatlined for, it looks like, about 115 days, okay? It went through a cycle where it basically did not profit at all on that stock. I made half of my money in the first 100 days, and then I didn't make anything for a very long time. That's information I can take into consideration. Different market climates at the time, what did the company go through at that time, etc. But take a look at 215 days in to 250. So we're a month and a half or so. The last month and a half, I've started to profit very significantly. So while this stock has profited, it hasn't been consistent over the course of the last year. Now, if I go back and look at a different stock here, let's look at Capri Holding. Now, this is another good example of a stock that, hey, I profited. Let's take a look. I profited $1,400 actively trading this system, but look at the roller coaster that I've ridden in the meantime doing it. It's not really something I don't want to manage that. I don't want to have to deal with managing that type of trading history. That would drive me through a wall. You know, you don't make anything for 190 days, and then you start profiting, and then you lose 3/4 of it, and then you're up, then you're down. It's not consistent. So I can rule those out as consistent performers. Now, the last thing that I want to show you guys, I told you I was going to run 2 simulations. I actually already ran one a little bit earlier because these take a little bit longer to run. I ran a simulation. Let's find the correct one here. Should be this one. I ran a simulation where I took about 15 stocks, 15 to 18 different systems, and I ran it across the entire S&P 500. Now, why would you do that? Some people may ask. Well, again, I believe that traders should be malleable. I believe that you should always be looking at market conditions, adding and taking things away from your trading system that work for you. So in this scenario, I ran, again, it was about, let's take a look exactly. I ran 17 of the different systems that are in Metastock, and I ran them against the S&P 500. All the other parameters were the same. I ran it over a year, same trading account, long and short opportunities, same brokerage fees. Everything was the same as the last simulation that we looked at. Now, in this case, I'm looking for a system that performs consistently and profitably over the entire index. So I want to find things that work across a broad index. So instead of looking at best profit, I'm actually going to look at average net profit. So I'm going to double click on average net profit. That's going to sort all of my my systems in the ones that were most profitable at the very, very top. The winner of the systems that I chose ACT, which is Adaptive Cycle Toolkit, which is in Metastock 17. It comes with Metastock 17. That had an average profit across the entire S&P 500 of $214. So it did well across the board. I double click on it, and now we're looking at the report that we're kind of used to. Okay, it's going to break down how profitable each and every single stock in the S&P 500 was. So in this case, PVH, I traded 14 times. I made $2,300. Let's see what the equity curve looks like here. And again, consistent, slow profits, consistent, but lately it's been very, very profitable. Now, you don't just have to run 17 system tests across the S&P 500. You could do all of the system tests available in Metastock 17 across all optionable stocks and find the best system that works for you. Okay. Now, once I have these stocks, let's say that you know, I have a stock here that I want to take a look at, I can open that stock through Metastock and apply my expert advisor, and there's a few things that I can do from there. Now, I'm having to cut this presentation short a little bit just due to the fact, out of respect to the rest of our speakers, I want them to be able to start on time. But we have a lot of different tools available. This is maybe 60% of my actual workflow in Metastock. There are a lot of other ones, and we have a walkthrough of our complete workflows on our YouTube channel, which is youtube.com/Metastock. So definitely check that out. Now, Metastock 17, again, is incredibly powerful. It's my most favorite upgrade that we've done so far because of primarily Quote Center and Option Scope, which for options traders, you have the ability to go through and view options contracts and do basically filter through options contracts, etc. It's an amazing tool, plus all the other things that we've added in. We've added in some usability features, etc. So if you have questions on what Metastock 17 can do, right now, open up a separate window on your browser, go to metastock.com/sales chat, and we have reps in there that are more than happy to explain some of these features a little bit more in depth than what I have time for this evening or afternoon, wherever you are. So Metastock 17 is amazing. Back to the Summit bundle that we are doing that includes Metastock 17. We have the Chart Pattern Engine by Ed Downs, which is our newest add-on, and it's been incredibly popular, primarily, I think, because of the fact that it is based off of his artificial intelligence engine that works incredibly well. That's the AI, which is a completely different add-on that we have as well. But his Chart Pattern Engine, which you're going to be seeing here shortly, comes again with 13 explorations, an expert advisor. Normally it retails at $14.95. We're going to put that in a bundle with our next speaker's add-on, Stuart McPhee's Trade Launch Systems. It comes with 4 systems, expert advisors, explorations, indicators. One of the expert advisors actually allows you to input your account size, much like we were just doing in the system test. It puts in your account size, or you input your account size, your risk, basically how much you're risking every single time you trade. And then his expert advisor is going to walk you through the trade opportunities. We also just did a 5-module course with Stuart, and it spanned about 6 hours. He covered a ton of different trading methodologies, a couple of which he'll probably touch on next. Now, normally this class retails at $7.99. The add-on itself retails at $4.99. Metastock 17 also retails at $4.99. So typically all of these things together to get these complete trading systems, as well as all the new tools in Metastock, it's going to run you about $3,300. Because you're attending the summit, we want to reward you, say thanks, and we also want to give you some of the best add-ons and best trading tools that we have available at our fingertips. So the bundle price for attending is $19.97. So it's going to save you a little under $1,500. And again, that's going to come with Metastock DC 17. It's going to come with a month of data link data for free. It's going to come with the chart pattern engine. It's going to come with our next speakers, Stuart McPhee's trade launch systems, the add-on, as well as the 6 hours of training that he just finished up. It's going to come up with our ebook, Unleash the Power of Metastock, which typically is $99, but it's a wonderful walk-through training, essentially, of everything involved in Metastock 17. Throw that in for free. Also, our white glove service. Big shout out to our support team. You guys are our backbone. It's amazing. All of our clients love you guys. You've done so well with this white glove. Basically, if you don't know what the white glove service is, our tech support will actually call you up and download Metastock 17 for you and walk you right through it and kind of give you an overview of how everything works. It's crazy. No one else in the industry does this stuff. So really excited about that. Whew, deep breath, deep breath. On to our next speaker, guys. I won't put you through any more of my ramblings. We have a very good speaker. I was just talking a little bit about some of the tools that Stuart provides. The training that he just did, the 5-module training, everyone that attended really, really loved it. It was, like I said, it was about 6 hours long. We did it over the course of about 5 weeks, I think it was. He covered some amazing things. I hope he's going to be dropping some of that wisdom on us this evening. Stuart, we've been working with for a very, very long time. He is a private trader. He's a best-selling author of Trading in a Nutshell, which is in its 4th iteration. I got this wrong last time. Hope I didn't get it wrong this time. Travels all over the world and does these live events in Singapore and Hong Kong. He's done live events for us in the US. Stuart, can you hear me okay?
Yes, I can. Yes.
Wonderful. I've been talking really fast. I had a Red Bull because it's about 11 p.m. This evening, my time. So I'm going to take a deep breath. I'm going to let you have the reins. Let's see here. Let me make you a presenter. How's everything going for you this morning, Stuart?
Into the afternoon, all good. Looking forward to this session. Let me just
Wonderful.
set up there.
I see your screen. Looks great.
Okay, good. And I'll turn my webcam on.
Wonderful.
See if that works.
Yep, we can see you. We can see you just fine.
Okay. Very good. Good afternoon, everyone. Maybe a few people more west of me. Maybe it's still morning, just before lunch. Great to have your company. Thank you very much for spending some time with me. It's great to be in. I always appreciate Metastock inviting me to attend their events. As Hunter said, I have spoken at a number of events in Sydney on multiple occasions. I've been to the US and spoken at their conferences. And only 2 months ago, I was in fact in Singapore, a country I love traveling to, and have been over 100 times and spent a lot of time in Singapore. And I was only there speaking at the Metastock conference about 2 months ago, which so happened to be from my hotel room because we weren't holding any live events, or certainly Singapore didn't want you doing that. So great to be here now. I'm going to spend the next 40 minutes or so just going through, I guess, this topic, top 10 trading habits of professional traders. Hunter just mentioned the education course that we just finished up, and I was really very pleased with the final result. At the end, in fact, we just finished recording the final module on Thursday morning, which was in fact all about my add-on. I'm not going to mention my add-on much at all today. You might see pieces of it when I go through Metastock today and show you a few things, but I was really pleased to present that particular module because I actually never really talk about my add-on. I never really promote it that much. I don't spend much time talking about it. They're all the systems that I've worked on over the years, and it actually made me feel pretty good to be perfectly open with you on Thursday, spending the 1 hour actually going through an expression that Hunter uses often, and that's the workflow. And that's working your way through, market scanning, looking for new opportunities, conducting the analysis, using the various indicators or tools within that particular system to prioritize your opportunities. No good your scan coming up with, 300 opportunities. 300's a little bit impractical. You probably prefer 3 or maybe 10, but not 300. So working through that process of how to then prioritize and work out which ones are the good ones and which ones are not so good. Anyway, to today's session, interesting times, obviously, that we find ourselves in. Incredible times, really, with volatility and the like. I'm going to start today talking about my beliefs, my core trading beliefs with trading. I think it's important. I'd like to think some of you have heard me speak before, maybe seen me live in Singapore or in Australia, but I think if you've never heard me speak before, and I'm going to talk about some things that can hopefully help you today, I think it's important you know where I'm coming from and what I believe to be true in the markets. I've been doing this all of a sudden a long time. I can't believe that it's been over 20 years. I can't believe that I've been using Metastock since 1999, which is now 21 years ago, which is ridiculous. Version 6.52, I think, was my first version, and of course now using 16 or 17. So all of a sudden, as we all know, time just goes on and it doesn't wait for everybody or anybody, and just life goes. And all of a sudden I've been trading for more than 20 years. So I think it's important I pass on the things that I value and the things that I think are very important in trading to then, I guess, provide the basis of why I think these are important trading habits for you to take on. All right, obviously here to help. It's my pleasure to be here. Always pleased when Metastock invites me to an event. Nothing's too much trouble. If you have access to the chat or the questions area within GoToWebinar, please feel free to get in contact there and ask me any questions you wish. Got my green tea here this afternoon. Okay, starting with my core trading beliefs. Just wait for, there is a lot of people in this particular session, which is great. And it just means the images I'm getting here means that it takes a little while for everybody's screen to get the slide that I'm wanting to talk about. So I always just wait a second for that to come through, which is why I'll delay a few times during the session. So these are my core trading beliefs. They're in no particular order. They're just things that I value, things that I believe to be true. One of the things that I always do is I always zoom out. So let's go to Metastock very, very quickly. I do have a few charts open, just mainly some indices, main indices like the Australian Index, Straits Times Index, Dow Jones, and some currency pairs. But if I was doing my scan and I went through that process of looking for opportunities, I'll run a couple of scans in here in just a moment. I'll just randomly pull up the S&P ASX 200 as an example. And I'll explain what the indicator is at the top of that screen as well. But whenever I go through looking at charts in Metastock, and whenever I conduct an exploration, using the Explorer, and I view the results of that exploration, and again, I just have to wait for that screen to get through to everybody, and I view the results of that exploration and I go through the charts, as a result of that, the first thing I always do is zoom out, always. And hopefully, in Metastock in the bottom right-hand corner, there's that 4-headed arrow, and that's called the zoom reset, and it literally just pushes every piece of data or data you have for that particular chart loaded into the window that you're looking at. Just zoom reset, so there's no zoom at all, and it shows you everything. And all it does is put current price action, at the right-hand edge of the screen, into perspective. That's all it does. I know I can't go back and trade anything back in the past. I know that. It just puts what we're looking at now in perspective. Are we near all-time highs? Are we near all-time lows? Does this have a checkered history of, being a technology stock, and then the NASDAQ crashed and then all of a sudden became a mining company, which happened, So all of a sudden it's got this checkered history of having the same company number, same registration number, but doing completely different things and being listed throughout. So what's the history of this from a technical analysis standpoint? What am I looking at? Just to provide perspective, and then I simply just use the plus sign and zoom back in. All it does is gives me perspective. That's all it does. And I always believe in zooming out to get that perspective, to get what am I looking at right now in relationship to what it's done in the past. That's all I'm doing. Trade with the most obvious direction. I am a technical analyst through and through. Quick rewind. Back in the late 90s, I was living in the US. I was very interested in the markets. I was doing stuff in the markets. I was losing money, but I was very interested. And living in the US, I was exposed to all these cable TV channels covering markets. And it really opened my eyes to this new adventure and had no idea what I was getting myself into. And it just all these people talking about markets all the time, next to no technical analysis. It was all, very much just earnings and yields and what the company was doing. But I was fascinated. I was fascinated about what all these people were talking about. 99 was when I joined a traders group, and they didn't talk about that much at all. They talked a lot more about reading the charts. Undertook a very expensive course that year, got introduced to Metastock that year. This is now 1999, which, as I said, is all of a sudden a long time ago. But all of a sudden, looking at the charts, technical analysis resonated with me almost immediately. It made a lot of sense. The very clinical, objective approach to looking at the numbers, it just resonated with me. So which brings me to my next point about trends. As a technical analyst, I'm very much a trend follower. I believe in following the path of least resistance. If something is moving in a particular direction for an extended period of time, you want to join in on that and get involved in that and take an interest. I'm just a huge trend follower. We were just talking a second ago about my trade launch systems add-on, which I wasn't going to mention that much at all, but although they're fresh in my mind, having just talked about them so much on Thursday. But the systems here, the 4 of them, altitude, ignition, reversals, and slingshot, 3 of those are very much trend following. The one that's not is the reversals, which is looking for key reversal signals. But even in the session on Thursday, and I'll say this to you now, even with those reversal signals, I still want to trade in alignment, in the overall direction. So we're looking for reversals, but we're looking for reversals that get us back in the line with, in fact, where the overall trend is heading. So I'm just a big believer in following trends. I also believe in not trading every signal or strategy. So this comes back to my quality versus quantity belief. Traders often want quantity. They want lots of trades. I prefer quality. I prefer quality of trades rather than quantity. I think people believe the more I trade, the more opportunity I give myself to make money. Makes sense. The more times I'm in the market, the more trades I take, the more opportunity I'm giving myself to get profits and make money. I get it. I believe trading less is better for you. It's better for your psychological health, but I think it's also better for your account balance. That's just my belief. I believe in quality over quantity. I'll share with you a story very quickly. So I've been in this industry a long time. I know a lot of people. I was in touch with a person within the last 2 weeks, and this person runs a currency broker. He's the CEO, whatever, of a currency broker. And I said to him, I hadn't been in touch for some time, and I said to him, my experience when volatility is doing what it's doing right now, and we've seen this with the GFC, we've seen this with the NASDAQ crash, almost 20 years ago, and now we're seeing it now, although it is dying off a little bit in the last 2 or 3 weeks, but the volatility is still quite silly. I said to him, my experience has been that with currency brokers, when there's a volatility is like this, their revenue, their trading volume from their clients doesn't stay the same. It either dives or it shoots up. And I said to him in very nice terms, I said, that's been my experience. May I ask how it's going for you and your company? And of course, he wrote back, good to hear from you, blah, blah, blah. We are currently at record levels. This is a currency broker, currently at record levels. So I said, well done. But you know what that means for the broker? It means they're making a lot of money. That's what it means. Why? We have ridiculous amounts of volatility And people see that, people coming into trading think, I want things to move, I want volatility. That's all good. It means it's moving quicker and everything else. But then again, if you don't know what you're doing, it means you'll just lose that money quicker. That's all it means. And this is one currency broker out of, you know, countless in the world, but I suspect that's probably quite common amongst a lot of in the industry, right? This very point in time. So what that means is a lot of their clients are just handing over money, you know, hand over fist, handing it over, saying, here you go, take this out of my hands, I don't want it. And they're losing lots of money. Currency broker currently at record levels with this volatility. Just an interesting side note that, you know, yes, we want to trade and we want to be active, but I don't believe in quantity of trades. I don't think that's good for you. It's great for brokers. That's how they make their money. They need activity. They need to charge commissions or get, you know, pick up on the spread every single time. However they generate revenue, right now they're doing very well. I just believe in quality over quantity. I'll leave that alone. In line with that, rather than having, you know, thinking we're this fantastic trader and having 8, 10, 12 different trading systems, forget about that. I really believe in having one. Now, I don't mean you can't have more than that. What I mean is you need to start with one. Start with one, become an expert, know it incredibly well, implement, execute that plan, have confidence in it, see the results, and then maybe think about a second. Don't come into trading, think, oh, I've got to have all these different strategies for all these different market conditions, blah, blah. I can't make money from any of them, but maybe one will, you know, just try one. That's my call. That's one of my beliefs. I also believe, again, just waiting for that slide to come through on your screen. I also believe that higher timeframes produce better signals. So, you know, if we come in the case of a Metastock, for example, this is the real-time version. And of course, I have a menu down here which allows me to select, excuse me, select different periodicities, chart periodicities. You know, if you go to an MT4 platform, trading currencies, or another trading platform, an actual execution platform, you might even see more. And there can be that inclination to want to have a look at every single one and potentially trade every single one. Again, I'm not a big believer in that. I believe, though, we need to perhaps consider more higher timeframes. That's just been my personal experience. That's one of my beliefs. I really do avoid intraday charts. People wanting to trade 1 minute, 5 minute, 10 minute, 15, 30, whatever it might be, down in that range, thinking, you know, the candlestick is coming up new every minute. That's activity. That's what trading is. That's great. I don't subscribe to that theory. I don't think that's a good thing. Brokers will like you thinking that way. I think if you want to achieve consistent performance, that's probably not the best approach. I think there's absolutely zero logic, any sense in a 1 minute chart from 1 minute to the next, to the next, to the next. You know, and when I'm in Singapore, I always talk about go to Resorts World on Sentosa, go to Marina Bay Sands. You've probably got a better chance, or I can mention a number of casinos in Australia. You have a better chance of making money there, I think, than trading 1 minute charts. That's my personal opinion. Just finishing off the core beliefs, and then we'll get into the top 10 trading habits. I believe in leaving trades alone. Leave them alone. You are the weakest link. No offense. You and your mind and your whole attitude and approach, you unfortunately are the weakest link, all of this. It won't be your trading rules. It won't be your software or your broker. It'll be you and your want to interfere and to get involved and to second guess and to think, oh, I think I know better. I think the market will do this tomorrow, and, you know, change your rules and think you can influence things. Leave your trades alone. Your rules, you know, the compilation of your trading rules is obviously your trading plan. Your plan is there for a very good reason. It's there to protect you from doing really, really silly things. There is an illusion of control sometimes when we watch intently, you know, look at charts, and I think your good trades take time. Very rarely do you enter a trade and it immediately hits your target or immediately starts surging in your direction. The very best trade you take, just take time, need patience. Again, comes back to point 1 on that slide, leave your trades alone. That's what I firmly believe in. Okay, so here are, again, just waiting for that slide to come through on your screen. So here are my top 10 trading habits. This is what I really believe in. Firstly, we'll start with using data-driven decisions. So having numbers and the price and the derivatives, drive what you do. This is a core belief I've had for some time. Clearly, as a technical analyst, and if the majority of your analysis is driven through technical analysis, then you're probably already doing this. An example I'd like to share with you right this moment is, in fact, the indicators at the top of any of these charts that I have here. So top left, I have the Dow Jones when it comes through on your screen. In the middle, the S&P ASX 200, I have the Straits Times Index, and two currency pairs, the Euro US bottom left and the Australian dollar bottom right. And the indicator on the top of all of those charts is a volatility-based indicator. The average true range for the two currency pairs at the bottom, and the three indices are my volatility percentage indicator. And just coming to the S&P ASX 200 just for a moment and then zooming out, you can see that the vast majority of time, that red line is below my 1.5% level. Every now and again, it will pop above and stay above. And you can have a look at what sort of happens during that time. So clearly we have, during 2008 here, we have the GFC, a time well known to a lot of people. And the volatility during that time of an index got to ludicrous farcical levels. Now, for an index to be moving 4 or 5% per day, that's the index, mind you, not an individual stock, but the index moving those levels. And of course, volatility is directionless. It's not up or down, it's anywhere. But to be doing that on a regular basis was just stupidity, just ludicrous. Markets shouldn't behave that way, but that's not my say. That's just the way they were doing it, the way markets are operating. We've seen it again 2 more times briefly. Notice every time the volatility surges higher, the market falls. And of course, we're seeing it more recently here. In more recent times, again, we've seen that volatility just surge higher. So coming back to having data drive your decision-making, I've said this for now many, many years. I've been talking about this particular concept, and I'm going to say it again now in 2020. When I have that indicator move beyond 1.5% on my index, that to me means tools down. No more trading. That's what it means. I'm out. Like, for the index to be surging through that level, surging through and then going even higher again and keep going higher, means the market is operating stupidly. I reference back to the message before from my CEO of the FX broker, who said, record levels, just things are going fantastic. I just hope they continue, was his sort of final message. Why? Because people are trading and they're seeing this. They're seeing the volatility. For me, tools down, I'm out. I'm out. I was approached by a person running a company in Singapore in the last week about his upcoming online, similar to this, online trading summit to be held in June. And it's called the Bear Market Summit. He said, I want to reach out to people, find out how you're trading this particular time. And I replied to him and said, well, I'm going to provide a point of difference. I might be different to all of your other presenters and speakers, because based on this, I'm actually not trading at the moment. And I'm sharing that with you right now. I'm not trading at the moment. It's just stupid. And he's saying, yes, that will be a point of difference. I'll be interested to discuss that with you, share that with the audience, et cetera, et cetera. So I'm being just very open with you. I'm not trading right this second. I think it's just stupid. It will go back to normal at some stage. Please don't ask me when. I don't know, but it will. Always does. It will, and things will get back to normality, and I can get back into the way, I approach the market and look for opportunities again. But I'm in no rush. I'm in no desperate need from a personal financial standpoint. I mean, when it resumes, I'll get back in. That's just the way I approach the market right this very second. Why? Because I'm having the data drive my decision making. I'm not applying any emotion to this. It's just a very clinical, objective approach to the way the markets are operating. Just share with you a couple of things. Again, just waiting for this to come through on your screens. So if I run right this very second, if I run my altitude, this is a long system, say on the top 500 stocks in Australia, using local data takes next to no time. Get a quick snapshot here. So there's 7 companies currently appear in that list from that scan. And then if I do the same thing and I run the short system for the same, and I run that again, we'll find there's, how many? Just waiting for that to finalize. Not quite double, but almost, right? So there's twice as many stocks appearing from that scan. What does that tell me? It tells me generally the market's heading lower. Maybe I then have a bias one way or the other. You know, if there's twice as many short opportunities than long, that's telling me something. That's having data drive what I'm doing. So it's just a simple example. I could run the weekly, sorry, just come back up to some of my own personal ones here. You know, I could run the all-time highs, weekly all-time highs and lows. And again, if I find twice as many stocks reaching all-time lows in the last week compared to all-time highs, again, that's telling me something. It's telling me about the way the market's operating. Maybe I shift my bias between longs and shorts. But again, that's just having data drive what I'm doing. I just thought I'd share that with you. You know, the scans can often, you know, show you what's happening anyway without even looking at the index. So let's just go through these slides. You know, all of this is related to technical analysis on this particular side. So as a technical analyst, I am having data, I'm having numbers drive what I do. That's just what technical analysis is. Just quickly, if you've heard me speak before, you've heard me talk about all these things. It's simply an approach. It's not the approach. It's not perfect. I will never say it's the best. I will say, though, that we all need to find something that resonates with us and we're comfortable with, because we're putting our own hard-earned money into the market at risk. So you need to have that level of comfort and confidence in the way you are analysing opportunities. It can be very complicated and mathematical, but I absolutely believe in simplicity. And all we're looking to do is increase probability of profitable trade. Any form of analysis, all we're looking to do is increase the probability of having a profitable trade. That's it. Need to move on. Speaking of data-driven decisions, speaking of key numbers that will determine whether you make money or not, ultimately, these are the 4 that you need to concentrate on. There's no 2 ways about it. These are the 4 key performance numbers that you need to focus on and work on. Not so much the top 2, but more so the bottom 2. You know, your average profit compared to your average loss, and the combination of those with your percentage of winning trades and percentage of losing trades mathematically determines whether you make money from your system or not. This has been spoken about for so many years, it's not funny. And the first I learned about this was from Dr. Van Tharp in his book, Trade Your Way to Financial Freedom, where he spoke about expectancy. And he used these 4 numbers here and the combination of them to determine your expectancy and what multiple of your risk are you going to make from a system over a period of time. Understanding this is really, really important. This is key. It's your key performance numbers. And, you know, we shouldn't focus too much on the first 2, but the combination of all 4, certainly the bottom 2, and managing reward to risk and the like is critical to whether we actually end up making money. And I am not here to talk about this in this particular session, but, you know, one of my modules in the education course was all about managing risk. And we spoke about reward to risk. And we spoke about how the combination of all these can actually lead you on a path of you guaranteed to lose money. And some people are doing that and probably not even aware. And that surprises me. Maybe it shouldn't. I find that fascinating, though, that some people have the combination of these numbers in the wrong way and they're guaranteed to lose money because they're not managing and not aware of their system's capabilities or characteristics with regards to these numbers at all. Okay, moving on quickly as time is very quickly escaping me. Sticking to your time frame to me is really important. So I talked about MT4 before. I'll just move to a real-time chart here in Metastock. Just again, wait for that to come through on your screen. So this is a chart of the Euro US. So even within Metastock, you know, the real-time version, We have the range of menu options there so far as periodicity of the chart. You know, MT4, other execution platforms may provide you more. And I don't like it when people run the menu. When traders look for opportunities, utilizing every single one of those options in that menu, I think that's a horrible way to trade. But if people think about quantity of trades and they're so focused on getting lots of opportunities, that's exactly what they'll do. They'll look at an hourly chart and see nothing. They'll look at a weekly chart and see nothing, a daily, whatever. They'll just keep looking because they're looking for opportunities rather than sticking to their time frame, which I think is really, really critical. And just having your time frame for your trading plan and being consistent with that. You know, the way you trade a 1 week chart is very different to the way you may trade a 5-minute chart. You know, the way you set stops, set targets or trailing exits or whatever it might be, the way you analyze trends is going to be very different. So all of a sudden now we have the potential for multiple trading systems simply because we can't stick to our time frame. I'm a believer in sticking to your time frame. Demand quality rather than quantity of trading opportunities. And you can zoom in too much. I can't spend too much time on this. I need to move on. This is a model that I've spoken about at length. It's certainly in my education course. You need to, using this, you identify your trading style by looking at your average profitable trade duration as you see it. You know, what's your ideal trading setup when you visualize what your trading is going to look like? And once you've identified that in the far right-hand column, I can then assign you a particular trading style and maybe an appropriate chart periodicity to use for that particular trading style. That's all I'm trying to do. And I think that's important, to have a trading or chart periodicity which best complements or suits your trading style. And this also provides you that focus of only want to trade this way. I'm not going to look at 5-minute charts or 1-minute chart or 1 week charts. It doesn't suit my trading style. I don't need to look at them. Well, simplicity is something that I could talk about at length. Again, I just need to wait for that chart to come through. Screen to come through on yours. Simplicity, I can talk about this at length. This is something that I very, very firmly believe in. Of all the, you know, my top 10 trading habits, this might be right up there. Simplicity works. We come into trading thinking it's easy, we lose money, we then think, oh, it's really difficult. When we think it's difficult, we think we need to complicate and have quite a complex approach to trading. We need to use lots of indicators and whatever it might be. And yet simplicity can really be quite effective in the markets, and very simple approaches have proven over time to be very, very effective. Plus, the more simple they are, the easier for us to implement and execute and stick to, rather than having too many layers of complexity. Yeah, I can't talk about this enough. You know, I really believe in simplicity. Hunter mentioned my book before. I was actually just flicking through it just a moment ago. It is in its 4th edition. I'm very proud of it. And, you know, whenever I would sell one of those books in person at a presentation in Singapore, and someone comes up with some money, and I would always sign it and write, keep it simple. Always write inside cover, keep it simple. That's how much I believed in how important this particular belief or habit is for, you know, good trading. I've always used this particular slide. I got this many, many years ago, and I still use it today in my presentations. And that's, you know, just a chart full of everything I could find, and I just threw it on there. Unfortunately, I've seen on people's laptops and I've seen charts that look like this, and I'm thinking this is just wrong. This is not what trading is. This is playing with software. That's what this is. This is not trading. So please don't have your charts look like this. You know, just on the slide before, I talked about a very, very minimalistic approach, having clean, uncluttered, very clean charts. I'm a big believer in that. I'm a big believer in simplicity. You know, when it comes to Metastock, and, you know, my charts are often very, very clean and uncluttered. You know, to me, when I run the scans, and I'll just get rid of these two here. Again, you just need to wait for it to feed through to the hundreds of people in this particular session. You know, when I run a scan here and I run my altitude long and I'll run the scan there, you know, I don't need to see what it's doing on the charts. I know what's in that system, and I know the 20 odd criterion that particular scan is doing the calculations for and ensuring that each stock meets all of those criteria. I know a lot of work's being done. There's a lot of number crunching going on behind the scenes. So when I see the final report or the final chart, I don't need to have lots of indicators on the chart. I know all of that work's already been done in the Explorer, in the number crunching. And I think that's important to have that confidence in what the scan is doing for you. I like this quote. It says a lot. Simplicity and ease are different. Simplicity and ease are different. Trading is simple, but it's not easy. The concepts that can be very effective in the market are relatively straightforward. The whole idea of buying a stock at $1, and if it falls to 90 cents, selling it at a loss, as in a stop loss, is a very straightforward concept that you could explain to most children. Very, very simple. Trading is simple. However, us actually following through and adhering to those rules and concepts, that's where the difficulty in trading lies. That's the difficulty. So trading is simple, but it doesn't mean it's necessarily easy for us as people to actually follow through and, you know, follow those rules and do things like that. So I love that particular quote from The Way of the Turtle, I think a book written by Curtis Faith about the turtle traders. I'm a big believer in following a process, a logical step-by-step sequence. You know, for people who've even been trading for a long time and they're still struggling and a little bit haphazard, this can provide just a logical framework for you to follow through. You know, you need to input all the actual actions you take to follow those steps, but this is just a logical step-by-step sequence, and traders need to follow a very methodical approach. Don't be indiscriminate, don't be random, don't be haphazard, be logical. Excuse me, be organized, orderly, be, you know, just be methodical in what you do. This can provide you that sort of process to follow. I won't spend any time on that. I'll just quickly get through just a few quotes and then I'll move on to the next. This comes back to that key performance numbers, you know, again, from William Eckhart, who's linked to the Turtle Traders, interviewed in one of the Market Wizards book, who said, we as people, if we have a desire, you know, setting up our trading system and coming up with a set of trading rules, the desire to maximize number of winning or minimize the number of losing trades can actually work against you. That sort of strike rate or percentage of winning trades is really not that important. That's when it comes down to average profit and average loss, reward to risk, and the relationship between those two. That's really critical. With anything in life, just having the right mental attitude obviously is important. The reason why I had my book in my very hands minutes before I started today was I flipped, if you have a copy, page 231, and it was when I was interviewing my own little sort of group of market wizards, and I was interviewing Dr. Van Tharp. And I said to him about, you know, 3 M's, you know, money management, mindset, and the methodology and how important each of those are. And he said, you know, back in my book, Trade Your Way to Financial Freedom, late 90s, I broke them up, you know, 60% psychology, 30% money management, and 10% system. He said, now I believe it's 100% psychological. Trading is all about taking action, making decisions, doing something. All of those come from our beliefs, our habits that we form. Trading is 100% psychological. Now that's coming from a psychologist. Maybe he's biased, maybe he's not, maybe he's even better equipped to draw that conclusion and form that opinion. He said trading is 100% psychological. It's nothing to do with the software, your broker, your financial products you trade. It's all in the head. So clearly, you know, so far as habits are concerned, we are habitual creatures as people. We are very habitual. We do a lot of things without thinking. We do a lot of things subconsciously, instinctively. So in trading, we need to form good habits. And if we need to rethink the way we do things, and that's exactly what we need to do, form good trading habits where they then become our habits, and we then become actions that we don't even think about. And therefore become a very good trader as a result of changing our beliefs, changing our actions, changing our habits. There's just a few things, you know, discipline is obviously important. I spent a lot of time talking about these again, in the education course, there was a module dedicated to the mindset. I ran way over time. I was given the wind up because I just wanted to keep talking about it, because obviously it is so important when it comes to this very psychological endeavor, which trading very much is. Love this quote from a former US president. In reading the lives of great men, and I'm sure any person, great people, I found that the first victory they won was over themselves. Self-discipline with all of them came first. Can't overstate the importance of discipline. You've heard it all before. You know it. There's ways in which we can improve our discipline. I spoke about that very much in the education course, you know, taking small steps and changing habits. Self-discipline is so important. I love this quote from a former US Army general, commander of the Allied forces in the First Gulf War back in 89 or 90, whenever that was happening. And I love this. You know, the truth of the matter is you always know the right thing to do. The hard part is doing it. And when I read that, I thought, if that's not trading, I don't know what is. When it comes to trading, you always know the right thing to do. You always know you need to let your profits run, or take the profit there, or cut your losses, or follow the trend. The hard part is doing it. Trading is simple, but it's not easy. So again, we need to do things which make it easier for us to follow what we know is good trading practice. That's what we need to do. Discipline is certainly an important of that. Cutting your losses. Can't talk about this too much, but obviously I don't have too much time today, but I think it's the most important trading decision you make. I challenge anyone to come up with a more important decision you make with your trading. I challenge anyone to come up with that. Obviously, it's easier said than done. There's a number of different ways in which we determine stop losses, but this to me is a very, you know, it's just a critical part of our trading. I love this particular quote from another trader interviewed in the Market Wizards book. He's only got 3 parts of good trading, only 3 of them, and those 3 there: cut your losses, cutting losses, cutting losses. If you can follow those 3, you might have a chance. So that's how important, you know, this particular person thought, you know, cutting the losses was to your trading. There's only 3 things you need to do, and do the same thing 3 times. You know, really, really important. I love this one. The most important thing in making money, says Marty Schwartz, the most important thing in making money has nothing to do with your profitable trades. Nothing. It's not letting your losses get out of hand. We've all had losses get out of hand. They can devastate you. You need to completely eliminate that from your trading. Completely. The most important thing in making money is not letting those losses get out of hand and get away from you. And unfortunately, we've all had that happen to us. Another trader interviewed in the book, don't focus on making money, focus on protecting what you have. So don't come into trading thinking I'm going to make lots and lots of money. Think about what can I do to protect my money. Again, a complete mental shift in the way you're approaching your trading. Don't have time, need to move on. Sorry, as time escapes me. I talked about quality rather than quantity, which leads me to my point here on the left. Don't force the action. Don't overtrade. Don't trade for the sake of trading. Let your trading plan do its job. Your trading plan is designed to keep you out of the market, not get you in. Your trading plan is designed to keep you out. When I do a market scan before using the Explorer and it comes up with 6 stocks out of 500, my trading plan is saying no to 494 of them. That's what my trading plan is doing. That's what my trading plan is designed to do, to keep me out, not get me in. Don't force the action. Don't overtrade. Demand quality, not quantity. Don't listen to others. It's a great position to be in where you could not care less what anybody else thinks. It's a great position to be in. You just have tremendous confidence in what you're doing, your whole approach, the systems you have in place, that workflow you go through, all the rules set up in your Explorer, you know, the exit systems you use within your, you know, built in the indicator builder, or you have my add-on or whatever it might be. You have a lot of, you could not care less what anybody else thinks. It's a great position to be in, I can assure you. Keep positions small. This just comes back to being that very protective, you know, conservative. We're talking about what good traders do. They don't put all their money. You've heard all this before. Just be very protective. Adopt a very conservative, protective, defensive posture with your money. Don't think about all the money you can throw into the market. Think about all the money that's going to sit in your account being safe. You have a lot of control to determine when your money is allocated into trades and placed at risk. Maximize that control, keep your trades small. The 3 M's of trading, obviously, again, I've talked about this so many times over the years. You obviously need to develop a trading plan that's right for you, resonates with you, sits well with you. It's your money at risk, not mine. Your money at risk being put in the market, you need to be comfortable with that risk you're taking. You need to be comfortable and confident in the systems and the plans you're implementing to put that money at risk and ensure that you have good stop losses in place. They are well positioned and they're positioned for the right reasons. And you have your trailing exits in place or your take profits in place. And it's all, aligned with that reward to risk relationship you're looking for. Just good things are set up for your trading. You must develop a plan that's right for you. I'll just finish off on these points. Clearly, your methodology is the sequence of events that you use to conduct your analysis and look for opportunities. The money management side of things is all about protecting that capital, allocating capital, ensuring your reward to risk. And I think it's an issue that a lot of people don't consider. It's not obvious to you. When you start trading, you don't think about reward to risk. You don't think about expectancy. You don't think about average profit and average loss. It's not obvious. You don't think about it. You just think about finding trading opportunities. So understanding all that and how the numbers weigh up for you and your system is really, really important. And then, of course, the mindset, the 6 inches in between your ears, the glue that keeps all of that together. And all of that decision-making we do, the analysis, deciding on our trading opportunities, reward to risk, setting stops, allocating capital and trade sizing. It's the glue, the mindset that actually ensures that we do everything our plan is telling us that we should be doing. Just to finish off here, to me, trading is very much a rules-based activity, very much system, process, methodical, working our way through things very methodically. Traders are very good at what they do. They're disciplined professionals and they've spent a lot of time developing themselves and, forming those good habits and doing things obviously differently to a lot of, the way a lot of other people in the market approach their trading. Speaking of trading plan, just to finish off, your trading plan simply has to respond to 3 questions. That's it. So, perhaps write this down if you haven't done this yet. Just how do we get into trades? How much money do we commit to those trades? And how do we get out? That's it. That's what your trading plan should have. So follow the step-by-step sequence, the trading process, but your trading plan should have an answer to each of these 3 items. Pretty important. As Hunter mentioned, my last module of the education course was actually spending the whole 1 hour actually going through, conducting scans, showing how to rank, the different stocks based on the different columns and the different parameters that I've set within that, within that particular system. I've got the 4 trading systems and a number of, accompanying supporting indicators like a market breadth or sentiment indicator, my volatility percentage, volume strength, and a number of other, all those trailing exits that I've shown people over the years, all part of the Trade Launch Systems add-on. I was pleased to include that as one of the modules in the education course. Just to finish off, today I've had the pleasure of your company. I just wanted to start off by talking about my core trading beliefs and then just working my way through top 10 trading habits of successful traders. Remember, habits. As people, we have beliefs when it comes to trading, we have actions as a result, and then we need to form good habits. So think about, we are habitual creatures. We need to form good habits. That's what will help your trading. Remember, trading is a 100% psychological endeavor. It's nothing else. It's all about you and your beliefs, your actions, and your habits. For those who don't know, I do have my Metastock related site as a partner site. I've been working with Metastock now for a long time. So that's my site, metastockaustralia.com, metastockaustralia.com. On there, I'll post updates with what Metastock's doing. I'm able to help. Having used the software myself, I may be in a slightly unique position. I've used the software now for 21 years. There's not a week goes by where I don't use it. So I've used it a lot. I know how to use it pretty well, and I'm always willing to help people. So if you use Metastock and want to get some help, please don't hesitate to contact me from a trader's perspective, not a technical support perspective, but very much from a trader's perspective, I'll be more than happy to help you. With that, Hunter, I think I'll just try to get you a little bit back on track time-wise. I hope that's okay. Thanks again for the invitation, the opportunity to talk to everybody. It's been great. I've really enjoyed it. So thank you. Over to you.
Yes, my friend, always a pleasure. Thank you so much. I hope you have a good rest of your afternoon. Stay safe out there. Maybe get a good round of golf in. You know, one of the things that I truly enjoy about Stuart's methodology is, honestly, you rarely see Stuart show charts as much. And what I kind of want to touch on there, what I want to cover is that emotionally speaking, trading it's so important that you have the mentality of a trader, of a successful trader, and that's having a trading plan. Metastock's entire purpose is to allow you to do everything that you need to do as a trader to be able to get into a workflow, and you hear me say that 500 times per webinar, but be able to get into a workflow, be able to do the same thing every single morning and establish that rules-based trading. Now, one of the huge things that I've taken away from Stuart is what he was covering a little bit earlier. And that's walking away. I don't want to trade like this. That's not how I want to trade. I don't want to have to focus solely on the trade. I don't want to have to stare at it and you know, get scared when it starts moving the wrong direction a little bit. I want to be able to utilize my trading plan. I want to be able to utilize the tools within Metastock to identify the signals that are outlined in my trading plan. I'm going to place my trade, and then I'm going to do this. I'm going to walk away, okay? Because I'm confident in my trading plan. So if you do not have a trading plan, I would definitely recommend writing a trading plan down, have it in writing. One of the really cool things about what we've done recently with Stuart, his add-on is very, very simple to use. It is very, very straightforward. It has a short-term, medium-term, long-term system. It has 4 total systems. It has expert advisors, explorations, indicators, customizable experts, etc. But my favorite part is the 6-hour training we just did, because the amount of time that we spent covering specific charts, etc., was minimal comparatively to the time that we spent actually focusing on how to be a good mental trader. Okay, how to establish that game plan, how to establish that trading plan, how to stick with that plan. So if it's something where you don't have a trading plan, if you don't have it written down, I would really recommend that you take this course that's included with this bundle. So with the bundle, you get Stuart's add-on that he showed a couple of times. You get his, it's actually closer to 6 hours of training across 5 different modules. He covers how to create the trading plan, which is personally one of my favorites, understanding the 7-step trading process, how to compare fundamental and technical analysis, what is risk management, how to apply it correctly, the 8-to-2 rule, the key attributes successful traders have. This really walks you through step by step and shows you how to be a competent, successful, consistent trader. And in these times, that's all you can ask for, is being a consistent trader. Now, our next speaker is the creator of the chart pattern engine. His name is Ed Downs, and he has another add-on with us that has been very, very successful. And this is something that was kind of created off the back of that original add-on. Ed Downs, he's a software engineer. He's a veteran trader. He launched Fulgent Technologies in 2019, and he uses a lot of AI technology developed by Nirvana Systems. This is something where this add-on it's incredible, and that's kind of part of the reason that we put it together with this bundle, because we believe it really is the complete package. You get Metastock DC, you get a month of data for free, you get the chart pattern engine for all of your technical analysis needs, and we're going to take an in-depth look at that here in just a moment. But you get Stuart's trade launch systems, which is a very easy to use system, as well as 6 hours of training with him that he's already recorded. You get Unleash the Power of Metastock, you get the white glove installation service that we were talking about earlier, and you save $1,500 doing it all together. So it's $1,997. Now, if you have questions on what's included, or if you have questions on anything that's included with Metastock and what you can do with it, give us a call. You know, it's 800-882-3040, +1 801-506-1003 is the direct line if you're out of the US. And metastock.com/sales chat. It's late in the evening here, but we have sales guys, staff on hand. Probably they're coherent right now. I'd assume so. It's about midnight here. On to our next speaker, Ed. I talked a little bit about you here. Can you hear me okay? Let's see here. No audio. Let's see. I think we're dealing with some audio issues. Give me just a second. Ed, can you hear me okay? All right, so we're going to take just a second, and I'm going to see if we can get Ed's audio working. So I'll be right back with you.
Go. Okay. Hello, Hunter. Do you hear me? Yes,
All
you do.
right, I can hear you just fine.
And now I hear you. We're good.
Wonderful. So after short technical difficulties, I'm going to go ahead and turn the presenter over to you.
All right. You want me to go ahead and jump in?
Yep. You should be on now. Just go ahead and click on share your screen.
Oh, yeah.
We should be good to go. I see it right there. Looks great.
All right. Let's check the really important thing. Do you see me?
I do. We're good to go, my friend. Take it away.
Awesome, awesome. Hey, thank you, Hunter. This morning, actually pretty early morning here in Austin, but it's such a privilege and an honor to be here for APAC with what I have to present today. And I don't know how much you know about me from the materials, but I've known the folks at Metastock for many, many years, going back to Steve Akalis, the founder. He actually promoted some utilities that we built in my company for Metastock DOS version. So that goes way back. That kind of dates me, doesn't it? So that was one of the early things that we did for automation in my company. That's what we specialize in. I have an automation background, so naturally, I wanted to automate stock trading in some way. And so we've done all kinds of different things, but one of them was to focus on artificial intelligence very early, going back about 22 years or so. And that focus it was one of the things we did around the area of automation. We also worked on today's topic, which is chart patterns. And so been at this a really, really long time. And I'm so, like I said, so honored to be here with you today. And been looking at your stock markets. They're very interesting, very, very cool. So my main intent today is to, of course, I have a product like probably everyone on the show, but my main intent is to teach you about the most powerful thing that you can use in the markets, in my opinion, and also one of the easiest things to apply, and that is chart patterns. They are so good, so powerful. Like I said, I've been studying them for many, many years. And so I hope that I can impart some of that knowledge onto you today to empower you in your trading. Whatever you're trading out there, it doesn't matter. As long as it's freely traded and a liquid market, patterns work like crazy in every market imaginable. End of day, real time, futures, Forex, stock markets around the world. This is the way you can really get the explosive moves, folks, I'm telling you. So with that intro, let me go ahead and start here. I'm going to give you a lot of information today about patterns. I'm going to go pretty fast through it. This little book, an ebook, has all the material that I'm going to present, plus additional examples of the patterns. And so if you just go and sign up for that, happy to send it to you. No charge, of course. It's an ebook. It's fairly long. It's got, like I said, a lot of chart examples in it. So I think that will help you to get going there. And Hunter, I see that Jeffrey is calling me. Let's see. Jeffrey is my marketing cohort over there. Let me just tell him everything's good. Jeffrey, we are good to go on the webinar.
Oh,
we're rolling.
okay.
Okay. All right, man. Thank you. Okay. Yeah, I called him a little while ago to make sure we were okay technically, and so he's just checking up. So
Perfect.
Anyway, no problem, no problem. So this little book will help you, and you can just get that on the website there. So let's go ahead and dive into our topic, which is all about chart patterns. And the first question, of course, everybody wants to know is, well, do they work? Do chart patterns actually predict stuff? And I quote this study by McKinley and Lowe from the Wharton School because it's so famous. Up to this time, and I was in graduate school and stuff way before this, in like accounting and economic classes, and they would always say, technical analysis is voodoo stuff, doesn't work. Earnings and fundamentals are all that matter in the market. Everything else is priced in. And so they studied these patterns, and especially the ones like head and shoulders, triple tops, triangle tops, and bottoms, and so on, and really did a rigorous study at that time of history to see, are they actually predictive? And what this is just the sort of the conclusion of the piece is that the results showed that the various technical patterns occurred far more frequently than if they were truly random events. So, and they had a lot of evidence to back this up. And of course, there have been other studies since then, the same thing. But if you Google them, you'll find that, and it's really quite good. So in general, charts contain useful information about future share prices. Of course, you know that. That's why you have Metastock, and that's why you're here. So when we look at, patterns are tremendously powerful. This chart is just this chart of the S&P 500, marked with all kinds of patterns on it. We're going to be talking about them today. But there are quite a few different patterns you can look at that have been written about over the years. And they're, effective to varying degrees depending on certain things. So what we want to do today is explore these patterns and understand the ones that are the most powerful, the ones that really can get you, just in the catbird seat for making money in the market. So let's go ahead and dive right in to the 7 patterns. And of course, they are the 7 patterns that consistently, go on slide, make money. Okay. So that little book right there I wrote back in 1998, and it's not very long, but it covers these 7 patterns. And since then, I have continued to see in chart after chart in my trading that these are the patterns that really, really work. I mean, there's lots of stuff out there, you know, different things, different variations, but these are the 7 that are the most powerful, and they're documented in the book. Of course, if you get the ebook, it's the same material, so you don't need to buy the book. Okay, it's the same thing, but it's they're timeless. They've been around forever, and they really work because of the psychology of the market. There are additional patterns that I call secondary patterns, and there's 3 here that I'll just mention: tops and bottoms, cup and handle, head and shoulders. And those patterns really are variations of the others. For example, a top and a bottom is really a support resistance level. Cup and handle is really a saucer with a little consolidation on the back side of it. And head and shoulders is really a trend line break pattern, mostly. Head and shoulders is a little different. Head and shoulders has a lower high on it, so it has a little more information than just a trend line, but it's basically a trend line break. So those are the top 7 are the 7 patterns. Let's just dive right in and look at them. So the first is a trend line break and reversal. Very powerful psychological pattern. And on all of these, what I want you to think about is, you know, you can draw a line anywhere in the chart across anything. And there's lots of ways people do it. What you have to ask yourself is, does the market see what you're looking at? Do they see that break? Is it obvious? It needs to be clear to the market that there is a sudden break of a sloped support line, you know, and if there is, then the market sees it and they react to it. So, you know, that's just what happens in markets. So this invisible line forms across price action and creates similar psychology to support resistance, which we'll cover in a minute, and strong breaks can result in large moves. So that's the basic pattern. And let's look at a structure diagram. I have these for each pattern, and this is also in the ebook. But I like to divide moves up into 8ths. That's the Fibonacci scale. And we'll be looking at that a little bit in Metastock here in a minute. But this is actually showing 2 different patterns. One is the trend line reversal, where you're coming down to a trend line. You get right to it. Has to be very obvious trend line. And price starts to go the other direction. Well, when it starts to do that, you're pretty assured that it's going to make the top of that channel that it's forming with the upper trend line across the top. So as it gets down to the bottom down there, you wait for that little 1/8, you know, approximately move from the bottom on a scale of 8ths across there. And that's about where you get in. And you're looking at a target up in this 8th that's really close to the top of that channel to get out. And you put your stop down just below it at the other 8th down here. So if you divide ranges up into 8ths, it's approximately correct. If it's a really big range, of course, you want it to be tighter than that, but that's just a general rule of thumb. The break pattern, you're going to look at this entire range going across the chart like this, from the very recent low that formed the move up to the break and to the high. So that range, you can divide that up into 8ths and the same thing. You know, look at approximate the dimensionality of the pattern. Patterns are fractal in nature, so they can be little bitty, they can be huge, and the rules kind of apply, you know, no matter what they are. So at this point, what I would normally do is go through a gazillion slides with all these examples. Well, that's in the ebook, so we're not going to do that. We're here to trade with Metastock, an amazing piece of software. I love this program. There's especially 17. What they did for 17 is just killer. I mean, with options especially, and the other features, it's incredible. So I've really enjoyed working with it and working with the people at Metastock to get this implemented. So what I'm going to do here, this is Metastock on one of my favorite American stocks, Apple. And let's just look at kind of what's happening here. If I move over a little bit and zoom in at a point on this chart, what I can do is say, you know, I see this thing going down here really hard, this price action, and it's kind of forming what we call pivots. They're not very big, but it's forming them. And when it gets to the bottom here, it sort of breaks that. So if I were to go over to the Metastock drawing tool and draw across all of that stuff right there, okay, about like I need to make it fit as close as I can to what the eye sees. It's kind of breaking through it right there, but it really breaks through there. And then it starts up and we have a gap and we have other things happening over here on the right. But that's what you're looking for, is what the market sees, that little break right there, and they love it. They go, okay, Apple's going up now, and they start buying. So I can sit here and draw all over this chart. You know, we talked about canned examples. We're not doing that. I can just go to town on this thing. I'm not going to do it though, because I have a tool that will do that for me. So this is our product. I'm going to show it to you and it'll help us in this presentation. It is the Fulgent AI chart pattern engine. Fulgent is the name of the company that I created to really get the AI out into the market that we've built over 20 years. So that's its purpose. My original company is Nirvana Systems, but Fulgent is this AI-centered company. And the chart patterns have a flavor of AI in them. I might talk about that later. It's basically a database of patterns that we built, but this is just integrated right into the Metastock menu. I can go right to it, and I can go to the expert, which is patterns. There's another one here, which is an AI expert. Metastock has this also in their store. We're going to be talking about patterns today. So if I double-click FT patterns, I get all of these patterns here. And I'm going to go ahead and turn all of them off. Turn on one. Click OK. And close. And what I want to do now is activate the expert advisor let's just go ahead and refresh this real quick. It may actually already be on. Let me check. Not yet. So we're going to activate the expert advisor for the patterns. And let's see what we get here. Okay, it says which one. It is the Fulgent AI patterns. Okay, get that. And refresh the chart here. Okay, let me go back to it, because I hadn't done it quite in this sequence before. So let me go back in and make sure that's activated. Yep, trendline break is active. Okay. And let's see what we get here. Well, that is interesting. Let me try to reload the chart here real quick and see if that gets it. Okay. You know what software people do when this happens to them? They start freaking out, but it's happened to me before, so I'm not going to freak out. Let me go ahead and enable all these and see if I can just get it kick-started. So, all right, close that. Okay. Okay, interesting. My Fulgent is running. It runs in the background on the computer. So let's see. I'll tell you what I'm going to do. It doesn't take long. Just restart Metastock. So I'll just do that. And I'm sure we'll be fine. So like I said, my sequence is a little different this time. Normally I leave the advisor on. I don't turn it off like that. So I think that just, wasn't the best sequence for it. Okay, let's see here. And I think I've got this still selected down here. Let's find it. Let's just try. I'm pretty sure I left it selected. So what comes up? And there they are. All right. Now don't look. You can't look at this. You got to close your eyes. Thank you very much. All right, because we got to build this thing up. We can't just do the kitchen sink all at once. That wouldn't be good. So we're going to build up. All right, there we go. No need to freak out. Okay. Oh boy, I'll tell you though, I've had some times when I did freak out, but not this time. So let's go back to the chart and I'll go ahead and redraw that thing for you. We only lost about a minute to that. Not too bad, not too bad. So here's my line, and you can see down there, we actually have this little, it says TLB, which is the symbol that we use in the chart for a trend line break. And so what this software does, it's looking for the patterns that we're going to be exploring today, and it looks for the earliest opportunity for the pattern to fire. The reason we do that is because this is a tool for seeing the patterns in the charts as they occur, as early as they possibly occur. So what you're going to do as a trader is look at that pattern, look at that signal and say, okay, does the market see this? Yes, Mr. Software, Fulgent patterns, you found the trend line break there, but is it really a good one? And like I say, we can look at this, we see all this volume exhaustion here. Shortly after this trend line break, we see a gap form on volume. So there's lots of things happening around that pattern that tell us that was good. What the software is doing is it's telling us where they are, and that's its value. And so I can go along here. Here's another one, a trend line break right there to the downside, which actually didn't move much. It was early and across those lows right there. Here's another one that says, okay, we've got a break here, which then took off. Here's another one here. This is a nice one that I'd like to point out. Let me get the little tool again here and I'll draw it. This one is across those highs right there, trend line break, and so on. And then we have another one just forming here on the right. So that is the trend line break pattern. And yes, I'll draw this one too, which it broke it, but it didn't continue. It kind of gapped down there and then came back up and then continued. So that's what happens with patterns. The psychology can be there, but it may not quite be following through yet. And there's another one up here. I'll just draw this. Now, I'm not going to spend the whole session drawing, otherwise we'd be here forever. So I'm just kind of showing some of them here and putting them on the chart. So there's a trend line break there. We had a nice bullish run on Apple recently. Okay, so that's the trend line break pattern and identifies those automatically in the chart. So let's go back to the presentation now and go to the next pattern because we have 7 to cover. The next is support, resistance, breaks, and reversals. Very powerful pattern, especially if it's obvious. Like I said, it's got to be, the market's got to see it. And so what happens is you have a support level formed and you break it decisively. And when that happens, the market's going to go down a ways, especially real-time charts, And so there's a level here that was broken, a level here was broken, this one was broken, and then going to the upside, this one right here, a 1-point resistance level was broken there. And here's one over here. So it's a very powerful pattern. A similar pattern, which is not quite as powerful, but still very good, is the support resistance reversal. And that's where you go up and down in a wide range. And people also call this like a double top formation, but it's really resistance reversal is the base pattern. Because you don't need to have too many points formed, 1 point's enough. And so you approach that level and take off away from it, and that's your indication that it's going to move. Here's kind of a structure diagram. We have the 2 cases of coming down to a support level, taking off, and usually you want to look at like about the halfway of the move is kind of a minimum target for this, and all these patterns have targets. If you break the bottom, you kind of look at the dimensionality of this pattern, how big it is, and you should go about half that distance to the downside. Okay, so once again, let's go to our handy dandy Metastock and go into Fulgent, and let's look at some support, resistance, breaks, and reversals. So Fulgent AI, and I just realized I turned on trend line breaks, but not the reversals. So I'm going to go ahead and do that. We'll just kind of look at them as we go by, and let's turn on the support, resistance, breaks, and reversals as well. And I have them as 2 patterns because the psychologies are very, very different. A break is a panic thing. A reversal is a hopeful thing. So, all right, let's go ahead and refresh this now and see what we got. Okay, let's go back a little ways here and just look at this. Okay. Oh, there's another trend line break there. Very nice. But if you go back over here, look at this. This is what we're looking for right here. Market came down. There's I'm going to do just a few of these. There's the resistance level that was broken right there. It says SRB for support resistance break. And if I go through here, I see there's one here. They're just kind of all through here. Here's one that there's actually some to the downside. Now, one thing I hadn't mentioned yet is this color coding that you see is what we did with the Metastock folks really helped me do this. It was amazing technically how it happened, but programmers talked to them and we were able to color code the chart ahead of the signal, the pattern signal, to show where the pattern was formed. So like this trend line break, that's where it was formed over. This trend line reversal, which we didn't see before, was formed over these bars. And, so you got a trend line here formed and took off from there. So that's what the color is. It tells you, what the bars were that formed the pattern, because we can't actually draw the pattern in the chart. Metastock doesn't, we have a facility to do that. And I know they're working on that actually now, but in the current Metastock, we can't do it. So the color coding is really good enough because you can look at that chart and see, it's very easy to pick out, like support resistance break right there. Let me zoom in a little bit more so you can see a little bit better here. Pretty small stuff. Yeah, there we go. That's much better. Okay. So, I look at this break here. Well, where's it coming from? Well, it's coming from over here, silly. That's the support level it sees. And this one is this one over here. So, but it points them out to you, and then you can, take off from there. And here's a trend line reversal. We already talked about that. So there's trend line form. It's reversing. Actually, it's this line right here, reversing off of it. And then we have the nice move. Okay. So moving right along. So those 2 very powerful patterns, reversals and trend line breaks reversals. So back to the presentation, and we'll go to one of my favorites is the saucer formation. They're kind of rare. I mean, the really good ones are really rare, but when you see that really smooth curvature in a chart, and everybody's seen it, that is so obvious. The market's going, oh, it's being accumulated. Look at that. What do you think? And so when you break the most recent pivot in this saucer shape, that's where you want to go long. And if it breaks down, you want to go short, because saucer failures are really powerful, especially if they're high in the chart. Okay, so let's look at that. And there's also rounded tops too, which is the opposite, of course, of a saucer, rounded top. Saucers typically form about like this. You've got a distance to a high. You go out about 0.6 away from that distance. That's where it's probably going. And of course, I draw the scale on here to kind of figure out, where to put stops and stuff. You break to the downside, it's going about the same amount of distance to the downside. And like I say, very, very powerful pattern. Let's go ahead and turn that one on here. All right, Fulgent AI, go into the patterns. And where's saucers? There it is, right there. Okay. So, and we make it where you can turn on and off these experts, because as you're going to see, if you have all of them on, completely, there's a lot in the chart, and people want to specialize. They want to find the specific thing that they're, really interested in seeing. Let's see. I think Apple is one of those that doesn't have a saucer. I'm looking across here at it just to see if I can find one. Say SAU, SAU, SAU. No, I don't see one. So there's no like real clear rounded formations, but we'll see them in other charts here in a little bit. Okay, so that is the saucer. Let's go ahead and move on here to the next thing, which is, drum roll please, that would be the Fibonacci retracement. And I have a funny story about this. I met a guy in Dallas, Texas, several months ago, and he was about 80 years old. The guy looked like he was 45. I mean, he was so energized. And he just said, he came to me, and I did a presentation, of course, on some other things, some AI stuff. And he goes, Ed, I got to tell you, all these years, all I've been doing is trading Fibonacci retracements. And man, they just work like dynamite. I pull about 500 to 750 a day out of the market, and I'm having so much fun. So this is a pattern that you can specialize in. It is very powerful. Just like all the other patterns, you need to make sure the market sees it. It's not as obvious as a trend line break or support resistance break, so you can measure it pretty easily in the chart. Either a 50% retracement, 38% retracement, or 62% retracement of a range. And the 62 here is of this range. So 38 of that range, 50% of that range. It's not that hard to see with the eye, but what we know is that there is something about this. There's something about that point. And actually, interestingly, on the U.S. market right now, the Dow, our indexes are right at 50% retracement. I mean, they're right there. Dow 24,000 is just perfectly on that line. So we're really watching that thing because it's kind of a big deal. But you want to make sure you see the reversal off the line. So like our software will point out where they are, and then you need to wait and make sure you get follow through on the other side. But there's no reason to be greedy. I mean, you don't have to get the exact point that the thing happened. You can wait a few bars. There's lots of time because these things move a long ways. So let's go ahead and turn that on and see what we got here. So patterns, Fibonacci, there we go, right there. All right. Okay, Mr. Chart Pattern Engine, show me some fibs. Okay, so here's an example of one that was found that did not fall through. It looks like a 50% retracement of this range right here, and the market didn't see it. So, this actually was a very bullish turn on Apple because of all the other things that were happening, the gap, and here was a support resistance break right there, So it's just going to town. So anyway, so that Fibonacci level, the market didn't care about it. If I go back in the chart, let's see if we can find another one here. However, these it did care about. So let's look at this one right here. Fibonacci right there, and if I were to draw a range, and I've got a great tool in Metastock for this, by the way. It is the retracement tool, so I can go from a high to a low, and very quickly see that is a 62% retracement. I'm sorry, so you come down, go up, come down. So it's a 62% retracement of the range. This is a 50% retracement. Both of them resulted in very nice moves to the upside. Let me see if I've got another over here somewhere I can show you. Nope. Okay, let's go over here. And nope. Now the reason I'm staying in one chart is if I jump between charts, we would never get done. I'd just have to, they'd have to get a hook and pull me off the stage, and I'd be on pattern number 4. So we're not, I can't go between charts right now, but I will in just a minute. We got plenty of time. Okay, so that is the Fibonacci level, and noted these two here. I just put the range on it, but that's what you do. Use the Fibonacci range in Metastock, stretch it, and you've got those different levels right there on that tool. Okay, so let's see. Where are we in our little pattern lineup? Ah, yes, price gaps. Haha. These things are awesome too. You know, and these patterns work together because you can get a trend line break and a gap and a volume pattern, which we haven't talked about yet. And when all those things come together, oh man, you've got something. Okay, so again, you know, the patterns will form, you have to confirm them. Let's talk about these 3 kinds of gaps for a second because there's some nuances to them that I want to mention to you. The breakaway gap is pretty easy to see because you're at a low or a high and you take off in the other direction and a big gap forms and the chart keeps going in that direction. Sometimes they'll form and the chart fails right away. So you got to give it a little room, don't get greedy, let it go a little bit and then go, okay, and you can put your stop right in the middle of that gap or at the base of it, not very far away, so you're well protected, but you want to let it move some. And one of the reasons for that is the measured gap. What happens is you're going up in the chart and you have this gap form right to there. And what you don't know is it going to keep going or is it going to turn around on you? If it turns around after a move in the chart, it becomes an exhaustion gap. The demand exhausted itself, usually have a lot of volume right there, and then it'll just fail. That's an exhaustion gap. Very tradable. Those are great short opportunities to the upside. But if it continues in the same direction, we call that a measured gap. Why? Because it is a continuation pattern. Measured gaps measure the halfway points in moves. So you start down here, here's your breakaway. You have a gap, you don't know yet. Okay, it's going. All right, it's a measured gap. So guess what? You can project from this point here through the center, which is the measured gap, and find out exactly where it's going, like 85, 90% of the time. It's very easy. Let's see if we can do that in Metastock here. So back to Mr. Fulgent chart pattern, jobby duper. All right, there we go. And we're gaps. There we go. Got it. Okay. Okay, now we do call out a lot of gaps because they're powerful patterns. So we want to err on the side of really calling them out. And so you'll see quite a few in the chart. If I go back here, and these are breakaway gaps, of course. Here, this one was a little bitty one that didn't go anywhere. So like I say, you're going to see them, especially in the scanner, and you can instantly tell if they're good. Here's an example of a good one. So if I look at that gap right there, I need to zoom in because I know you can't see this very well. Let's see here. Okay, there you go. That's better. Could be a little better maybe. All right, even better. So let me get Mr. Fibonacci retracement over here and stretch him from the low. Okay, now that gap just happened, let's say. All right, we don't know where it's going to go. But what I do is I put the center of the Fibonacci tool, which is right there, 50% is right there. And guess where the gap's going? Right there. It almost gets there. It's so close. It's kind of weird, but that's where it gets to. So when you see gaps, when you see a gap in the chart, especially a big one, you know, you just see it, right? Software's going to say, there it is, or your eye, if you're not using the software, you can pick these out very, very quickly in charts. There's a big gap just happened. And watch what happens after that. Now we had a little 1 bar pullback here, but it needs to be a failure. It needs to be pulling back like down to here somewhere. It's not. It starts going up again. Okay, there you go. Get in. And that was good for a good, I don't know, 4 or 5% right there in that move. And if you stay with it to the target, it was good for like 8%. So pretty good, pretty good. Let's see, we'll go to the right here. I need to go ahead and take this off. And let's go to the right, see what else we got over here. Okay, you can see that the patterns are starting to kind of come in here. Here's some more gaps. And this is really a breakaway gap right here. This one's pretty close to the start of the move. I don't see any called out in the middle of the range. But here's a good one right here. So if I do the tool again, retracement from this high down to here, 50%, and it goes just, there's 50%, right where the gap is, just almost perfectly to that point. Telling you folks, this just works all the time. So it gives you a target. So you're gonna put your stop on the chart, and then you need a place to go. So you want that ratio of where you're going to the stop to be like a 2-to-1, 3-to-1 number. For this trade, you put your stop right at the start of the gap, and you're going all the way down to here. That's clearly, from this point right in here somewhere, clearly like a 4-to-1 profit to loss ratio from the stop to the move. Okay, we're moving right along here. And let's get down to some of my favorites now. So, yep. The next one is the volume climax. Really powerful pattern. I know I say that about all of them, but this one really powerful. Volume climax is what's happening is the chart's going down. It's screaming down like crazy, usually very steep. Volume is rising, and then volume backs off, and the chart reverses. Well, what has just happened is everyone who wanted to transact, I say everyone, all the players on that stock or whatever it is that wanted to transact at that price have done so. They bought and they sold. They said, okay, we're done. The ones who sold said it's going down. The ones who bought said it's going up. There's no more pressure. It's gone. It's all been evaporated. Everybody who wanted to do it did it. So it takes very little pressure to move that chart up from there. And you just see this all the time. The same for a volume climax to the upside. You going up on the chart, up on the volume, they both back off. That chart is probably going down, at least for a pretty good ways. Now, what happens if the chart's going down or up and the volume increases a whole lot, but then the volume backs off, but the chart keeps going? We call that a volume trend pattern, and that is a measured move pattern, which means when those happen, you're probably about halfway in the move from the start of that to where it's going to go. It's amazing how well this works. I mean, it's incredible. So let's go ahead and turn that on and see what we got here. Fulgent, all right. The patterns, and where is it? There it is, volume climax right there. Okay, so we'll turn that on and bingo. Let me back out a little bit here so I can see more of them. All right, climax, looking for it, volume. Okay, here was a volume trend signal. Now here's one back here that is pretty good. So we come down, we're screaming down. I like to see them really coming down from a long distance, but this one's pretty good because it screams down, and I've got this really big increase in volume right here, and it backs off just as the chart is starting to go, no. And it does go up for a ways. So that's a nice little reversal pattern. This one here says VOL on it. The volume increased as it was going down, right in here. Then it decreased, and the chart kept going. Okay, so that's what we're looking for. Looking for another good example I could talk about. And pay no attention to that man behind the curtain. He's doing something over there. Okay, now also what happens when you turn on all these patterns, they overlap each other, and it will do, I think it's the first one in the lineup that it sees it's turned on. So right here, there is a volume climax. There's also a gap. So there's two patterns forming, but your eye can see it really easily. Look at that. I mean, this is that recent coronavirus decline, a nice gap. The volume is really high right there, right at that turning point. Great place to look at going long. On actually, quite a few stocks did that on that day. Okay, we're getting close. I think there's one more to talk about. Oh, this is the structure, which is what we just talked about. Volume climax at the peaks, volume trend in the middle. That's a halfway point of the move, typically in a volume trend, going down to here. There you go. Okay, so last but certainly not least is the consolidation pattern. And I do think that it is the most powerful pattern. The thing about consolidations is, you need to make sure the market sees it, okay? And it just needs to be really obvious that a range formed from a move point. So you start low, goes up, a range forms, and you can have both reversal consolidations, that fail. I call them failures. You can also have the breakouts. The breakouts are the best ones because those are measured move patterns. Same thing. Look at their structure diagram here, this thing. If you see a really well-formed consolidation, you can just take it to the bank because you take the width of that thing, You go back about the same amount of width and you'll find a low down here 9 out of 10 times. And if you just project with that nice little Fibonacci tool I showed you in Metastock, you just stretch it, and that's where it's going, is right at the end of that tool if you put the 50% line right here. And that's also where you can put your stop. So it is an amazing pattern. Again, our software is designed to find anything that it thinks could be a consolidation. So it's looking for any kind of a range that breaks out. So we'll go ahead and look and see what it finds on Apple here. And, you know, some of them are obvious in move and some of them are not so much. If I look here, this is what we call a broadening top consolidation right here. And it's really clear now, of course, because it's already happened, but in real time, you would see that, or imagine that those lines would look something like this. It sees this consolidation first and says, I've got a break. It's that one right there, right? Got a break to the upside, but it doesn't take off. It doesn't go far. Then it goes down here. Oh, now we've got the broadening pattern formed, and it sees that break of the broadening pattern and goes, oh yeah, you're probably going down here. It's just telling you this is the point where you need to look at it. So you may go a few bars. Here's a saucer pattern. There was one. It's a rounded top formed right there. And you got the gap. I mean, where do you want to take the trade? I mean, there's the gap down, the support resistance break, you know, anywhere in there is a very nice trade. But that's finding that. So that's that purpley pattern there. Here's another one. Here's a consolidation. This is where the patterns kind of gang up on each other. So I've got a consolidation formed right there. I've also got the support resistance break. And if I look really close, there's a gap right there too. The gap is probably being masked by that support resistance break. So I've got three things going for me. And lo and behold, ooh la la, we have the volume increasing down here. Oh yes, it's all jolly good fun. That's going to go. That's a perfect pattern right there. Let's project it. So if I project it with the Fibonacci tool, here's the width of the pattern. I go back the width, go down, there's my low, go up through the pattern, and 50%, bingo, bango, bongo, it goes right to there. It goes a little further, actually. So, you know, that's just a cool pattern. I love those things. All right, so that is consolidation. And so I know I've gone pretty quickly through those, but they are dynamite. And like I said, you don't need software to find these things. You can see them in charts every day. And we're gonna look at some charts in your market here in just a second. Just want to cover my last points in the presentation. I feel that these are the three most powerful patterns to trade. Is the support resistance breaks, especially reversals. You saw that in that chart. Volume climax is extremely powerful. They need to be obvious. And consolidation. So those are really the bellwether patterns. Put a little note there on the side that you want to kind of be watching for those, especially. The Fibonacci's are good too. I mean, they're all great patterns, but I've just found those seem to kind of work out the best of all the ones that you could run across. Another point about trading with patterns is you kind of want the volatility to be low if possible. This chart will be hard to trade with patterns. I mean, I can see little consolidations in here and stuff. It's just your odds of getting stopped out are really high because the chart's going all over the place like this, you know, up and down, up and down. This is much better. If you've got a nice, well-formed, orderly chart, here's a support break right there, another one here, or trend line, you could call it a trend line. You know, just try to tend to trade the less volatile charts. The other thing is it needs to be liquid. So I know there's a lot of stocks in all markets, our market, your markets, where there's little dots everywhere or little bitty lines, like there's just no volume. I mean, our software will pick up those, get the gaps in there, and they can be pretty good, but you know, there has to be a free moving market where there's a psychology at work and a lot of people looking at that going, oh, I'm jumping in. So just that's an important point. The last thing on trading with patterns that I want to say that will really help you be successful is go ahead and look at the index as well. Look at the market. Now I hand drew all these on here just because it'd be really easy to see it, but you can use the software that we have too. But like this recent route from the coronavirus, you know, just looking at the market, we were breaking support levels everywhere in there. There were gaps down, there was volume coming in. I mean, it was really, really telltale that was happening. There was a consolidation here that broke through. You know, more support levels breaking through. So I mean, if the index is telling you that it is going down or up from a pattern that's very obvious, and the market reacts to the markets. The people trading the market react to what's happening to the market. And so you just really want to see that. Very, very good and important. And finally, the last thing I have here is that if you're using anything else, it doesn't matter what trading system, indicators, get used to looking for the pattern around the signal that you're considering trading, because they will add a lot to your ability to make money with whatever it is. And that's just definitely for sure. Okay, so with that, let's go ahead and type a few symbols in here from your market. We've got, I'm going to leave about, let me ask Hunter, how many questions do we have backed up out there? If you're, sorry, I caught you by surprise.
No, you're fine. Let's see, we have someone looking for Walmart, so that's WMT.
Okay, they want symbols.
Yeah, so if we have, and just to kind of put this out there, if you want to see any symbols out there on YouTube or in GoToWebinar, type them into the chat, either platform respectively, and hopefully we can take a look. The one we have so far is Walmart.
Yep.
And that's up to you.
Yeah, so I've got some stocks here from the Australian market and Hong Kong and Singapore, so I can start typing those in too. Yeah, so you see some really great opportunities here, and I can start marking your trend line reversal off those lows right there. Trend line break here. This was really a good one because it started picking up steam right away from that trend line going across there. There's a measured gap right here. Actually, you know, that was the exhaustion gap because we pulled back up in the pattern. Here's a gap up right there. So anyway, that's Walmart. So they probably want to know what's going to happen next to Walmart. Let's look over here, the right. So, and again, all these signals are designed, it's not a mechanical trading system, obviously. What they're designed to do is to get you to the chart from a scan. Now, the one thing I have not shown, Hunter, that I needed to show, I think I have enough time for this because it's really quick, is the scanning feature. Because I'll tell you, I've used a lot of software, and this scanner in Metastock is really, really good because it's fast, it's simple. So let me just show you that real quick before I go on to do some more symbols. If I go into the Explorer, we provide a whole bunch of scans because we provide the main one, which scans for everything, but we also provide the individual ones because, like I say, they can be on top of each other. And, you know, we would have the chart would look like a mess if we showed all those, right? So you can scan individually for any one of these patterns, and it doesn't matter if they're on top of each other. It's going to tell you which charts have a gap, which charts have support resistance breaks or whatever. I'm going to use the general one right now, which looks for all the patterns, and I'm running it on the S&P 100. I know it's turned on here somewhere. There it is. Sorry, S&P 500. So 500 symbols. And normally I would not do this in a webinar because it would take a while. However, Metastock is so fast that I can do it. So let's just turn it on here. And you can see it going. There's 500 symbols. It's already almost to 100. And so while that's going, I can talk about what's going to happen down here. When it finishes, we're going to see every symbol in the S&P 500 that has a pattern forming today. The software is detecting there is a pattern there. You need to look at it. And there's a nuance to it, though, that I want to explain that is really, really helpful. So we have these little arrows out there in the chart. And one of the things I did not show, and I think I can do this right here, I'll show you in a second, is you can actually click within 3 bars of those arrows to see the commentary. The commentary teaches you about the patterns. I'm going to show you that next. But what we do is we have a little, like an exit, it's like a 3-bar and then the pattern's done. The reason we do that is so that you have a chance to see a pattern that happened yesterday or the day before or the day before, because they will mature and start moving in the right direction, and you want to see them then. So if I look at this list here, I've got my long signals, you know, all the patterns that are firing long, and they're numbered because they're all together, and the numbers are easy. There's a legend for the numbers. 501 is a trend line break, for example. But the thing I'm talking about right now is this in long column, which is everything that has been in trade for 1, 2, or 3 bars. So you see the bars here, 3, 2, 2. So that pattern, that 505 pattern, can't remember which one that is, but 505 pattern fired 3 bars ago. It's probably dynamite. So you want to look at these in trade patterns, you know, to trade. Of course, you can just double click them, get to the chart, really easy peasy. All right, so what I was just talking about, let me show that to you. I say view, commentary, and let's click on one of these within 3 bars. And let's see here. Oh, it's not doing it. Why not? That is weird. Let me just refresh the chart here and see why. There it goes. That is strange. That's actually never happened before. That's weird. Okay, so I'll click this trend line break. So what we do over here is we show you, there's some education on it. You can go to the website and get more about that pattern. But we allow this little 3-bar window after the pattern, which is where you click to get that. So every pattern has its own little, description and everything, kind of like what I was showing in the webinar. Okay, so back to the symbols. Another one, and I'll do a couple of other markets. We've got about 8 minutes here. So if you've got
so so I have 2 symbols for you and 1 question. Which
okay.
one would you first?
Go.
Let's do Luna, which is LUNA.O. And while you're typing that, a very good question came in. You've been showing examples on daily bars. Can you use these patterns on 5-minute and 15-minute charts?
Oh, absolutely. Well? Absolutely. Yeah. I would go in higher time frames. They're just, you get a lot more smooth movement in higher time frames. So 5 is okay. 1's pretty hard because you've played the 1-minute chart, right? It's going like this. So it's not really forming a psychology. I like the 39-minute chart myself because there's 10 of those in the US exchange day. But 30, 15, yeah. But it works in any time frame, any instrument, Forex, futures. Somebody gives me one of those symbols that you'll see it's just seeing the data, and so it will find the patterns. On this one, we see the broadening consolidation said to go down on Luna. A support resistance break across right there said you're going down. A gap right here said you're going up. So it's working pretty well on this symbol. But again, the whole idea is to get you to the chart to look at it because it's psychology. And you can see that very easily once you know the patterns there. There's 10,000 stocks out there. I don't know how many there are on the Australian exchange, the other ones, but a lot. So, okay, next.
Next one is FPH.NZ.
Foxtrot Papa Hotel.
Correct.
NZ.
NZ.
Okay, November Zudu. Oh yeah, that's a nice stock. I like that. So we're seeing all green arrows go all the way up, except right there it said no, you're going down, and then green here, and then there's a gap there. So pretty much all these signals are correct. On a trending stock, it works really well because you'll pick up the support break, the resistance breaks, the gaps into the trend. It'll tell you, yeah, you're going through resistance right here. You might want to look at that stock, and sure enough, you get a little gap right there. Oh yeah, we're out to the races. So yeah, but that's a nice one. Thanks for that one. That's good. Okay. I feel like Karnak. Karnak says.
Let's see here.
Or I can type some in. Let me do there's one on the Hong Kong market. Let's see if I can. Oops, no, not that. The wrong key. I think this is right. 17.hk, believe. How would you type that in? 17.hk. Is that the symbol?
Yeah. So everything on the Hong Kong market is numerical. It all just has numbers, so it should be 17. Do you have the it should be 17.hk.
I didn't see it come up. Let me try 27 because another one here, HK. I don't see it coming up.
I saw a 2700 HK.
Oh. Okay. That's not it though. That's not the one I was looking for. I can go find it in the symbol database, but
click on name.
Click on name. Okay, I'll try the name. So the name is Galaxy, and it is Galaxy ENT
0027.
0027. That's the magic formula right there. Okay. Thank you.
No worries.
So anyway, this is a nice symbol on the exchange. Now, as I was going through the Hong Kong exchange, I noticed there are a lot of illiquid symbols. You all know this if you're trading it, but lots of very nice moves in this market. I mean, I love some of these stocks. They really have great things going for them. Really nice gap right there. This pullback did not go into the gap, so it qualified as a measured move or a breakaway gap. Another one here, very nice. Support resistance reversal across there. This one did not move. It did not keep going, so that's fine. And then we got a trend line break here. What is that? Another trend line break down here to the upside. So that was a good one. There's one over here on the Australian market that I thought was pretty cool too. Let's see. Let me just try if I can type it. It's 5GN. And I'll take your symbol here in a second, Hunter, but you probably got .AX. I think 5GN, is that it? Okay, I'm gonna have to do the name thing again. It's 5.
So you're on name right now?
Yes, I am.
Oh, you got it. You got it.
But that's .CH. I want 5G.AX. There we go. Is that it? Yeah. Okay. So, again, gap. So sell signals all the way down this. That's a nice consolidation break right there. This gap did not continue going. So that was an exhaustion gap, pulled back. And support resistance reversals here, a gap up, gap down, support resistance break right there across that level. It's seeing that support right across there, breaking it. And it's just really easy to see these things with your eye once you get to the chart, a gap up. So, And go ahead, you have another one?
Last one. Yeah, last one, CPRT.O.
CP, Charlie, Papa, Romeo, Tango, Oscar. Is that it?
Mm-hmm. Yep.
Okay. Oh, yeah. And this is a case of the Fibonacci level being called out from this range. Looks like a 50% and right in this big drop, and it did not fall through a little bit, but starts coming back down toward the level. So, the market just didn't care about that with this going down like that. But then you have the gap up, gap down, trend line break this way. This was a really nice place in the market where a lot of these formed is right there. There's a consolidation. It was basically a pattern up and down. It sees that break. Trend line reversal across here, another consolidation. This one's a nice target example because if I get the little tool over there, get out of the bottom, go through it, 50%, it's going to there. So very nice example. Thank you for that. What is that? Copart.
Copart. Mm-hmm.
Interesting. We'll go and get the little advisor to tell me something here. Okay, there we go. Support resistance break. That's what it is. All right. Other things or questions?
Not so far, no.
Okay. Let me just mention, we'll go and go back to the chart, but if you want to get that book again, it's a free ebook. So fulgent.ai/Metastock. You'll see it right there and happy to send that to you. Okay. Go back to the chart. And let me see, I've got a couple more here on the Singapore exchange that I thought were pretty cool. Let's look at ALIT.SI. ALIT. Oh, I'm on name. See if I can do it this way. There it is. Okay. And let me back out a little bit here. Okay, so same thing, support resistance break, gap. So the software is looking for ranges, and you can look at that right there and say, well, that's not really a consolidation. So sometimes it'll do that. And so again, the idea is it takes you to the chart, you look at it and go, ooh la la, that's a really good one. Or well, not obvious. The market doesn't see that. The program may see it, but the market doesn't see it. So that happens sometimes. But generally speaking, you'll see things like this here, support resistance break through there is a very nice trade. The gap down, nice trade. And I had one more here, ALPN.SI. Nope. I can't do that one. Okay, let me try the name here. ALPN, that is Alpha Energy Holdings. So Alpha Energy Holdings. I thought I typed that in. Maybe not. Maybe I misspelled it. So this one has quite a few patterns firing in the down move here. and then starting to see, gap up. So that gives you just a look at what, and again, we've got all of them turned on, but we actually don't have all of them turned on. I had not gotten to the sister patterns. I'll just go ahead and turn them on, see if we see any real quick here. The cup and handle, tops and bottoms, head and shoulders. And I know there's a cup and handle in the Apple chart, for example. So let's go ahead and type that in and go back to it. Oops, nope. Agilent. Okay, APL.O. Oh, Apple. See, Hunter, I'm catching on. Okay, Apple dot, what is it? Dot, do you know the exchange?
.o. Yeah.
.o. Okay. .o. All right. Oh, Apple.o is invalid. Oh,
yeah,
because I put the E on it. Dadgummit. Come on, fingers, don't do that. Apple.o. No?
So
Oh,
do this.
What?
Yeah, so if you start typing it, it'll be in that list.
There you go.
We go.
Okay, here we are. So yeah, so let's see if we can see that. I saw it over here a while ago. Cup and handle right here. There's one. So little kind of rounded pattern, sideways movement, predicting a move up there. And anyway, so now they're all on, and so looking for another one that we hadn't seen before. And I'm not seeing that right now. Okay, just that one cup and handle, but it will definitely call out double, triple tops and bottoms and cup and handles, head and shoulders if it sees it. So, okay. Other question to wrap up on? We're right at time here, it looks like.
No, nothing else. Looks
okay.
Like we're good.
All right. Well, I sure appreciate the chance to be here. And there's my email address. If anybody wants to ask me a question, ed@fulgent.ai. And I just always enjoy this with you guys, Metastock people. You guys are awesome. So thank you.
We try. Oh, one question did just come in. Where can we get that ebook one more time?
Yeah, it's just go to fulgent.ai/Metastock. And you can also read about the AI product we have over there in the Metastock store. It's part of our offering for Metastock. But the first thing on the page is that. And yeah, just sign up, and I think it'll come right to you as you sign up for it. So there you go.
Perfect.
All right.
Well, thank you so much for your time, Ed. As always, it's a pleasure.
You're very welcome. Oh, one thing, Hunter, if Jeffrey were here, he'd be probably saying, we have the chart pattern engine available at Metastock, and it's right now discounted. It's normally $14.95, but on sale as an introductory offer for $9.95. So I'm just trying to do Jeffrey's part there. I know he would be saying that at the end of my presentation. So
yeah, I'm getting to that part right now, actually.
Oh, you were? Okay, I'm sorry. I stole your thunder.
You did. I have no thunder left. I'm thunderless now.
It's all right.
1 o'clock in the morning, and there's no thunder. I have no thunder left.
I understand completely.
Well, thanks for staying up late there. It's 2 o'clock in the morning there, so we truly appreciate you spending the time with us this evening.
It's fun, even at 2 in the morning. It's fun.
Even at 2. All right. Thanks, Ed. You have a good evening.
Thank you, Hunter. Take care.
Yeah. Thank you, everyone in the audience. For attending. I want to cover this with you. I mean, we saw the signals that were getting shown by the chart pattern engine. It's an amazing add-on, as you saw. It has really wonderful features in it, the 13 explorations and you being able to sort by which pattern you're looking for, and something that says a lot of specializing in a pattern. So with the expert advisor, which he was showing, it'll explain the pattern to you and actually how to trade it. So being able to go in there and search for a pattern and really start specializing in that pattern and understanding how it works. There's 13 explorations. The expert advisor is amazing in it. Now, normally this is something that we sell for, like Ed was saying, $14.95. We wanted to put this into a bundle with the rest of the tools that were showcased this evening. One of the other tools that was showcased, the speaker before, Mr. Stuart McPhee, his trade launch systems with the 4 systems that are included, the expert advisors, explorations, indicators, the customizable expert, which is really cool. You can put in your trade parameters there and it'll kind of outline your trade for you. Again, we just finished a 5-module training course, which lasts about 6 hours long on his trading methodologies, etc. Both of those things together, normally $12.98. We packaged that with Ed's add-on, the chart pattern engine, for a specific reason, and that is because we feel that if we provide you with Metastock DC, so end of day, a month of data, the chart pattern engine, Stuart McPhee's trade launch system add-on, as well as 6 hours of training with him, Unleash the Power of Metastock, which is kind of a how-to guide getting used to all the new features in Metastock 17, and the white glove installation service. We believe that within a short learning curve, that this will greatly impact your trading. Learn how to become a non-emotional trader, understanding how to come up with a trading plan, understanding where your stop losses should be, where your limits, understanding chart patterns as a whole, understanding trend, having people walk you through every step of the way. We feel that if we provide all of this for you, that, you know, like I said, it's going to be a big impact on your trading. Normally, all of this together costs about $3,300. For attending the summit this evening, we're going to discount that by almost $1,500, $1,997 for a permanent license to Metastock DC, for a month of data, for the chart pattern engine that alone is $1,500 normally. Trade launch systems and the 6 hours of training altogether for under, for $1,997. Now, the way that you take advantage is, this isn't something that we're going to offer long term. The way that you take advantage of this is a couple of different ways. The easiest way is right now, go to metastock.com/sales chat. We have sales guys standing by that can answer any questions about Metastock 17, that can answer any questions about chart pattern engine or trade launch systems. These are 2 add-ons that our sales guys actually personally use, so they have quite a bit of experience with them. So go to metastock.com/sales chat. Tell them that you're at the summit and that you want the Trader Summit bundle. And then, of course, ask any questions. What they'll do is they'll get you set up for everything, and then they'll set you an appointment with one of our support reps to get everything installed for you. That way you don't have to, worry about the installs, etc. The white glove service, they literally install everything for you, and they kind of walk you through some basics of setting up your charts and different things of that nature. #1 customer service in the industry, I can assure you that. So get the tools that the professionals are using. Everyone that spoke tonight, from Brad to Gary, Darryl, Robin, Stuart, and Ed, they're all using these tools and have been for a very, very long time. So get the tools that the professionals are using and learn how to use them from the professionals, and you will be successful. Another way to take advantage, if you're in the States, give us a call at 800-882-3040, or if you're out of the States, +1 801-506-1003. If you have any questions, feel free to let us know. I'm really, really glad that we were able to have these speakers on tonight. We love your feedback, so if you have any feedback for us, how we could have done it better, definitely let us know. Keep in mind that it's 1 o'clock, 2 o'clock in the morning here, so go a little bit easy on me if I don't look as spry as I do at 9 a.m. in the morning. Yeah. I'm looking forward to it, buddy. Spry as ever. I like it. Thank you, Greg, our completely impartial marketing guy here at Metastock. most of the time he doesn't. He's not like part of the time. So, like I said, if you're still out there, thanks so much for joining us. Come into metastock.com/sales chat. We're more than happy to answer any questions, or just give us a jingle. We love hearing other people's voices right now, since we can't really get out of the house. On that note, everybody stay safe out there. Stay home. It's a good time to work on your trading. It's a very volatile market. Be careful. I think one of the things that all of the traders tonight are going to reiterate to you is be careful, whether they're bullish or bearish in the market. Don't let emotions drive you. Use facts and figures. Use the data in front of you to make educated trading decisions. And if all those guys are saying it, I take that to the bank. So thanks again so much for attending. The recorded videos will be sent out to you via email. They'll be available through GoToWebinar and YouTube probably next week, once our wonderful marketing guy Greg gets those all shined up. They'll be available on our YouTube channel. If you haven't subscribed to our YouTube channel, it's probably something you should do. youtube.com/Metastock. Yes? If you would like to marathon it, you guys are better people than I. Go back to YouTube. It's available. It's available now. Like I said, though, if you have any questions on pricing, on what the bundle includes, etc., just go to metastock.com/sales chat or give us a jingle. Thanks so much for attending. Go out there, stay safe. Don't go out there, actually. Stay safe at home. And as always, happy trading.